expectations coming up for the next quarter. So last quarter, they posted about 64 cents. And of course, they cut now another 9 cents off an adjusted basis and widened the range to between 18 and 36 cents. So that's effectively half of where they were last quarter. They're also seeing comp sales for the quarter to be down
Nationwide
8 to 12%.
is so much more than a great insurance
And
company.
again, they're
one of
looking at
America's
these
largest
additional
financial
charges
services
associated
companies.
with
Like how
restructuring
more than
costs. They're
Saquon
going to be
Barkley,
laying
the
off some
NFL's
workers,
reigning leading rusher,
cutting
also
back
the
their experience
NFL's
center. These are
leading
again,
rusher.
these are factors that they mentioned in their last results. But nonetheless, they did
I might have
again
just set
post
the hushing record.
some auto sales. At least EV sales were higher because of the expiring tax
for your
credits by
insurance and financial needs,
6.4%
Nationwide
September
is on your
versus
side.
August. But if you look at effectively the wholesale used vehicle market, prices have been falling. And total sales September versus August were down about 2%. So volume is down, prices are down. That's not a good sign.
Man.
And of course, the restructuring charges added to that, putting pressure on CarMax this morning again.
Right, and you're looking also at Fortinet this morning, which is also lower on earnings. Can you talk us through that report and the reaction you're seeing today?
Yeah, let's take a look at the price on this one. But yeah, so this one's interesting because it's a cybersecurity name, and if you look at the EPS numbers they posted, 74 cents higher than the 63 cents, about a 17% increase. If you look at the top line sales, 1.72 billion. 14% higher. They also beat the estimates fractionally by about 20 million. The challenge is their targets essentially about 14% in terms of sales for next quarter. And of course, for the full year, they see expanded AI solutions. One of the things is, if you look carefully, the next quarter revenue range was actually widened out to 1.83 billion to 1.89 billion, where the estimates were 1.88 billion. So in other words, they widened out the range of next quarter's revenues, the low end of the range, and so that's essentially putting pressure on the share.
Okay, looking across three key names this morning off the back of earnings and the reaction in the market today. Thanks so much for that, George Tillis. I'll talk to you a little bit later on. Coming up, Jason Ware from Albion Financial joins me to discuss his economic outlook and some stock picks in mega cap tech and consumer names. Opening bell, we'll be right back.
Very restroom. Good morning, good morning, good morning.
While others recap the news, I help you read between the lines from what's moving markets to what's next with sharp takes and market know-how. Follow me on all social media platforms at Diane King Hall and connect with me on LinkedIn for more.
Hey, Bob. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that
Boom, boom, boom.
be vulnerable. Wait, had a stroke? Yeah. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time. Jim, events and stuff. More than that, 20 years ago. Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at schwabnetwork.com.
Welcome back to Opening Bell. Joining me now is Jason Ware, Chief Investment Officer and Head of Research, Albion Financial. Thanks so much for joining me today, Jason. So you're saying that the economy is doing fine. Which parts are and which parts aren't?
Good morning, Sam. So you hear a lot about this K-shaped economy. I think that's a little bit of an oversimplification. I think the way to look at it is things that are sensitive, things that have been sensitive to interest rates, like housing and manufacturing, industrial production. services report yesterday, and the services economy, which is by far and away the biggest piece of GDP, continues to expand and continues to do well. So we have consumers out there spending. We have jobs that are, yes, the labor market's cooled, but the jobs market is okay. We see wages still above inflation and unemployment's low. And so those are the things that really matter to economic activity. And then, oh, by the way, we have a strong AI capex boom underway that is adding to growth. So most of the economy looks good. Some of it is sluggish, but as the Fed reduces rates, maybe those other parts will pick up.
Yeah, you raise a lot of interesting points, and I suppose herein lies some of the confusion with the conflicting data points. So you raise a really good point first and foremost about ISM. I mean, services sector activity continuing to look strong, and particularly that new orders gauge I was looking at jumping to the highest in about a year. I mean, this makes up for 80% of the economy, but then you get a report out like this morning, Challenger job cuts 183% month-on-month higher, the most for October since 2003. I mean, if you have a job, you're more inclined to spend your money, and some of that, to tie into your capex point, is to do with AI and losing jobs to that technology. So how do we make sense of all of this now, Jason?
It's a really keen observation. And look, I think first and foremost, we can't put too much weight on the Challenger Gray Christmas report. That is notoriously volatile. I can't tell you, I mean, I've been doing this over 20 years. I can't tell you how many times I've seen a bad report from that group and heard people saying, oh, here come layoffs, and they never materialize. We prefer to look at things like initial job displacements, and they are very low. They are at near cycle lows. They're just over 200,000. Yeah, we haven't got them at the accurate level because of the government shutdown, but you can still look at the state filings, and they look really good. So, look, I think there are certainly parts of the labor market that are squishy. AI is certainly having an impact, I think, on companies' willingness to hire. I don't think it's firing people as much as it is maybe putting companies on pause, or maybe even saying instead of hiring 3 new analysts, I only need 1. I think that's more of the decisions happening at the firm level. So the technology, we are trying to figure out how to use it. Businesses are starting to use it more. So there are some decisions being made that might look a little bit different. But again, I wouldn't put too much weight on the report this morning. It seems when you look at the broader picture in the U.S. labor market, it's not hot, but it's not cold either. I think it's just floating along. ADP yesterday, 42,000 jobs. Not great. Again, not fabulous, but good enough for a decent economy.
Working across teams
so like some
is
encouraging
tough,
data points. It's
but
good to put it in
Asana helps
context.
you handle
Squishy.
it.
I like
Asana
that.
AI can spot
What we
roadblocks
do
and
know,
assign work
because
to
we
keep
haven't got a lot of
everything on
government
track.
data, but we have been getting a lot of
That's
earnings,
how work
is
gets
that
handled.
some of the fast food
Visit us
retailers,
at
casual dining,
asana.com.
have been sort of sounding the alarm bells on the consumer, particularly the younger demographic, low-income consumers as well. I mean, it was Mickey D's who really raised the whole idea of this bifurcation that they're seeing, and, I mean, they continue to see a challenging environment. So it's clear that it's not just a Chipotle problem, which we heard from first. Starbucks is faring quite well. I mean, Mickey D's also is seeing good same-store sales, but what do you make of what we've heard from these companies so far as a sort of prelude to what we're going to hear from the retailers?
Yeah. So we know that about 50% of consumer spending right now is coming from the top 10% of households. And those top 10% of households don't frequent McDonald's and Burger King and some of these fast food restaurants as frequently as other households. And so I think there is a slowdown in consumption happening below the overall consumer spending number. I think if you go down the income spectrum, you see a little bit less discretionary spending happening. I think that's what you're seeing at those establishments. I would also say that after 3 years of high inflation, and inflation now I think is fairly benign, and we're above the target, but it's not problematic inflation. But we had a couple years of really high inflation, and I think that there's been some exhaustion there. And so that decision to eat food away from home is starting to normalize. I'll give you a statistic that's interesting. Over 50% of food consumption is away from home right now. That's up materially versus pre-pandemic. So what happened is, for whatever reason, on the other side of the pandemic, we all got used to ordering Grubhub or going to a fast food restaurant or going to quick casual for dinner. And I think some of that is normalizing, like we've seen with so many other parts of the economy. So I wouldn't read too much into it. I think overall spending looks okay.
Okay, good to know. So what stocks are on your radar right now, Jason? Just talk us through some of the ones that you like.
Yeah, that's a big question because we could go like 8 different ways. We still like business that does good in both slowing economic environments and strong economic environments. They provide strong value to the consumer, a lot of loyalty, and people enjoy going to the stores and pulling off the whole treasure hunting. So we still like TJ Maxx, quiet compound and trade management team. We like Costco, and that sounds really boring, it's because it is, but go to a Costco and look at the parking lot and look at the lines, and it's still a fabulous business. We got an October comp number from Costco yesterday, 7%. Show me another business of that size and scale that's comping 5 to 7 to 10%. They don't. So great company, well run, very sticky, loyal customer base.
Yeah, I mean, it's somebody put it to me the other day. It's almost like a dumbbell or a barbell. It's like the luxury is doing quite well, and then sort of your TJX, your Costco's are doing well. It's a little bit that people are a little bit concerned about as far as that classification. Jason, it's been a pleasure talking to you. Thanks so much for giving us a look of your analysis and insights today. Jason Ware, Albion National. Appreciate your time. Coming up, we will look at the key levels and charts to watch with Kevin Green. Ladies and gentlemen, right back.
Sometimes, you know, you could have done it. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Moore. We go beyond the headline, tracking the trends, sector news, and fundamentals shaping the markets in real time.
Oh,
This is Schwab Network. Subscribe at schwabnetwork.com.
what?
Live from Chicago, this is Trading 360. I'm Marley Caden. We track
Selfies
macro
make me mad too.
market trends and company news that shape investor decisions. All with expert analysis and information.
All right, my bad, y'all.
From inflation data
Good morning, good morning, good morning.
to policy. It's a comprehensive view of the market every trading day. Trading 360. In-depth
I changed the music and they going crazy right now. Yeah. Yeah, heavy metal, yeah. I love it, yeah.
Let's take a look at the key levels to watch.
Yeah.
Just after the open today, joining us now is senior markets correspondent Kevin Green, live from Schwab Impact Forum.
Yeah,
What
love
are we
it,
watching
yeah.
today, KG?
Good morning, Sam. Well, we are seeing a little bit of
Yeah.
damage in the market so far.
Heavy metal in the morning,
This is
yeah.
a trade that has taken place.
Well, we gotta
here.
check on Lemon,
You're
bro.
able to see this market kind of broaden out over the
We gotta check on Lemon first, bro.
that we have seen over the last couple of weeks, last week.
We gotta
or
get us
so.
some
To the
Lemon
upside, looking
immediately.
at 68.40 as your major area of resistance, as we are seeing the majority of the calls being sold
Oh,
at the
bro.
moment here. We're seeing the same type of options activity
Yeah,
that we saw
hell
yesterday
yeah.
morning. A lot of activity on the wings. We are already seeing a significant amount of options volume on yesterday.
Lemon's still trying to fill up the gas.
So we will be mindful of that. That could be conducive for markets moving
Yeah,
over
give them a
higher,
second.
squeezing higher like we saw yesterday.
See
Or it could be the reason that we have a little bit
if
of
they
a
gonna bounce off that upper resistance that was support.
support that we would like to hold.
Right.
Anytime we break down below that, 67.40. Once again,
Why is everything like rock and rollish?
a little bit more defensive. I think it's
We
gonna
need
be a
like
tough trade that's gonna have to hold
smooth,
us up. I would say keep
smooth
an eye
stuff.
on
Like
Nvidia. That has been a stock that the price action has been
we need
at great
smooth
the last
stuff.
24, 48 hours, especially going into the close yesterday.
We ain't trying to scare everybody when they come in here.
And unpack it a little bit because we are actually seeing Nvidia shares recouping some of the losses. I mean, you and I were watching this stock absolutely losing altitude just as we went into the closing bell yesterday. And now, of course, we've woken up to some of these headlines from the Financial Times about Jensen Huang talking about, the competition with China. So how are you looking at this one? Because obviously this is going to be the next cat off the rank as far as Max 7 earnings.
Yeah, this is one that has been seeing a lot of weight when it comes to the volume here. The downward pressure has been apparent. You can see that within that 1-year daily chart. Pretty much the last 5 trading sessions or so, we've had red candles. But that doesn't mean that we've had red days. We have seen intraday selling for this name. And yesterday, 5
trying to like my stuff.
going to close.
I heard y'all got it.
Around the $5 to $6 move to the downside going into the close. That doesn't give you a lot of confidence. We're getting fairly close to the 20-day moving average, sitting at around $190.50. That could be attractive for a lot of buyers to really step in.
Alright, hold on. I gotta do quick market analysis. See what's going on real quick. Projection on Meta.
Also look at that 50-day moving average if we do break the 20-day. So I think this is still going to be a big headline mover for us. We're getting a lot of commentary.
What direction we going?
And also OpenAI that might be causing a little bit of a stir for investors in this.
Yeah, and look, Diane was just talking
Damn, look what they're doing to RR. RR was like $7. And everything getting a pullback already. Oh, they don't broke the support. Okay, that's what I said last night. Rejection. This is why everything is going down. That run up, the same rejection that we seen the day before the run up. Right here. Yeah, but I hope they got some bulls come in, bull. The bulls gonna come in. I'm expecting a red day.
Okay, and Kevin, just wanted to get your sort of takes as we are nice and warmed up now as far as what we're seeing beneath the surface. A bit of sort of push and pull here. I'm seeing as far as sectors. We've got energy high by 1.5%. What stands out to you?
Everything getting pushed down.
Well, you know, for a market that's down about 3
That's the max 7. Yup, everything is in this red right here. I can see.
It's the S&P right now.
Check gold out. Gold finna go down a little bit lower.
5 lower. But when you look at the weighting, it's
oh, they finna start pulling. Hey, I'm about to get my push ready. I don't know what. Nike crossing. They're going back on this 1 minute.
Consumer discretionary. Those are the 3 big sectors, I think. The S&P.
As soon as the market fall, gold gonna be the first thing to bounce.
The same thing I talked to you about this morning, Tim. This market is jittery and hesitant. It was jittery on the upside slightly. It's jittery on the downside slightly now. VIX is a little higher. I think gold is taking advantage of that lower dollar.
Bro, ain't nobody talking.
Here's the last thing.
Hey, yo, Gable.
Tesla has a 1-day expected move of $17.5. So volatility ahead or during this vote is really spiking in the front expiration and Tesla. So watch for something to happen there if some announcement comes. It is poised or coiled for a big move in either direction.
Yeah, well, it's a huge day for Tesla with that annual shareholder meeting. And I mean, you've got to put it to the shareholders. They've been on a wild ride over the last year or so. I believe $214 below 500.
Hey, good morning, good morning.
No doubt a critical one for that company. Alex,
you, how you doing? My financial advisor. I'm happy to see you.
over this morning, some interesting moves off the back of that.
Are you not?
Yeah, what's on your radar?
You know, a couple of guests
We all get cooked. This can be a lot worse, y'all, because like I was saying, you know, they hit that rejection on the market up here. So, like Swabby was saying yesterday, we can really go down a lot, y'all. You know, this is a government shutdown.
Unemployment rate, and we haven't gotten data in several months, but we've lost in 2 years
Yeah.
from March of 2022 a high job opening,
Yeah, the longest ever government shutdown.
more balance, where they're both around 4% as of August.
So while everybody's looking for calls,
Amazon
we should be looking for puts.
layoffs,
Shit.
painting a picture of a job market that seems to be
The
at an
VIX
inflection point.
going up like a motherfucker.
Without a floor underneath it of job openings and
So y'all know what that means for the market. If the VIX is going up, look at the VIX, looking bullish as hell. Bullish divergence like a mother freaker on the VIX.
Yeah, look, I mean, we're going to be hearing from a number of Fed speakers as well. I mean, Goolsby's already been...
Bullish divergence on the VIX. It's crazy.
William Barr as well. So maybe we'll get some more clarity on what they certainly think of the economy right now and certainly what happened in that meeting and how they see things moving forward with all of that in mind. Alex Coffey and Kevin Hinks, always appreciate it. Thanks so much for joining me today and breaking down your thoughts on these markets, which are looking a little bit...
Right here, this is a per $6 drop so far. Be careful, y'all. Protect y'all positions. Shit. Yeah, don't be buying shares right now while they're pulling back. Yeah, it is time to buy shares, but I would just say, wait till they get done selling off first. But you just want to buy shares and walk away. That's cool too. You can always dollar cost average into anything, I think. You're going to be straight. Give some of this stuff some time, you're going to be alright. Oh, I gotta look at Beyond Meats for real. Alright, never mind. It was right here on the scanner, so I feel like something might be happening. They still Beyond Meats is still under $2 though, and that's gonna get liquidated with everything else today. Okay, Beyond Meats at the bill went up a lot.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis.
Alright, we might be getting that bounce here shortly. This was the biggest, a big slope of support that it just broke. This is the one we bounced off of yesterday. Now they look like they're trying to break it. Let's see, they might be able to weak back into this. Oh. Hell no, they put all that shit back. Right up in here, like they finna stop right here for a bounce. This area right here. Right, let's see. It's getting a little bit lighter right here on the bulls. Might get a bounce right here, but this is getting scary.
Morning movers bring traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst call. Get your watch list ready. 8 a.m. Eastern. Morning movers only on Schwab Network.
What'd you say? Hey, how you doing this morning? You at work? Yeah. You had me hit those weights last night. Yeah. You know you made me pick up that weight last night. I picked that weight up before I went to bed though.
At Schwab, how I choose to invest is up to me.
I already felt good.
I can invest and trade on my own. Yes, and I help them manage some investments.
My body's feeling really good right now.
No can do. Get out of here. Where are you going? Schwab.
Yeah, I'm telling you, yeah. I already know, yeah, you're right.
A modern approach to wealth management.
Yeah, I go outside and boy, I look up at the sky, boy, I start smelling the boy. Yesterday was actually a really good day. It was like 80 degrees over here yesterday. And hell yeah. At 4 o'clock yesterday, it was the first thing I did. I turned my stream off. I went for a walk, a run. You know, so I say, like, everybody over here, all the white folks over here, everybody was outside running. I come outside, all the cats want to run up to me and stuff. Squirrels and birds want to come talk to me. I like going outside. Shit. I cleaned up outside. What y'all talking about? I told y'all, me and my landlord got into it. She tried to throw me out of here because somebody threw something on my door. So I cleaned that shit up yesterday. And that actually was a workout in its own too, because I was scrubbing the roof and shit. Bro, move with this hand. We trying to see the market go down.
NVIDIA and AMD. So what's in store for 2026? We'll have that conversation and plenty more on deck here from the Schwab Impact Conference. We'll have the latest in the bond market.
All right, well, I'm about to buy a put as soon as they break this, boy. Where's the next stop? I just drew these two yesterday. Look, I just drew these last night. Told y'all they was heading right there.
Here's a look at the market. So while you see the major averages down fractionally, basically a half percent or a quarter, 3/4 of a percent, we are still about 2% off record highs on the S&P 500. But
No, he ain't.
tech-heavy Nasdaq
No, he ain't, Swab.
down 1 full percentage.
We tricking people. We about to. They about to give all that back to another market maker. Watch what I tell you.
We've also had, the earnings.
You're gonna give the market to another market maker, boy.
Other earnings names
This is going right here. Looks like.
Lauren, and just to name a few. When you look at what's going on in futures, bonds,
So these are. All right, these are the two areas I'm watching.
Double points on every qualified stay. Life's a trip. Make the most of it at Best Buy.
Like, it has to be a dead count bounce somewhere. This is a horrible drop. This is almost a $10 drop on the market.
Is the Supreme Court hearing the challenges to the tariff?
And for some reason,
And there was some speculation maybe that could boost the market. You had
Okay.
Lucy saying today that he didn't necessarily think it was a good idea. Cautiously
Yeah.
further rate cut.
thought so far was
Down. I didn't have this
what it is.
with Kevin Green. He's in the know, watching the overall market. Joins me here at Schwab Impact. We've had a great couple of days so far. Kevin Green, good morning to you.
Good morning, Nicole. Yeah, we are seeing a little bit of pressure in the S&P 500, down about 0.6% as you're continuing to talk here. Technology is getting a lot more weaker, if you will. NVIDIA starting to slide.
What you said.
Also moving to the downside here. So we have a situation in a market that continues to gyrate around these levels. We were able to see a little bit of a recovery yesterday. We did see a little bit of a selling pressure going into the close yesterday, and that's exactly what's being followed up this morning. Now, there's a lot of headlines that are in the news. Tariff policy, kind of a curveball or a wild card there to see how it's actually going to pan out. If we do see tariffs actually taken off the table, are we going to see the equity markets actually sell that because of other aggressive actions that the White House could take in order to kind of mitigate some of that risk? And you also have this situation where we have NVIDIA earnings coming on deck. Maybe you are seeing this kind of selling pressure taking place as a lot of the news from these Mag 7 names are now being priced into the market.
I'm about to tell everybody about this VIX.
We're seeing the 19 VIX right now, getting close to around that.
This is like a cold 10 right now, boy. Y'all be careful.
Here, and I think the market just wants that new catalyst. And I'm not sure if NVIDIA is going to be that catalyst. We may also get some news around the government shutdown here today. After the elections, we did see that on Tuesday.
Yo, SheldronFrost here, man. This is the VIX. Look at the VIX going crazy. I don't know if this foolish divergence on the VIX, but y'all be careful. Watch y'all positions. Stay strong.
This morning, their
The best.
conference was it 10% or 40%? It was a big number. Do you know what the number
It was
was?
10% across several different airports.
They're going to be cutting the number of flights, and they were doing
Ooh.
comparisons to
What'd
past
you just say?
shutdowns, which were actually partial
XBX
shutdowns.
Y calls.
And so how grave of a story this really could become very quickly. And so
BXY.
they think that that may push lawmakers to get this thing through.
Yeah, it's going to be a very big pressure point, especially when you come to the holiday season. I mean, that's the real big moneymaker, not only for the airline companies themselves, but all the small and mid-sized businesses that are really relying on that holiday spending and that holiday travel. And so this is going to impact from rural communities to urban communities, and I think a lot of these representatives are probably going to be focusing on that moving forward, especially once again, we're done with the election cycle, so they have that kind of marker already put into place, and maybe we do see some form of a resolution that we kind of delay maybe this government shutdown, at least for now, try to figure out the healthcare policies and things of that nature. But I think that's going to be a really big story here moving forward. And the tariff policies, do we see them getting removed from the Supreme Court? That could be a possibility. The White House definitely has other avenues to impose those tariffs. I'm not sure how much of an impact the market's going to have around that decision. I think this is going to be a government shutdown story here moving forward.
Look, I think we don't know how the market might react. Will there be a knee-jerk reaction, at least to the upside, or will it come up off the lows if we get that news? There might be a sense of relief with that to have some clarity versus uncertainty. The market doesn't like uncertainty. But nobody knows how the market will react. When it comes to tech, and I do want to get to the Challenger labor numbers because the layoffs have been huge. Layoffs surged to the 20-year highs. So while we're not getting some of the data, we've been getting some soft data three big movers this weekend. Qualcomm out with its numbers. I mean, just one more final thought here on tech.
Yeah, so if we're looking at Qualcomm's numbers, they came in pretty decent. At the end of the day, they didn't beat both top bottom line. Guidance, for the most part, their commentary looked a little bit healthy here. I think this is more of a buy the rumor, sell the news event. They had one business unit that did actually miss the street's expectations, but a very small one. I think it was about $1.9 billion compared to, 10, a significant amount when you're looking at some of these other industries within their business line. So not that big of a mover here. Palantir, buy the rumor, sell the news type of an event. We have seen Alex Karp getting a little bit more aggressive when it comes to the media and his commentary. So I think we got to
commentary.
Yeah, so it's getting a little bit heavy there. And then the OpenAI news yesterday, I think it's gone under the radar here, but they're CFO kind of talking about the federal government providing a backstop for them in order for them to expand their data center investments and be able to create cheaper rates. I don't think that the market probably did not like that. I think that's another reason why NVIDIA kind of dropped to the downside here. But you're really company that's talking about a backstop for OpenAI in order to keep this boom going. And unfortunately,
I'm making this
the
short.
AI story is
I'm
driving
checking
around
my
0.7% of GDP growth right now. This is the only thing that's really growing our economy at a sustainable rate. You can see other areas faltering here. So let's see if that actually does come to fruition. But I think that's also providing maybe some of the selling pressure within the tech space just in general because of those comments.
And Tesla investor day. So we'll have Tesla to keep an eye there, folks. As far as what happened with Elon Musk saying, basically he really gave his rebuttal. That's a nice way to say it. To Solomon and Pitt, right, from Goldman Sachs and Morgan Stanley when they put out that cautionary tone. He, sort of briefly gave his rebuttal that that's not the case. In fact, he felt quite straight. That was the tone he gave us. When we look at the labor market here, we look at the challenger numbers, and the big picture
which
here
ones are they?
is the
Send them in a message.
and we haven't necessarily seen that for something like the ADP. We saw some strong hiring in larger companies. This one here, you had 153,000 in October, the highest since, let's see, 2003. So layoffs have surged to 20-year highs.
Yeah, so I think we need to balance this report out. Challenger is a very volatile data set, and they're around job announcements or jobs being cut that have been announced. It doesn't mean that we're actually going to see those follow through, and it doesn't mean that they actually have to be layoffs or those getting fired. It also could be attrition over time. So Walmart had an announcement about a month ago, 2 months ago, where they basically said, we're going to keep our headcount at the same level over the next 5 years. Now, obviously, not everybody's going to stay at the same company for 5 years, but they're going to, backfill just to what they need. Obviously, we had some other companies, UPS, kind of showing up in this report. So you're right, 153,000 that were announced. It was a 183% surge since September. You're looking at a 175% increase on a year-over-year basis. But this doesn't automatically translate to what the labor
I would kind of be
is
careful at
actually
this moment because
feel.
I don't know what the market's doing. I think
Challenge
everything is kind of falling at this very moment
unfortunately, it probably carries a little bit more weight because we do not have the government data.
of this government shutdown. That's what I'm
Probably
thinking.
putting this one in the background for now. It's concerning, but I'm not sure we can really hang our hat to say this is actually happening in the economy. Some of it maybe, but not the whole thing.
And we were due to get non-farm payrolls tomorrow. We won't get that. But what's interesting, too, is your point that you made about the layoffs. They're announcements. They're not actually laid off yet. Sometimes they also aren't they also counting jobs that they were putting out there and then pulling them off? We saw that. I saw that with some of the story stocks. When they say we're going to do X number, let's say they say 10,000.
Yeah, send me a
jobs that were listed. They're just pulling those off.
Send me a list of those.
Right, exactly. And these are announcements that they are looking at their data set. So you can announce, there's companies that announce a lot of things. Right. They can announce a lot of things, and sometimes, and most of the times, they don't come to fruition. And a lot of those announcements are looking at a longer term time frame, 5 years, 10 years, or even 2 years from now, where we are really looking at a data set that's focused on a month to month. So once again, is it a trend? I think we are starting to see a trend. Is it something
we
that
might
is
be giving
really,
some
really
time,
concerning
for real.
right now? I don't think it's really being supported by any other data set. The aggressiveness of this number, right? The trend might still be going in the wrong direction, but the aggressiveness of this number, you're talking about 175% on a year-over-year basis. We're not seeing that in the
You put it into some perspective. So take this one with a grain of salt. Also, last but not least, we look at the commodity space. I saw oil and gold not moving too much, less than 1%. I did see Bitcoin at 103,000, dip below 100,000 this week after having been over 100,000
That's how they trick you into saying stuff. Well,
You know, Bitcoin folks have been jostled around a bit of late. Some thoughts on commodities?
I love all y'all.
Bitcoin is hitting that structural
Look at
base of
Tesla getting them down.
100,000. We're seeing some buyers really step in. We're trading at around 102,000 right now. If you're looking at the futures
I
contracts,
can't hear shit with these headphones on my head.
and it's sustained below that level for about a week or so. You get a little bit concerned that it comes down to around 80, 85,000 or so. Crude oil, we did see a little bit of a sell-off here. Obviously, we have supply concerns in the market. We have a lot of inventory that's on water right now, and the demand story is really not that great. Nat gas moving to the upside.
She said she took her money out of SoFi.
That everybody loves to talk about is the
I've been holding SoFi for a minute.
in the background, Nicole, we are starting to see China
SoFi just keep chopping in this range right here.
Yesterday for weeks. And sorghum, wheat and sorghum, so we are starting to see soybeans being purchased, wheat, so in the background, China's holding their own, maybe not as aggressively as we would like to see, but they are making some steps there, and if we still see some positive signs, we could see maybe some more favorability when it comes to these tariffs over the next couple months.
Kevin Green, I enjoyed our conversations here at Impact, Schwab Impact Conference. We have, a whole day filled.
This little stock work is going. I'm not messing with that at all. My bad, y'all. I'm rolling.
Get a look at the
I'm almost
major
done.
market averages, the outlook for 2026. We'll have plenty of folks.
Yeah, everything is in the red right now, y'all.
Financial research.
Every single thing is
Join us
done
morning
fell.
trade live. We'll be right back. I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at Schwab Network.
What's up, Carl Nation? It's your number one
Huh?
broker with the best full-service wealth management skills in the
You say who I'm talking to?
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, folks to invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention Schwab is a team of specialists with taxes, insurance, and estate planning, all with low fees.
We're
Right.
experiencing technical difficulties. Carl.
I already had told y'all that.
A modern approach to wealth management. No politics, no spin. Just the market. Close and the open. 24/7, any screen, anywhere at SheldronFrost.com.
Whether you're an experienced investor or just getting started, Schwab offers a webcast that's right for you. Using charts when analyzing the stock, our technical
Y'all, be careful, y'all. Like,
breaks down
tech and everything is falling. I don't know what is going on.
moving averages, oscillators, and much
Like, investing is cool. Like, they are even a lot of this stuff out.
Welcome to an education coach.
But if they start breaking, like, all this stuff,
In live or on demand. Head over to schwab.com/coaching and start learning today.
yeah, Goldman Sachs said we pulling everything back, right? So we could have, like, maybe like a 20% drop,
Time market moves.
at least, on the market.
Trade ready insights.
He said F Goldman Sachs.
On LinkedIn.
We could have like a 20% drop. This is like the sloping support that they don't broke out of. Like, they literally can start coming back down, y'all. Be careful.
Closing bell. We've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on
They
their
wicked right down past the sloping supports
Live
and
analysis,
everything.
breaking news, and sharp trade ideas minute by minute.
With shows built for
You gotta be careful,
break it all
boy.
down in real time with speed.
Everybody these puts are printing. I know that much.
Important things is you're making a play in a risk-defined way here going into earnings. So that would be a further downside area to watch.
These puts are printing
Full data, best in traders,
right here.
financial journalists, streaming live.
Schwab Network. Streaming
Oh, where is this even coming from?
any screen, anywhere, free. SchwabNetwork.com.
Like, I don't even see like this is the only bounce we get. They ain't even stopped going down yet. This, if anything, this almost looks like bearish divergence, y'all. This will be
I can invest and trade on my own.
This is
Let's
the
move on, shall
bear
we?
No can
pole.
do.
Look at
Bear is down version.
Where are you going?
Shop.
I gotta look at my positions, make sure I'm not getting liquidated, boy.
Opportunities
The market
don't
give
stop
it
when
and
the
they
market
take
day
it.
ends. So neither do we. Schwab gives you round-the-clock access to over
Let me look
100
at
of the most
the
popular
positions.
stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
And we are on our way. We are live at the Schwab Impact Conference here on Schwab Network. It's a pleasure to be here. We've had so many great guests and taking a look at the big picture. Happy to have two esteemed guests with me here today. Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial
Alright,
Research,
Fox
and
is a
Mike
good one.
Johnson,
Fox is gonna be
Managing
okay.
Director, Legislative and Regulatory Affairs for Charles Schwab. Thank you both
Fox is
for
gonna be
being
alright.
with
I
us
can already
here
tell you
today.
with
We
that
have so many
right now.
conversations
They
to
gonna weather
have.
this storm.
Today, this week, what are people asking you, Kathy, when they are taking a look at the current environment?
Fox Corporation.
I think they're really questioning the direction of interest rates.
You don't know
So
Fox?
we have, yield bouncing around. We've had questions about
No,
is the
Fox
Fed
the
going to cut
corporation.
some more? Is the Fed not going to cut some more? Our takeaway is no more rate
Yeah,
cuts
the news
this
people.
year because the Fed's made it pretty clear. The Hawks have made it pretty clear that they're concerned about inflation and they want to wait and get some data, which we
This
have
stock is
none
straight.
of right now, before making another rate
All
cut.
all the things.
So I think we wait until next year on that. And in terms
Who?
of bond yields, the 10 years just bouncing around in this range, I think that continues to be the case
I don't
until
know why
we
you
have
sound
some
funny.
evidence
I
that
think you said
inflation's
that.
actually going to come down. Right now, it's just not there.
Bouncing around for real.
Hello.
I mean, for example,
Oh,
this
Dallas.
past week I saw it go below 4. I think it was at 398. I saw it up to 414. Now those may not be the lows and the highs, but I
Say
saw
ticker.
both with my own eyes. We've seen this, and to your point, in the last Federal Open Market Committee meeting, we had Stephen Myron, who votes for the 50 basis points. He knew that was coming, but Schmidt's keeping it flat really brought a lot of attention to maybe what some of the committee members are saying, which is what you're looking at. And Goolsby today put out a statement too, a cautionary tone on cutting again during the government shutdown. Mike, what are some of your thoughts this morning?
Well, we're in day, what are we, 37, I think, of the day of the government shutdown.
It's actually like it's gonna break out.
To see whether we get
Where
any
it's
kind
at.
of
Fox
resolution.
does.
We've been stuck in sort of an endless loop on the shutdown now for more than a month. So, I do think the pressures are mounting. We not only have federal workers are going to miss another paycheck at the end of this week. We have the food
That's
stamp
what I'm saying,
benefits,
like,
SNAP benefits that are all in limbo.
This can't be happening.
But to me, the biggest pressure point is
The
airline
people
travel. And we
is
saw
losing
the
money like
announcement,
cats.
from the transportation secretary that
They gonna pull that money out the market.
10% starting tomorrow at
Right.
40 airports. I will tell
The
you,
people ain't getting their
the
paychecks.
air travel
They gonna pull that money out the market.
are going to be the thing that actually pushed the shutdown to end. So we'll see.
And it'll make the market fall.
Shutdown, and so now this really kicks things into gear. And maybe, do you have a prediction when the government how quickly this government shutdown can end?
Yeah, so really interesting. Watch today, because today the Senate is supposed to be on recess next week. Long plan, they were not going to be in session next week. There's a bunch of meetings going on today in Washington, and if they end up canceling that recess, meaning that the Senate is going to stay in session, I think that's a clear sign that a deal is imminent. And I would not be surprised if that happens.
Kathy, whatever you say.
Look, these
Whatever you talking to, Kathy.
they fly everywhere themselves, so they're going to be impacted by this.
Kathy.
Constituents' frustration with the air travel laws, I think, is going to really grow. So I'm looking in the next 48 hours to see whether there's significant movement.
I'm going to ask you about Nancy Pelosi's retirement announcement today, too. I just wanted to get a thought on that. But Kathy, when we look at fixed income investing and some advice to folks, you're looking at credit quality, duration. What are you advising folks at this time?
Yeah, we have pretty much stuck with an up in credit quality,
All right,
intermediate term
so in an
duration
event
message.
of biotech
And
falling
the reason
a little bit
is
lower,
up in credit quality is you don't get a
just
lot
load
of
the
extra
boat
yield
up.
for taking credit risk
Okay.
right now. And
This
there
is
are
historically
signs
where
of
it's
parts of
where
the
it bounced
economy
at.
slowing down, which which means we'll probably see those credit spreads widen
This is the whole
at
chart
least a
for
little bit. So we would prefer the investment grade area rather than
right
high
here.
yield or the leverage loan market.
That's your
Even though
support.
they haven't
All
moved
this is
that
support.
much, we're concerned that there's just too much risk.
This is what he fell from.
And on
right here.
duration, we like intermediate term, which is like 5 to 10 year average duration. It avoids the reinvestment risk of staying too short if rates come down. It avoids some of the volatility at the long end for all the government
Man, this
issues
rate
that
is
are going
beautiful,
on,
actually.
rising deficits, the uncertainty about inflation, etc.
All right, this
So
is
we're
decent
kind of
right now.
trying to be middle of the road.
And, you know, the
This is
economy
where almost
such
where you
a
should be
big
loading the
story
boat
here,
up.
you know, how
By the
consumers will
hundreds.
behave. What will they do with housing?
So
And
this,
those
when
rates
this
come
pop
into
up,
everything from housing to Carlos'
and go up towards
to
10,
everything that we do, how these banks
20,
behave. You know, I wanted
that's
to
gonna
get
be a
your
lot of
thoughts too
profit.
on the
All right,
economy
these two
and
are
also
good.
this big news on Nancy Pelosi. I don't know, is it big news when she says she's going to
While the market is falling,
Yeah, you know, I don't know that it's a big news.
some stuff
I
is
think
bullet.
it's sort of surprising that she stayed on.
That's what we
for
be
the whole
doing. We
time
be finding
after
some bullet
she
stuff
stepped
still.
down from being Speaker of the House.
Why does it matter? Sorry to interrupt you, but I should spin it forward to why it matters to investors.
Well,
Nah, they hard now, right?
Thing. I think the interesting change here
To
is
me,
the
it ain't hard.
generational change that sort of represents. We saw in the election on Tuesday night where younger
They
members of
hard.
the Democratic Party won
The market
big
liquidates
elections,
all
New
of
Jersey,
it.
Virginia, New York City.
All right, this is good too right now. They finna
I
bounce.
think there's a generational change going on for the Democrats. But you know, for me, the biggest thing to watch in the post-election and all of that is for investors is, you know, the government shutdown is it's gonna end at some point, whether it's next week or the week after. I think it's gonna end by
Okay, right here.
We'll start to get data again for
On the weekly.
the economy, which I think is going to be really important, not only for the Fed, but for investors who want to know what's going on in the economy. So I think that'll start to normalize again in the
pull back
coming weeks,
already.
and you know, we'll see how it all plays out.
And just a final thought on the economy. I mean, what's the big picture here? We're getting soft data. We got ADP, we got Challenger. We've been getting pieces of inflation. We got the ISM services. A thought on the economy, either one of you?
I think it's two-tier.
All right, trivia.
You have
This stock
wealthy
is trying to
people
go right now.
who account
I don't know
for,
what's going on.
10% of the population accounts for over half of consumption. So well-to-do people have gains in the stock market, and their jobs are good, and they're doing
Looking for a
fine,
retest
and
right
they're
here.
kind of holding up the economy. When you go to the
And a
lower
breakout
part of
at the
income
same
spectrum,
time.
you're seeing more stress. So you're seeing the delinquencies on car loans, on credit cards, etc. So two-tier right now, it averages out to a pretty solid growth rate, but we really need to keep an eye on probably the bottom rung to
Find
see
these
how
on
that's
the baby
deteriorating
stocks
if
too.
that continues.
And other
Support
big
and
picture thoughts
resistance.
that you want to add?
All day.
Obviously, the
Right
tariff
there.
case is going to be really interesting to see how it plays out.
You
So
see the
we saw
ranges
yesterday
right
the
here.
Supreme Court considering whether the bulk of the president's tariff policy is constitutional. It certainly seemed like there was
What'd
a
you
lot of
say?
skepticism on the court. If the tariffs get thrown out,
Yeah,
the president
support
does have other
resistance.
mechanisms to impose tariffs, but those are slower moving. And the potential of refunds, something
Getting a
in
pullback
the
for
$100
this
billion
resistance, but
range of refunds, that'll be big news
they're gonna
for
bounce
companies.
somewhere.
The question is timing. When will the Supreme Court make that decision? We're hearing as early December, but the court has no timeline.
This is
for
a
anything.
God candle right here.
So,
This is a
after the holidays,
bull flag right here.
Thanksgiving
So
holiday,
they gonna go
we'll see a
higher.
decision
They're
there,
gonna find
and
support
obviously
somewhere.
That'll be huge for
Right
companies
right
and for the
here.
economy.
And when we were talking, I breathed a sigh of relief when we started to say when we will get our data, because tomorrow, for example, we would be getting non-farm
They're
payrolls.
gonna find it
Very
somewhere around here
arguably
and
one of
bounce.
the most important pieces of economic
go
data
higher.
that we really come through.
See, look,
It's great
it's not
to
right
see
here.
you.
They might just
Happy
decide to
shows,
bounce right
milestones,
there.
And thank you for being with us
It's
here
an area.
on Schwab Network at the Schwab Impact Conference. Great to have you. Really appreciate it. All right, folks,
All these
coming
is
up,
good.
deep dive into tech, which has been under pressure, under the microscope this week. James Demmer will join us, and why he thinks any tech bubble has a long way to go before actually popping. No explain. Morning Trade Live. We'll be right back.
All right, those stocks are unfazed by the market's shenanigans.
Diane King Hall on the floor of the New
All right,
York
so look,
Stock
check this
Exchange.
out.
When markets react, we are live with analysis that
And look at
matters.
the MACD.
Watch
What the
now,
heck?
Only on SchwabNetwork.com.
Yeah,
First day, so sometimes, you know,
Try it again.
you could have done better. Same goes for where you invest.
yeah.
Level up and invest smarter with Sharpen.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex.
Yeah. I
Plus,
would
get
appreciate that.
24/7 live
You
help
send that.
and access
I'll
to
get right on
your
that.
phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close. Here on the floor, I bring you real-time sentiment from traders
Yes, sir.
driving the action. And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings. Live coverage from the close every single day. This is Market on Close, live weekdays, 3 p.m. Eastern, only on Schwab Network.
Somebody,
Dad, I have a question for you. Sure. When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torches were passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college
I gotta take my
education.
food on the stove, y'all. I'm
Someday it'll
burning
be
that,
different.
get liquidated. I'm doing everything right now.
What's up, Call Nation? Is your number one broker with the
Hold
best
on.
full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it.
Not to mention Schwab is a top specialist for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical
Schwab, a modern approach to wealth management.
Welcome back. Morning Trade Live from the Federalities. We are live in Denver, Colorado, at the Colorado Convention Center. This is the Schwab Impact Conference. 5,000 people. Great conversations happening here. James Deverett is joining me now. Founder, Chief Investment Officer, Main Street Research. And this is a conversation because people are talking to RAs, wealth managers, asset managers, and talking, of course, about technology. That's your realm. You don't think there's a tech bubble that's ready to burst just yet?
We don't, and this is a room full of a lot of investment opinions, right? With all these advisors at Impact. Great to see you, Nicole. Yeah, we think that there is a bubble inflating, but it's got a long way to inflate. So all this conversation of about it's about to pop, we don't think it's there yet.
You gave me a hat that said Dow 100,000. Dow 100,000. How would you like that, folks? I mean, what gets us there?
Well, you know,
Do we actually hit that?
I think we do, and I think it's sooner than people expect. I think 2030, right? So that's about 5 years from now. And I think investors need to remember, we're only 2.5 years into this business cycle, this bull market. They usually last 7 to 9 years. So we got a long runway. The big question is, can valuations sort of keep up with the growth rates? That's important. And also let the air out of the bubble once in a while so it can continue to inflate. And I think that's where there's also some risk today.
And that's what's happening this week, right? Because we saw NVIDIA, Palantir, AMD, Qualcomm, who came out with some numbers. So you're okay with a little bit of a pullback, even 10% or more? I mean, that's part of the climb?
We'd even say it's overdue. You know, you've got some headwinds coming towards us this quarter. The Fed probably not going to cut. I think the market would like them to. You got the government shutdown going on longer than expected. You know, earnings come out, and when they beat, they're not as celebrated. Palantir was a good example, which you just brought up. Or AMD misses, and they really took the stock to the woodshed.
What do you think of Alex Karp's rebuttal to
David Solomon and Ted Pick when they were sort of putting out a cautionary tone and actually named Palantir at one point. He seemed much more positive.
That was entertaining to watch. I mean, Alex Karp is a brilliant guy, and I think he's right now. He's right. I think there will be a time where the shorts will have the opportunity to really make some money. Again, I don't think that's for years. I think the AI cycle is still very early in its evolution.
Jensen Huang was quoted as saying that the AI race, that China will win it because, they've had obviously the limitations on what NVIDIA chips going to China. I think he sort of dialed it back. I heard, I didn't confirm all this, but that he dialed it back when he put something on social media. But his concern is China wins the AI race. What do you think about NVIDIA, Jensen Huang, what's going on in the AI arms race?
Well, there's no question that the spending in the AI, it continues to exceed all expectations. And we think that will continue. It is an arms race, and if you're a Meta or a Google, you need to stay competitive. You've got to spend more than your competitors. And that's exactly what makes these technological sort of revolutions have so much leg. And we're still early. And I think Jensen's has a very good point. We need to do a lot of business with China, in China, and those regulations, those tariffs, we need to make a better deal.
So your, goals, when you look at some of the strategy you had 100,000 on the Dow, S&P year-end target 7,100, 2026 target 8,100. These tech names, 10, 20, 30% room to the upside in the year or two, three ahead?
Yeah, I think that people think they've gone too far, the bubble's about to burst. But keep in mind, a lot of these stocks that are the Mag 7, that are driving indexes, are trading at PE multiples that are still less than their growth rates.
Do you buy on dips?
You buy them on the dips, and I think we might have a dip. I would go after the Mag 7 on a dip, and I think investors should be ready. Those declines in a normal correction are going to be startling. They're going to fall 10, 15, 20%. You want to buy those if you don't own them. I don't think I'd sell ahead of it, but as you know, we're a global investor. You want to also, outside of that, have foreign stocks to have a better valuation.
Tell me about that.
Well, Cole, valuations outside the U.S. are about half, right? PE ratios are 15 versus 23. There's a lot of fiscal spending overseas since the U.S. withdrew. And a lot of investors don't realize this, but stocks outside the U.S. are up 28% this year versus 14 for the S&P. So that's already begun. Investors in general are underinvested in foreign stocks. They've neglected them for years. So we think there's going to be a mad rush in 2026 towards foreign stocks.
So the idea here is to take advantage of the dips. And tech still is the leader. Is that the driver? Is the catalyst some of the circular spending? I mean, there was some concern about OpenAI looking to the governments for some backing, but we've seen a lot of the circular funding happening. What are your thoughts on that? I mean, billions and billions and billions going around in a circle. It's not like the old days where venture capitalists would give money and say, I expect return on my investment. This is, I'll give you X billion, and it seems so theoretical. I don't know.
It is not the healthiest thing, and you're seeing the trend of that just beginning. In the dot-com bubble, we saw that trend to excessive levels. Right now, it's really just beginning to trend upward. So I don't think investors should use that as, the bubble's about to pop, but that is a symptom that the bubble is being inflated. Again, if we have a normal correction, that will bring that bubble pressure down and allow us to go another leg up. And again, I think this is a number of years ahead.
Yeah, and James, look at some of the other sectors. Are they very interesting to you in addition to technology?
Yeah, we're big fans of financials in the United States, the deregulation, the possible Fed rate campaign cutting is really making those stocks rally big. That's the JP Morgans, the whole sector of financials in the U.S. And then outside the U.S., you can almost invest in any sector. If you look at foreign markets, they're broadly rising. You don't just have to own the AI stocks.
Yeah, all right. James Demmer, great to see you. Always love having you on. Founder and Chief Investment Officer of Main Street Research. Thank you, James Demmer. Coming up, folks, we're going to take a look at some of the sectors on the move. I mean, we've talked a lot about tech being under pressure, but why some folks are buying the dips. We'll have a lot more for your portfolio, how to really also protect on the downside when there's...
All right, sorry, y'all. I had a phone call.
Live from Schwab
back. We'll be right back.
My landlord. I might have to lose my place here, but I don't know what's going on. It's always something. My landlord talking about I gotta have 50% of custody or I'm gonna lose my place. She said 51%. Yeah, just like I was thinking with the market, they might reject off something and come lower. Like you see, they already like a big bear flag. I was in the kitchen eating, I didn't grab my water. I'm ready though. I'm here, one man business. Good morning, y'all.
Morning movers, be the first to find out what's shaping early market action.
All right.
Options corner, futures focused.
Everything should be pulling back. I'm not gonna lie to y'all.
Covers it all. Grab your coffee and tune in every trading day at 8 a.m.
Everything should be getting a big pullback.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. So glad you're with us. We are live here at the Schwab Impact Conference today at the Colorado Convention Center. Taking a look at some of the sectors on the move today, and so we'll bring in Alex Coffey joining me. Looking at some of the takeaways.
I still got a lot of time on so far, but I had to take some
and a lack of economic data. Some of your big picture thoughts, Alex.
Yeah, good morning, Nicole.
take a couple of them contracts off.
Watching all the interviews from Impact.
But they try to liquidate me. Okay, Lyft is still doing good. Lyft is gonna go.
10 minutes or so, you started to see the S&P stage a bit of a comeback. We went from about 40% of the components higher on the day to about 45%. And then in just the last few minutes, it's cratered to 38% of the names higher and back towards session lows. I oftentimes say, look at the Magnificent Seven. But before we do that, I wanted to talk about some of the sectors that are weak today too, which is IT and consumer discretionary. Arguably the two most important, Nicole. So you start looking at where the weakness is, the broad nature of the weakness. I'm not surprised that we're now down almost 1%.
All right, yeah, we look at the heat map there. We see a lot of the Mag 7 names that have been under the microscope this week. Concerns about valuation and many others as well. Just a quick thought on Mag 7.
Man, what is going on? Well, I might as well put my music back on, boy. What is going on? That's why I don't try new stuff.
See this on a daily basis, but I went back and checked.
Might as well put my stuff on and deal with the consequence.
The Magnificent 7 has a 0.98.
Yo, let me rock out.
The S&P 500.
It's y'all stuff anyway.
Confirming kind of what we say on a daily basis, as the Magnificent 7 stocks go, so goes the market. Well, mathematically, that's been true over the last 3 months. If you were to index that group of 7 today,
if you late on these puts.
5% collectively.
Oh, hold on, give me a second. You gotta find where the money's at. They got me messed up. I gotta get some of this bread my own stuff. Alright, I'm about to, hold on. careful. No FOMO entries into no puts, but the trend is definitely going down. Okay, they're breaking down some more. Go ahead and give me a put ski. You got me messed up. We gotta join this. We gotta hedge our account with a put somewhere, bro.
About the concept of diversification, looking a little bit outside of some of the concentrated areas. So, while on one hand, a lot of these stocks do have, in some cases, twice the margins, twice the profitability, they're doing quite well, valuations are a little bit stretched. And so we do want to start to take a look at things like, broader diversified portfolios. We do see some of those interest rate sensitive areas like small caps and REITs.
All right, we might get a little bounce here.
Make a little bit of a
around
comeback.
support.
And so, good opportunity to reinforce with clients. Diversification, it's downside protection. It's not lack of conviction.
Yeah, let's talk more about that because sometimes people have an over-concentration in technology, particularly because that runs up so fast. And now your portfolio may have too much technology in it. Because of the
So if anything, on the put side,
when you talk about some of
you want to wait for a bounce.
You mentioned real estate. Tell me about that. I mean, some of these other sectors that may be a good way to protect on the downside and have. It's important to be diversified, right?
Yeah, absolutely. Yeah, particularly again, some of those interest rate sensitive areas. Small caps in particular have been depressed for a number of years. U.S. small caps, and so we've started to see again a little bit of a comeback. A little bit of a low quality rally, so something to keep an eye on. We definitely like to stay
might be a bounce
quality,
right though.
keep an eye on that. Whether that's through active management and high quality small caps. Also too, looking at things like direct indexing, where you own, the underlying stocks in an index, and then you can remove the stocks that you have that concentrated position in. So thereby you get a little bit of diversification. Also fundamental index funds, for example, that re-weight away from some of the market cap, high momentum names that you get in the concentrated portfolios.
Direct indexing and explaining to folks some of those strategies because it comes on like a lot.
These might be the stocks you need to trade right
direct
now.
indexing, for example, was something that was for a higher wealth part, and now more people are doing this. And people are always chasing yield, and they're always looking for tax efficient ways to invest, right? Tell me a little bit about that.
Yeah, certainly direct indexing, because it allows that direct ownership of the underlying stocks, you can then take advantage of some tax loss
broad space, when you're looking at everything, right? Folks want to be tax efficient. Isn't that a big part of the question they ask you?
100%. I think if not a day goes by, we don't get questions about
Bro, they're actually trading this stock right here. They're trading this baby stock.
Through, direct indexing, which allows for that tax loss harvesting component. And it's also a great reminder with the bond market too. We think about yield, and we always see these sort of headline yield numbers, but so important to remember that after.
I had thousands of this little baby stock, and I sold it too early. I ain't gonna lie.
Tax bracket where a municipal bond might make more sense, even though
I moved my liquidity to South Beach.
That tax conversation.
I missed out on all of that.
You're reminding me of my dad, who was a very conservative investor, and muni bonds were in his conversations. Dividend paying, stocks were always part of this conversation. You talk about the total return approach versus income generating assets, like dividend stocks, like maybe some other ideas. Maybe, slow and steady wins the race sometimes.
Yeah. Dividend stocks have had a tough time with the Magnificent Seven, just from a performance perspective. But to your point, and a lot of investors love the steady stream of income you get from dividend-paying stocks. There's an element of predictability to it, sustainability. The great thing is that, for example, if you do own some of the concentrated stocks, like the total return stocks, a little more growth-oriented, if
some
say, for example,
opportunities
the market
are
is down, you can then rely on the cash flow from those dividends, from that bond income you're getting to
keep you invested and not risk potentially selling out of all of those, growth
It's
stocks.
great to speak with you today. Really, people need to diversify, make sure they're not overly concentrated in one area. But it's been an exciting run for 3 years, that's for sure. Thank you so much for being with us, Inga Rockwald, Senior Portfolio Strategist.
Look at that pop-in rejection.
Asset Management. All right, folks, keep it right here, live from the Schwab Impact Conference, and we'll take a closer look at some of the expansion into credit markets and future growth. We'll have much more for you. We are live here in Denver. Quick break, Morning Trade Live, and we'll be right back.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
Man, that's why I got out of Congo.
For this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you.
ID pointing
If you're a
down.
long-term investor, our investing webcast series breaks down different investing styles, including growth, value, income, and more.
This is a rough day.
Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Bruh, if I see them break this, I'm going. I'm gonna put
Real-time access,
right now.
data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com. Welcome back to Morning Trade Live. I'm Nicole Petalides. Joining me right now, special guest Chris Malia is with us, Managing Director, Co-Head of Global Asset-Based Finance at KKR. Thank you for being here. So tell me some of your thoughts and conversations that you're having. We were just talking about some of the trends, and this is a record amount of folks, probably 5,000 people. What are some of the conversations you've been having?
Yes. So generally at all of these conferences, private equity, assets that have a lot of upside, generally take the spotlight. I think for the first time in a long time, folks want to speak about fixed income, about credit products, about private investment grade, private high yields in general. So we've had a lot of conversations ranging from asset-based finance, direct lending, structured solutions, and it's really, I think, a prime time now for structured finance.
I mean, private equity is always been exciting. I mean, and we've seen people going to private equity over the last few years. And I know I had a guest on who was talking about the market going higher in private equity. But I mean, what's the future here for you and your business? What do you see?
Yeah. So it's really interesting because everybody is now speaking about private asset-based finance and private credit. The reality is these sectors, these asset classes have been around for decades. Right? Mortgage-backed finance has been around since the 80s. The question really comes up, why are people talking about it now? And I think there's probably maybe two main reasons for that. One is that, thinking about what happened over the past 5 years or so, COVID, 500 basis points of rate rises, a lot of these origination companies that create mortgage loans, auto loans, equipment loans, they really need the capital markets to be efficient, to be up and running. And so when they're not, they need somebody to step in and provide capital. That's where private capital steps in.
I gotta call my lawyer here in a second. Tell him my
always seems to be of interest
landlord
to
was saying.
particularly some of the wealthiest investors were going that route.
right? I mean, do you think they'll continue to do that in the future?
I think definitively, private equity will remain an interesting asset class for wealthy investors. But I think when we look at portfolios, we look at a very complementary, broad-based portfolio that can withstand a downside stress. From our perspective, asset-based finance, different forms of private credit really have a place in the portfolio, not just as a trade right now, but as a longer-term solution.
So what's on your agenda? Like, what excites you now? Because you talked about, I mean, COVID was something else, right? We have this crazy government shutdown right now, and markets that have run up. We're 3 years into a bull market. What's on your agenda going forward? I mean, when we think about driving the expansion for you and your business, what are you focused on?
Yes, that's a great question. So from our perspective, one of the things that we have a very hard time predicting in general, especially as a credit investor, is what the world will look like in 5-10 years from now. So a lot of this corporate type risk, which is more corporate credit in nature, doesn't amortize, and there's some refinance risk on the back end of it. Within structured finance, within asset-based finance, you're generally owning exposure to pools of mortgage loans, pools of auto loans. These are amortizing assets. They de-lever over time, and they've been through cycles. They've been through the GFC. They've been through periods of stress.
Crisis, right? Yeah.
Right. So as a result of that, you really can underwrite, hey, how would this asset class behave in a downside environment?
And it sort of protects you, right? Doesn't it really diversify a portfolio? How so?
That's spot on. So tons of downside protection. Number one, across asset-based finance, you're dealing with things ranging from residential to consumer, commercial, infrastructure, hard assets, aviation. So you've got broad-based sector diversification, but then within each of those segments themselves, when you're involved in a segment of the market, you're generally backed by dozens, hundreds, even thousands of underlying assets that are all uncorrelated to the corporate credit market.
I also feel as if things have moved along very quickly over the last decade, whether it's technology or the way the products are available, or strategies, maybe things being more accessible to more folks. We've seen a lot of that. The younger investors are more interested, more educated on investing. I mean, when you think of traditional ways that this used to be, traditional private credit, I mean, now, what are some of the differences that could drive us forward?
Yeah, it's interesting. Some people often say decades happen in weeks, and it's really felt like that.
That's true.
Over the past couple of years. So from our perspective, what are we really looking to create? It's a portfolio that withstands downside risk, that's diversified, that's uncorrelated, and that's, there's exposure that the folks can get both at an institutional level, but even beyond that. And that's, I think, what the general market's working on right now.
Do people have great concerns? I mean, why is everybody talking about 1929 and, the tech bubble bursting? And I mean, are you hearing a lot of that? Is that a concern of yours?
Yeah, so I would separate the equity markets from the credit markets from the perspective that on the equity side, certainly a lot of, larger multiples, potentially in some sectors, there's a little bit of froth. On the debt side, where are we focused? We're focused on asset classes that we can underwrite through a very stressful period where we have very granular data and we're modeling it. We're looking at prepayments, default, loss severity data that we can say, hey, in a standard deviation stress, what does this look like? So definitively there are sectors, maybe data center comes to mind, where there's assumptions that are being made that you need to have a lot of conviction, maybe even on the equity side more than the debt side. Then there are things like financing pools of equipment loans that are strategic to businesses. Auto loans, people need to drive to work. Homes, people need to live in a home, all of which form the basis of asset-based finance.
Yeah, and when you look at the debt on those balance sheets, which kinds of companies may fare better over 5 years or 10 years. You mentioned some real, almost like small town type of things, right? I mean, you don't need to think about some, huge data center. You're talking about equipment and autos and things like that. A final quick thought, Chris, it's great to speak with you.
Fantastic. Yeah, so from our perspective, I think one of the things that really differentiates structured finance maybe from some other asset classes is that it is a bankruptcy remote asset class, which means you don't have exposure to the corporate parents, you have exposure to the assets. So even if the corporate goes bankrupt, as long as you've got a borrower who's making payments, staying in the home, that really creates the lack of correlation to a lot of other segments of the market.
Chris, it's great to speak with you. Thank you so much. A nice different perspective from a lot of our other conversations. So really informative. Chris Malia, Managing Director, Co-Head of Global Asset-Based Finance at KKR. Chris Malia, thank you. All right, friends, keep it right here. We're so glad you're with us here on Morning Trade Live, Schwab Network. We've got you covered from the Schwab Impact Conference with a slew of guests throughout this day. So glad you're with me. I'm Nicole Petalides. I'll certainly see you at 2 p.m. for the Watch List Eastern Time. Have a great day. Keep it here on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Good morning. We're 90 minutes into the trading day, and welcome to Trading 360. I'm Marley Caden, coming to you live from our Chicago headquarters. Here's what we have coming up for you in today's show. In our 360 Spotlight, we'll be joined by the president and CEO of Elanco Animal Health, fresh off of their earnings that topped estimates and their guidance that was raised for the full year. Our disruptor today is DraftKings after it announced a new partnership to make it the exclusive sportsbook and odds provider for ESPN. Then in our 360 round, we'll check in on Qualcomm as shares are slightly lower after a double beat on earnings and the company saying it's in discussions with a hyperscaler customer about potentially using its AI data center chips. We'll get to all of that and more shortly, but let's see where the markets stand this
Man,
morning
this
as we
oil
are
was
into our
nothing,
trading
boy.
day a bit now. A lot of red across the board. The S&P down about 1% right now at 67.29.15. The Nasdaq trading down more than 1.5%, 25,196.
Everybody be
Over
trying to
2
out
right
talk
now.
you and
As for the
stuff.
Dow trading 0.8 lower, 46,927, and the Russell 2000 trading down almost 1.5% at 2430.28. Checking in with the 10-year, which we saw spike to almost 416 yesterday. If we can populate that screen here, which
Oh,
we
you're
frozen
crazy.
us, I'll just look over here on the big board. There we go. We're lower now. We're at 410 right now on the 10-year, down about 1% and a third. On the dollar here, trading 0.4 lower, 99.67, falling below that $100 level we saw yesterday. Gold trading at 39.91, almost unchanged. Crude oil at 59.19 a barrel, and Bitcoin down about 1% and a third right now, 1% and 3 quarters right now at 102,335, but still above that 100,000 threshold we saw it dip below earlier this week. Do want to move on to one of our top movers today, bringing our first guest, Alex Coffey, joining us, co-host of Next Gen Investing and our senior equities market contributor here on Schwab Network, to talk about Datadog, a company I think a lot of people are maybe not familiar with, but rallying to levels it hasn't seen in years off of its earnings report.
Yeah, don't sleep on this one today, up over 20%. Massive, massive jump post earnings. And you look through the report, makes sense why, Marley, up 28% year over year in revenue, coming in at $885 million, way ahead of estimates on that metric. Adjusted EPS came in at 55 cents, also ahead of both last year and the consensus estimates. Adjusted operating margin did come down, but was still better than expected, and that led to free cash flow topping $214 million, which is up 5%, way ahead of the $165 million that was expected. Big piece of this is that they now have
My bad, y'all.
4,060
Yeah, I had to talk
customers
to my lawyer
generating
for a second.
100,000 or more in annual recurring revenue. That's a 16%
And he wasn't even listening
increase
to
from
me.
last year, and it's part of it ahead of the sub 4,000 that was expected. We know that's a critical metric for these software firms. They try to get the whale-like partnerships and customers in their ecosystem. For quarter four, they expect revenue between 912 and 916. That was way ahead, millions, of course, way ahead of the 888.1 million that was expected. Also, profitability expected better as well. So analysts were excited, noting the steady growth. No signs of AI headwinds right now. So really impressive quarter from Datadog.
Yeah, certainly, and there you have these monitoring security tools, so a little bit different subset in this AI trade. But we've talked offline about Datadog, actually, and in your opinion, is this one of the companies that is poised to benefit in this AI boom that isn't a name that we talk about? We talk about these smaller opportunities a lot, like who are these winners going to be that aren't the NVIDIAs, that aren't the AMDs, that aren't Taiwan Semi?
Looks like it today. Probably too early to say. I think this is one of the companies that was maybe people were concerned was going to be disrupted by AI. And I think the analysts come out of this saying, hey, there's still steady growth and that disruption doesn't seem to be taking hold just yet. But watch it. I mean, anytime a stock's making a 21% jump in a single day and it's on earnings, it's exciting times.
Very exciting. Alex, thanks for being with us to break down Datadog's earnings and their move to the upside, more than 21% higher so far today following their report. I do want to head back out to Denver to the Schwab Impact Conference, though. Welcome in our next guest. Joining us now, Mark Alberici, the Global Head of Product Innovation and Strategic Partnerships at State Street Investment Managing. Mark, good morning to you. Thanks for taking the time out of your conference day to be with us. I know you're an ETF specialist, and so I'd love to just start with your thoughts on
They are not going nowhere on
these
these bulls side.
in 2025 into ETFs, and
These
also
bulls
all the new
cannot
ETFs
lift
coming to
this.
market.
Yeah, so look, Marley, firstly, thank you so much for having me today. And before I talk about the flows, what an amazing conference. 5,500 advisors here. And what I'm seeing and hearing today is the energy around the usage of ETFs, which brings us nicely to the ETF flows. We've seen about $1 trillion this year, $1 trillion this year in ETF flows. And I think that's a testimony to the use case of the ETFs. And that's what I'm hearing today, specifically from the Schwab conference. And when we break down those flows, it's really driven by three main areas. The first area I would point out to is the continued usage of building blocks, low-cost building blocks. This is around 47% of the flows year to date. And this really allows our clients, our investors, to build portfolios using low-cost assets. In the State Street Investment Management, we have the lowest cost portfolio suite out there, and we have SPYM 2 basis points for our S&P 500 ETF. The second area of flows that we're seeing this year is in active, and unsurprisingly, mutual funds have historically been the wrapper of choice for active managers, but as more and more clients are using ETFs, we're really seeing people use that from active fixed income to option type strategies. And then lastly, the area double clicking is a lot of flows, about 300 million going this year in
I was
fixed
thinking the
income active flows. And
same
that's really
thing,
on the short
Swab.
end of the curve as people are figuring out what to do with their money. Just put it in cash, make a bit of carry, and then they can make their decision.
And we've seen more than 900 ETFs launch in the first 10 months of this year. I mean, just record amounts coming to market and so many options. Do you think that this current pace of product proliferation is sustainable in the ETF market? And also, do you have any concerns about how much product is out there right now?
Yeah, so I mean, first and foremost, it keeps me busy. I can tell you that, Marley. It keeps me very, very busy, not just thinking about what are the right products for us to develop as State
There's a little
Street
gap right here.
Management, but also just keeping an eye on the broader market trends. To
But
your
I would be
question around,
careful on the
is
long
this
side.
sustainable? I
A
think
lot of
the
risk.
jury will be out. The way I like to think about more of our product development is around putting the client needs first. What ultimately are we trying to solve for them? There are lots of ETFs already out in the marketplace today. So when we think about bringing a new product to market, we really need to make sure it's additive and it's adding value and not that one of our existing solutions can be used. So ultimately, I think products will probably slow down. We got a bit of a ramp up, but I think over time we're going to see the real needs for products that are ultimately providing the right use case and solving the solution for our clients will be ones that stand the test of time.
And so, Mark, it's important that they be additive, and I saw a release from State Street saying that you had partnered with Bridgewater to create this new fund, this all-weather ETF fund. Can you tell us about that fund specifically and the partnership and why State Street decided to bring it to market?
How's everybody doing? Everybody's
Yeah,
portfolio
absolutely.
okay?
So, you know, when we think about bringing products to market, again, as I highlighted earlier, it begins with solving.
That's the most important thing is
And,
protecting
if you think about today,
your dollars.
I see red on your screens. Markets are down. There's a lot of chatter here on the floor around all the markets at the top.
Remember, we investing for the long haul.
What should we do? So one of the things that we were researching and we heard from our clients was the need to provide a solution that could provide diversification for their portfolio. And as we thought about that, one of the things we're pretty strong at State Street Investment Management is knowing what we're really good at, which is we're great at ETFs, we're great at indexing. We brought the first ETF to market over 30 years ago. But then we're also really good at knowing what perhaps we're not good at. So by putting the client first, which in this case was trying to find a solution that created a diversified portfolio for them, it was a no-brainer to work with Bridgewater. Bridgewater have been around for 30 plus years. Their all-weather product was historically used by institutional clients. We want to democratize access to investors. We want to create more resilient portfolios. So it was a no-brainer to partner with what I would call the OGs for our all-weather ETF product. And we launched this earlier this year, and it's now at 650 million AUM. So we're super excited, and the feedback we're getting from clients is wonderful.
Hoping we get a
Look at
bounce on
this.
these
It's a
futures.
very interesting thing,
The
as you say,
futures
with
don't
the
even
needs of
look
your
good.
client first, and you're trying to move into this demand for active and diversification, and that comes in the form of creating a partnership with an active manager. Do you think that
I
is going
might
to
just do
become
puts
more
this whole
common
government
as
shutdown. I don't know
ETF
what's
product
going on.
development evolves
I'm
and
about to
people
trade
are
what I see
looking
though.
for more resilient ETFs as opposed to just quantity, which is a lot of what we have right now?
It's a great question. Look, I think it depends on the firm and the issuer. I can tell you the firm we're at, we know we're really good at, and we're really comfortable partnering with others. And we've done that with Bridgewater, we've done it with Naveen, we've done it with Blackstone. It's something that we love to do because we ultimately are trying to figure out how to put our clients' needs first. If my fellow issuers do the same thing, I think it's be wonderful for the end client. Ultimately, it's about bringing the best solution to them.
Mark, we appreciate you taking the time out of your busy day at Impact to be with us here on Trading 360 and Talk ETFs.
And I filled up the gas to go lower, boy. I'm telling
And
you.
we've got plenty more to
They
come
break
on
this,
Trading
they
360
coming.
next. We've got the big three. 3 stocks, 3 charts, and 3 trades. Rick
The moment
Duval
they
will
break
take us
this
through
and
the
go
technicals.
lower,
Jason Brown is joining us to take us through the trades for Microsoft, Broadcom, and Meta. That's next on Trading 360 on Schwab Network.
this area right here, sloping, support broke. I had said this last night, and they coming lower. Smack D's doing some weird stuff though. The Bulls are here though right now though. Trend is downward and Bulls is trying to push it up.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
Waiting for it.
Carl's Way
They
is
filling up the gas to go lower.
Is it? At
I can
Schwab,
feel
how
it.
I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out here.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the charts, and here to take us through the trades is Jason Brown, the founder of thebrownreport.com. Great to have you both with us. Jason, thanks for coming back. Love to start as we normally do. Big picture thought on the market performance we're seeing so far this week.
Yeah, hey Marley, hey Rick, good to see you both. I ran a little bit of red today because big picture, the market is down because the Mag 7 is down, which is the only stocks that have really been holding the market up. But from a, if you look at the technical standpoint, the S&P, the Dow, the NASDAQ, they're all pulling back to the 20-day moving average after being in a healthy uptrend. So at least for right now, we're still on that uptrend and it looks like a healthy pullback, but it still remains to see if weakness in the economy is going to take us down even lower. So I'm cautiously, I'm not even bullish right now. I'm just cautious right now.
All right, we're not cautiously optimistic. We're just cautious. Your first pick, though, is in the Mag 7, Microsoft. Walk us through this pick.
Yeah, so my first stock pick is Microsoft is in the Mag 7. We talked about this last time I was on. I'm wearing the shirt, you never go broke taking a profit, because I think as a trader, when these stocks were up, you had to look at it and say, we've had a nice run. Is it time to take some chips off the table? Now, Microsoft reported earnings, which was great from all standpoints. Free cash flow was up 25.7
everything
billion,
is
total
going bad.
revenue
Pull
77.66
back on everything.
billion, up 18% year over year. But yet the stock still sold off, I think mainly because of the accelerated CapEx for AI infrastructure. But one of the things I took away from their
QS
conference
is
call
filling up
was
the
that
gas
they
for a
said
retest though.
Azure, their Microsoft Azure server and cloud services
Retest
remain
somewhere.
capacity constrained all the way through 2026,
And
which
more
means they have
rejections.
so much business they cannot deliver on it, and they will be constrained or maxed out, if you will, until 2026. So I think that's a buy-in opportunity. It's not a bad company. They didn't miss earnings. I think you just see some profit taken from the Mag 7 stock. So I think this is it's down to a support area, which I know Rico talked about the charts, but I think it's a low risk reward to start looking further out and saying this is a company I want to own.
All right, so Rick, where are we seeing these support levels that Jason's mentioning, and are the technicals indicating to us there could be a potential move to the upside?
Well, it does seem like we're crossing below one of these significant supportive areas here. You could say that perhaps our price action has mostly been a big M recently here, bouncing between these two extreme points here. You could see we had our highs that came in here near 555. That's roughly where we topped out once again, but crucially we did not make a higher high. So never what you want to see. It did translate into a rather swift down move here. The 500 level stands out, old highs, lows here as well, and it looks like we are on pace to break through that level here today. Now there's still plenty of time left in the trading day, but that 500 level sticks out as a point that many traders might have an eye on. Below that,
if you get this position on the call side, you better have some time on it.
That could be a further supportive area to consider down the road. When we look at some of our other studies, you can see that the moving averages that are chart, yellow 21-day, orange 63-day exponential moving averages, so not quite the same as simple moving averages here. In this case, we have crossed below both of them. They're both starting to point downward. We have a very
This is what they talking about. This bounce right here.
Starting with our recent
it came all the way back down to it. This was the bearish trend. They done broke it, went bullish. This will be a retest over here somewhere.
For a further crossover below the threshold of 30 into the oversold area for further signs of bearishness.
I like when they done falling to go on the call
When
side.
we look at our other studies here, our volume profile study shows our point of control, our very thick red line there, comes in at about 510. That is the heaviest trading area. Again, not a great sign that we are starting to
want to go lower right now, though.
Here. The next significant volume area lines up right about here near 470 or so. Now that's also where you start to get our -1 standard deviation channel and our purple 252-day exponential moving average. So 468, 470. A quick look to finally at our 5-year chart shows 468 was a notable old high point right there. You can see that was a point where we topped out previously. So that really stands out as well in a longer term picture.
And we're about $3 off of that 500 level that you highlighted there, and about $13 off of that heavy volume area that you just highlighted. But Jason, walk us through your trade here on Microsoft. Is this a long-term play, a short-term hold?
Yeah, so this is a long-term play. Again, cautious. We want to see if the stock can bounce here. Obviously, if it breaks down and starts to go lower, this trade will become null and void. But I think this is the area where you want to start thinking about picking up a long position. So I'm looking at the June 18, 2026 call option, the 320 strike price. It's going for about $78 and maybe a little bit lower than that since the stock's been selling off. Break even's around 398 and you got 224 days. As a trader, you don't necessarily want to get too caught up in the short term. You want to think, where can the stock be 6, 9 months from now? And I think that's higher. The other thing I want people to think about when they're looking at this is you never know when the bottom is in, but you do know when the top is in. And we can look at the stock and say we're not picking it up at the top, which gives us a low risk, high reward potential opportunity.
Yeah, okay. Get them right there, Swappington. Get them right there, Swab. I told you with time on it, you're going to be all right.
It's funny to even think long term.
On Meta. I mean, not Meta, Microsoft. Give it some time.
In this world now. Broadcom, what I love about this from a technical standpoint,
give Microsoft some time.
One of the things that I'm seeing is even though the stock
is
pulling back,
they're going to go above 500.
Back to uptrend and support on that diagonal.
Look at them, boy. As soon as they said something
The
about
other thing I like about Broadcom is you look at the capex that's coming.
As soon as they said something about Microsoft, boy, they trying to bounce right where they at.
All these different companies.
This area.
One thing that stands out is they are working to also develop their own.
This whole area right here, y'all. Look at this wick.
From NVIDIA and the company
on the weekly.
To build their custom chips is Broadcom.
I like this on Elite.
AI that's working with Broadcom to develop some of their own custom chips.
I like this on Elite.
This is a company that has kind of carved out its own lane for helping people create their own custom chips. And there's
don't get caught up in the short term.
That's flowing into this company as well as NVIDIA. but I love that Broadcom is carving out its own share separate from NVIDIA.
Yeah, and it's an interesting one here with Broadcom because
I'm
their
still
earnings
nervous
are
though.
pretty
We
significantly
in the
removed
government
from where we are
shutdown.
right now, not until December. But I was just looking at some of the analyst expectations. They're expecting earnings to be up more than 30% year over year. So as you look to trade Broadcom, Jason,
There's a lot of
does the
diversions right
earnings
here. It
date
could be
get
a pop right
included
here, y'all.
in your trade?
Yeah, so what I liked about this is that we had a little bit of time for
I'm
earnings.
not
I
in
would love
any
to see
puts
the
yet.
stock run up into earnings. If that is the case, then I would take the profit off the table. However, as it goes into earnings, you always, the way I look at a trade, I know sometimes people say, why do you go so far out? You want to have time to sit through at least one or two more earnings in case you have what happened with Meta and Microsoft and the stock sells off. So I do take the earnings into consideration. Even if you're expecting a beat, that doesn't always translate to the stock is going to go higher. So you want some time on the back end for it to recover.
All right, so we want some time on the back end for that with the earnings included.
Yeah, okay.
When you look at
That's why I
Broadcom,
keep
you know
telling
they've
y'all
got
for
their
real.
earnings coming expected on December 11th. What are the technicals telling us here?
Yes, notable low point that came in recently here around 325. And Jason said something I wanted to expand on a little bit here, which is that low points in stocks, whatever other products, are often more orderly than the high points here. The high points are signs of either extreme exuberance or some kind of shock event or whatever. But the low points, there's often intrinsic value in a company here that they can be a little bit more stable. In this case, we do have one of those notable low points here, lining up around 325 at this point, as well as where our gap began, near 309, just below that level, 308.78. So we can see as well that even though we did peak our heads above the previous highs near about 374, we were rejected and had to retreat back to this level here near about 348. That matches up with our channel. We had some excursions above and below the channel, but typically what we try to do with these types of lines is just encompass the general price action and show the general trajectory here, not necessarily meaning to show a very strict path for the price that it followed exactly here. If we do move lower, then our 63-day EMA in orange comes in at about 334. That could be one area to watch. That is just above our lows of 325. RSI had been trending downward for a while. Our last peak in the RSI very notably showed bearish divergence. Not what you'd want to see necessarily if you were bullish, a sign of slowing momentum here where price makes a higher close.
Makes us filling up the gas, boy.
Nevertheless, still above the 50 midline though, so still more of a slight bullish lean. Finally, when we look at our volume profile study, this is a different situation than our previous chart. In this case, we're actually hanging on above that notable volume node near about 340 or so. So that's the potential traffic jam area where price could see some consolidation. It's also the site of our teal linear regression line, our line of best fit, an idea of fair value essentially at 341 that some traders use. So there's quite a bit of notable support in that area. The resistance, 375 is the mark to the upside.
All right, so we're at 356.47 right now with Broadcom, just slightly below the unchanged line today. But Jason, your last pick, you mentioned in part of your explanation for choosing Broadcom, you mentioned Meta, what happened to them post-earnings, but Meta is your final trade.
Yeah, well, I'm going to tell you about Meta here in a second. The trade, though, with Broadcom, I like June 18, 2026 call options, 320 strike price. It's going to cost you about 78. Break even $398. I think you can get back there. You got 224 days. The stock is healthy and it's benefiting from a lot of the capex from all these other companies. If we look at Meta though for the final trade, the reality is Meta really took the biggest hit because of the one-time tax charge. So it was 15.93 billion one-time non-cash tax charge. That really just obliterated the stock. If you look at the revenue, though, it grew to 50.8 billion, up 26% year over year. So the company's making money. I love that they don't really have any exposure to China or
But I don't
per
see
se,
the momentum.
because they just run a marketing company where everybody just uses.
Yeah, they've been selling off for a while,
So
but
I like that they're insulated from that. Unfortunately, they weren't insulated from the one big beautiful bill, which took the stock down. And then they also have a capex.
I appreciate you guys joining me and hanging out too.
Meta said on their conference call that they have
We're gonna find this money
for their
regardless.
Meta super intelligent labs. I look at it like this:
This
they
money be
have to
made on
defend their
upside and
assets. They have
downside.
to spend, invest, research and development, or else you're going to see the TikToks of the world and other platforms try to come in and take their lunch. If they can develop apps where you can edit and do AI and stuff like that right on their platform, it keeps people on the platform, which keeps people seeing the ads, which is their main revenue driver. So I like it, but again, I started this with saying I'm cautious, not cautiously bullish. I'm just cautious. I want to see Meta build some stabilization here. It continues to sell off each day. I saw volume decline and I thought the sell-off was going to stop. Today it's down another 14 points. So I like this trade that I'm going to share with you after Rick goes through the technicals, but I wouldn't want to enter it until we start to see base building or some green days to show me that it's done falling.
Okay.
I'm
all right,
seeing
so
a
with
lot
that
of
said,
red
walk us
everywhere.
through the technicals so that Jason can flag for us where he would want to make entry for this trade on Meta.
Yes, quite a difficult move on earnings here. Obviously, it was right here where we had our significant gap down. Now we are hanging out near 620 or so, so a far cry from those days when we were almost breaking through the 800 level here. So before that, things were trending downward, declining channel type shape here, moving lower.
I need
Between
this
those
MACD
two blue lines
pointing
now,
down.
much tighter, much more narrow channel
I need
between
to
our
see
two
more
breakpoints.
volume
So
and more
some
momentum.
notable activity.
Like
Price has
any
fallen
given
below
second, they can
the
bounce, right? They could
252-day
bounce right here.
exponential moving average. Many of these big names haven't come anywhere near these longer-term moving averages for a while, so a strong break below that level kind of stands out to me as well. The 620 area
Meta's
here,
filling up the gas to go
is
higher.
an old supportive point. We had a gap up on earnings previously, and then we bottomed out around
Meta
that
support
point
trying to
twice
go higher.
then. So for now, area at 25, but a tiny, teeny bit of bullish divergence. Our RSI has not quite made a lower close yet, but as I said, the point of control have given up long ago here. That came in around 714 or so. But now there's this other kind of block of volume here. The standout levels in this general region would be about 630 and 600 here. So those areas also could be potential congestion points once again.
All right, so 630 a potential congestion point. You said 714 was our previous area. Jason, as you're looking to trade Meta, where do you think is the best entry point here?
So I'm looking at 2 earnings ago, it gapped up from around the 605 area. At this rate that it keeps selling off, I wouldn't be surprised if we touch back around that 605. If it stabilizes around there, I think we look at a long call entry. I'm looking at June 18th, 2026. The 550 strike at this point is going for 126 or maybe lower because the stock is down today. Break even 676. You got 224 days on this. What I want traders watching this to understand when they hear someone like me come on, we only get this snapshot in time. If this stock continues to fall, I would not take an entry right here, right now. I want to see this stabilize as well and build a base, but there is no better app that has the attention of the world than Meta with their Instagram, their Facebook, and the ability to put ads right in front of people. So it's a good stock. It's having a tough time right now, but that's typically when you want to buy, not at the all-time highs. Down there, some major pullback, and I would qualify this as pretty major pullback. We're down from 800 down to 621, almost off 200 points. I think you start to look for an opportunity to scale in.
Buy the dip, but buy a stable dip. Good advice, and I know we all have Facebook, we all have Instagram. You are right, it is products we interact with every day. Jason, thanks for being with us for the Big Three today. For those picks, that's Jason Brown from thegroundreport.com, and of course, Rick Ducat, our lead market technician here on Schwab Network, for breaking down the technicals for us always. Coming up next, we're going to spotlight Elanco Animal Health. As we've seen shares gain 75% this year. We'll be joined by the president and CEO to discuss earnings and its latest drug offerings approved by the FDA. Trading 360 will be right back.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Anything on the short term,
We'll be the
though,
first to find out what's shaping early
like
market action. Check, options corner, futures focus, technical analysis, morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m.
I have to
Eastern.
wait
only
till
on Schwab Network.
some of this stuff with fall.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed
Let some
to
of this stuff stop
broaden your
falling
knowledge
first,
of
and
platform
then get
features
into the
and
lead for me.
resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest.
Some consolidation
Tune in
right here.
live or watch on demand. Head over to schwab.com/coaching and start learning today.
This is weird. What is?
Kick off the morning with the data and the decisions moving markets. Morning trade live.
This area right
breaks down
here.
the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning trade live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network. Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are. Welcome back to
Man,
Trading
look at this
360. I'm
rejection.
Marley Caden, live in our Chicago headquarters. It's time to spotlight Elanco Animal Health. Joining us now is Jeffrey Simmons, the president and CEO of Elanco Animal Health. Jeffrey, thank you for taking the time to be with us. You know, you're moving
I think they want to
higher
go lower
after your
for real.
earnings. You
They
had a
just
nice move to the upside. Can you walk us through some
taking
of
their
the
time.
key takeaways from your report?
Yeah, thanks, Marley. Great to be with
The
you
moment
again.
they get a
We
nice
had a
pop, I'm
solid
looking at
third
puts.
quarter, on all metrics, revenue, EBITDA, and EPS, and raised our guidance. 9% growth, high quality growth, marking really our 9th consecutive quarter of reliable, consistent delivery. And as we've highlighted in the past, really 3 priorities: growth, innovation, cash. That's what's driving this compelling value proposition in what I think is a very durable animal health market. We saw growth again from both the farm and the livestock side. In the U.S., I'll note 20%, pet health up 9%. And then the innovation. On the innovation side, as we've highlighted, we've got 6 blockbuster products. Innovation more than doubled year on year, and we raised our guide $100 million. And lastly, the balance sheet. Our balance sheet, as we look, we've taken 2 turns of debt out over the last 2 years. We're down under the 4 times. We're actually at 3.7 times debt to EBITDA, and all of that sets us up really well. And looking forward to actually an investor conference coming up in December in New York, where we're going to really lay out the Elanco continued trajectory of value in the rest of the decade.
And lots to follow up
Yo,
on
my
there,
bad
Jeffrey.
yesterday,
You've got
bro.
your
You
feet on
gotta
revenue,
get my
EBITDA,
cousin
on
out of here. You
EPS,
talk
beats
too much
across
on
the
it.
board there. What's behind that broad-based strength, and also how sustainable do you
Look,
think
we
that
was
environment
chilling,
is going into
and next thing you know,
It's
I
a great
felt like we
question,
was
Molly.
arguing a
we
little
see
bit.
the runway being very durable and solid. First, we got a great industry in terms of the pets and protein
That
trends.
motherfucker tried to
On the
talk
livestock
us,
side with protein,
trying to tell us
the
about
pet
the
side, of
internet.
course. But I think it all comes back to innovation. And what we've got, I'll just highlight a few. We have got differentiated blockbuster products going into
How you guys doing
markets
this
that are
morning?
big and growing. The broad spectrum parasiticide market in pets, that's the tick, flea,
What you,
heartworm
bro? I'm
market.
watching the market
We've got
fall.
Credelio Quattro, fastest blockbuster in our 70-year history, one of the fastest in animal
It's a
health.
government shutdown,
This
yo.
product is actually leading in the puppy index, which means more puppies are going on Credelio Quattro on
It's
a
a government
relative
shutdown,
basis
but
than
don't be
any other
scared
drug.
because Frost is in it,
Usually
bro.
when you get the puppy, that means you got the life of the dog. And that market is growing 40%. On the itching dog side, derm is growing 13%. We've got a product, Zenrelia, that doubled between Q1 and Q2. It nearly doubled again going into Q3. And we're launching now in big international markets like Europe and Australia and Japan. And lastly is the cattle. I mean, what brings Elanco into this different than others is we've got a really big farm animal business.
What? I
We've
got too much money. Give me some, man. What you talking about?
Size. And we got a product, Experior, that's already reached the 100 million blockbuster sales.
Yeah.
Grew 70% on 100% comp. And that's because cattlemen are
Oh,
looking at
man.
Experior as one of the key factors with less head of cattle out there in the marketplace. So big markets growing with differentiated big assets that sets
Papa
up a
John's is
really
down
nice
some.
long runway. We expect a couple other drugs as we go forward here, and we're going to globalize those.
And Jeffrey, you mentioned some of those products seeing this massive growth, particularly that Credelio Quattro. I was really struck by that number. 100 million in less than 8 months. What do you think is driving this adoption from veterinarians and pet owners? What's driving its appeal so quickly?
Yeah, there's a great trend in a dynamic time, I know out there in all markets, as we look at even from an investor perspective and from an overall, the durability of our industry. We've had 30 years and we've grown, I think, 29 out of 30 years. This is a durable industry. The willingness to spend is up. As
I did
population
crossing,
and kids
y'all. I
are
think it's
young,
ready to go
pets are
lower
up.
now.
But they want innovation that's convenient. I mean, what Corelio Quattro, first product that actually has 4 active ingredients in a pill that the FDA has improved, and it takes care of all the needs. It's got the broadest coverage, it's highly efficacious, it's convenient, you give it to the dog once a month, and it works. And that's what people want. They want that convenience and value, they'll pay for that. And veterinarians want, reliable products and innovation they can count on. And 70 years of Elanco in this business, we've got that relationship with the vet, and that matters as well.
And I want to jump to some of those FDA announcements in just a second, but first I want to talk about your deleveraging. You cut your leverage faster than expected.
All right, look, check this out, y'all.
How close is Elanco to returning to investment-grade metrics, and what's next for your
Gas is melting to the downside.
Yeah, thank you. We're very focused on delevering. It's
We're
our
gonna find
number
out
one
some
capital
puts.
allocation priority, as it has been for a couple years. We have a company that is generating a lot of cash. We've exceeded our cash metrics, I think, for quite a few quarters in a row. And all of our employees are incented on that as well, as return above the cost of capital and cash creation. So when we look at that, we see as that EBITDA grows, and we're seeing that, and we've shared with investors that definitely will be the case in 2026, the ability to delever. We've also changed our financing and actually increased some maturities, decreased our actually interest, and we'll pick up some interest opportunity on that refinancing as well. So we see a very strong balance sheet, the strongest we've had in many, many years at the end of 2025, which is going to be a key enabler going into 26. And we've told investors we are going to get below that 3 number. That is going to be very important, and that gets us to that level you're talking about.
Yeah, and something that can certainly help that is some of these recent FDA announcements that you've made. You've had 2 that I found just in the last couple weeks. So can you tell us about some of these new approvals?
Yeah, I mean, we're excited. First of all, I mean, we've got approvals around the world. I'd love to see, we've got our atopic dermatitis franchise that's expanding. We've got, we have an emerging concern around the new world screwworm that is emerging here. We got the first claim to protect, dogs from that as well. And then, we just continue to build out these portfolios. So what I would tell you is this consistent flow of innovation. What I think investors are excited about, why we've seen such a nice run in the stock, and what we see going forward, and what we're going to communicate in December, is we've built an innovation engine with some of the best team members that have come from animal health and human health, and we're going to create that consistent, reliable innovation, big and small, farm and pet, and then to globalize them quickly. These trends like the humanization of pets is globalizing. The movement around protein, animal protein, meat, milks, and eggs, and the dietary changes, all those trends are positive, and we're set up well. We're leaders in farm animal, we're leaders in pet retail, and we're right now leaders in the innovation area of pet vet.
Well, Jeffrey, we appreciate you being with us today. That's Jeffrey Simmons, the CEO and president of Elanco Animal Health. And thanks for helping us as a pet owner, for keeping our pets safe. We appreciate it. Shares of Elanco up 124% just the last 6 months. Coming up next, we've got disruptors. We're going to take a look at DraftKings after it announced a new partnership with ESPN that will make it the exclusive official sportsbook and odds provider for the station. Trading 360 will be right back.
Stay connected to the markets with Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to
puts.
Senior markets
This
correspondent here.
breaks.
Taking a look at DoorDash today, KG. We talked about DoorDash's earnings on market on close yesterday. Shares really under pressure this morning, down about 15.5% right now. Can you walk us through some of the highlights in this report?
Yeah, well, when you're coming to the report here, I would say at the high level here, we actually did some nice when it came to the adjusted earnings per share. That actually came in at 55 cents. Street was looking for around 68 cents here. And the revenue did actually beat, coming in at $3.4 billion. That was around a 25% increase on a year-over-year basis. What you did actually see, though, their guidance moving forward, they're actually looking at adjusted EBITDA between $710 million
hanging on by a thread right here.
But they're going to substantially increase their expenses or spending here in the near term, and that is really why the market is selling off on the stock here, trading around that $200 level so far, and we are not even close to really meaningful support at this point in time here. So spending money, margins getting a little bit more compressed. When you're looking at top line growth, it has been a little bit healthy, but is it enough to really offset some of the spending and maybe the lack of clarity as to what they're actually investing in?
Is definitely a good way to hedge your account.
Show some profitability here. It was a little bit lackluster when you were looking at that earnings announcement yesterday. So you are seeing a sell-off. Not really surprising though, Marley, when you're looking at a lot of these consumer stocks.
They're not taking all of my bread.
Really that great, and the stock market has been really
find me a good put somewhere.
These names, especially if they're actually increasing some of their expenses, and that's exactly what's happening with DoorDash. Unfortunately, you're seeing it down about 20% so far today.
Yeah,
ever since morning.
Seen some punishment in this area.
Excellent put. Whoever's in this put, excellent.
Doesn't like. I think was also looking for maybe a bit more detail on
You the
Deliveroo
coldest.
and
Tell
how
me,
that's going
you the
to
coldest.
be a driver.
You got all that put, you the coldest.
KG, we appreciate you taking the time out of your day at Impact in Denver to be with us to break that down for us. I do want to welcome in George Tillis to the conversation, though, because now it's time for Disruptors. We'll bring him in to talk about today's company, DraftKings, on the heels of a huge announcement, this new partnership with ESPN. They've also got their earnings coming out after the close. What do we know about this DraftKings partnership and how much it's moving here? I'm looking at their chart here. They're up just slightly on the day, but the market's down. So
yeah, so I mean it's a great question because I think the market also is looking for the answers to that question as well, Marley. Considering that DraftKings, was at the very least
here we go.
Time in the last year or
boom,
two,
boom,
25% market share in the online sports betting business in the United States behind FanDuel, but we know that there's been the rise of the prediction markets. Companies like Kalshi and Polymarkets are really taking up a lot of market share. And, the news today was positive. You can see the reaction pre-market where the stock gapped higher, and that's based on Disney and Penn Entertainment basically bringing in DraftKings and assigning them as the exclusive, sportsbook maker going forward. And that was, again, a catalyst to the news standpoint. But the challenge for DraftKings really has been some decelerating trends in growth in sales. But also, we've got another news item, which is their earnings coming out this afternoon, which, again, can present some either challenges or potentially some information that'll provide us more insights into customer growth and profitability metrics, as well as potentially some guidance revisions. Because if you look at the earnings estimates for the quarter, they're expected to be down 26 cents, down 53% compared to last year, which gives you an idea that expenses have been rising and maybe some higher cost per user or acquisition costs. But at the same time, the sales numbers are expected to be higher by about 9% to $1.2 billion. So kind of a mixed bag, positive earlier this day in terms of news, but going into the report, they are expecting a slight increase in sales, but a decline in earnings.
And George, I want to get your thoughts before we move to the example trade on the timing of this. Knowing they had their earnings later today, they could have just announced it during the earnings. So an interesting move to have announced it earlier in the day to have this headline coming across. Do you think that was an intentional move that perhaps was hoping to glaze over something else?
So I'm looking for a bounce now.
Or were they trying to back-to-back good news?
Yeah, so I'm not going to, look at this as potentially them providing this good news.
If one of these stocks
again, perhaps
from the Max 7
their
start rallying,
estimates for the remainder of the year. That could be the case. That's something you have to
or
keep in mind.
reversing that support,
But it also could be just coincidental as well.
Not rallying,
so,
but
we have to keep those conditions keep those conditions in mind. And anyways, if you look at the overall trend though, as we move into the earnings and in terms of trading this right now, we
A
have
little
to
bit of
consider the
divergence right here.
predominant
Might get a good
force right now
pop
is
on
the
the market.
downtrend. If you look at the 200-week moving average in DraftKings, the stock is trading below that right now. It's trading below its 10-week moving average. So, again, going into this earnings result, there could be a change in the earnings estimates going forward, which right now are still expected to be down 25 cents for the quarter.
I had took
For
a
the
loss on
forgive me.
Yeah, we
DraftKings a
did
little
get
bit
a
ago.
downgrade from B of A on Tuesday to neutral from buy, knocking their price target down to
But shares is
$35.48.
good.
So
I was
with
in an
that
option
downtrend in play here, Georgia, walk us through your example trade here ahead of their earnings.
up here.
Yeah, so essentially, as we were talking
I
about this a
took a
second
loss
ago,
on
the
this.
stock could have a really good
I
outcome
was up here.
based on earnings, even though the trend is down. So I'm going to use that 10-week moving average as a potential area where it could retest and then maybe fall back down, because it may take some time for the company to recover, especially when it comes down to the competitive threats they're facing from the betting markets outside of those prediction markets, like I mentioned. So what I'm
He's
going to do is I'm
trying to
going
get
to go
back
with
up here though.
December. And I'm going to sell basically a call spread. It's a bear call spread. I'm going to sell the $32 call and then buy the $35 call above that. Now, altogether, you could harvest around 70 cents a share or $70 a contract. So, in essence, the whole premise behind the trade is, in case the stock does move higher, we want something outside of, at the very least, the market maker move, which right now is around $2.80. And that's, again, where our short strike lies above that. The risk on the trade is, unfortunately, if the stock hits 35 or higher at $2.30 per share, or $230 a contract. So in essence, you
My
want the
bad,
stock
John.
to hold to $32 between now and expiration in 43 days.
All right, George, thanks for being with us
Yeah,
to break
yeah.
down DraftKings and their big news ahead of their earnings later today. That's George Tillis. Coming up next, it's time for our 360 round. We're going to take a look at Qualcomm, which is under pressure despite a top and bottom line beat on earnings. We'll break down the numbers next on Trading 360.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network. Welcome back to Trading 360. I'm Marley Caden. It's time now for the 360 round. Let's bring in our panel to discuss Qualcomm's earnings. Joining us now, Jim Kelleher, the Director of Research, Senior Technology Analyst at Argus Research, and Ben Beharin, the CEO and Principal Analyst at Creative Strategies. Jim, we'll start with you. You've got a buy rating, a $205 price target on shares right now, trading at 170, down about 5% following the earnings. What were your thoughts overall on the report?
Well, I'd say, thanks, Mark. I'd say my thoughts on the report overall, some encouraging signs in those parts of QCT, their chip business, that actually includes handsets, but particularly in automotive where they're outperforming, and, a real positive place they're moving into and kind of in the PC market. They're dipping their toes in the data center and the GPU side. Good full year momentum in the IoT space. So good diversified performance by QCT. We've definitely seen some slowing in the licensing business, but that's a steady and high margin contributor. So overall, a good report. It's a difficult trading day for the market. Not surprised the stock is down. It's finally had a little momentum this year after really kind of deeply lagging for like 5 years. So reasonably encouraged by the report.
And Ben, how about you? Were you reasonably encouraged? What were some of your key takeaways?
Yeah, definitely. I mean, I think obviously having a beat and a raise is good. It's positive for their business. I think, them stating that they're on track for the revenue goals in 2029, I think is encouraging. That's been a question amongst everybody in the industry in terms of their diversification efforts from smartphones. Obviously, we're seeing strong seasonality in smartphones across the board, so it wasn't terribly shocking that they're continuing to see handset revenues be what they are. Obviously, the next 2 quarters are a relatively strong cycle in all markets. We expect them to benefit from that as well. The automotive stuff, obviously equally positive, right? Hitting $1 billion, being on trajectory for the backlog of pipeline that both Cristiano Amon and Akash have said over time, I think is positive. I do expect different seasonality relative to IoT and some other things where they might see some seasonality impact that. But then again, right, the data center revenue is really the nut I think everybody's looking at. That's the biggest dollar TAM amount in growth expansion that everybody's chasing. So I think there's a lot of encouraging signs for them that they said they'll talk more about. Obviously, some deals that will be announced. But if you look just a lot of the upside in sheer dollar amount that they can go after, that's why everybody's excited about the data center. It remains, one of the biggest opportunities for everybody in semiconductors.
I'm buying a little bit of fastly right
And
here, y'all.
Jim, you said that it's a
I
tough
like what I'm
day
seeing.
to be on the heels of your earnings, in the markets, just because we do have a sea of red right now. But
I
despite
like
that
what
beat,
I'm
we still
reading.
saw the stock fall after hours, and it's continuing its downward trend right now. What do you think investors are most concerned about?
Well, the big concern is the roll-off of Apple modem revenue. It could be quite substantial amount, multiple billions per year. And already iPhone 17 Air has a house-built Apple modem. The rest of the i17 line still using Qualcomm modems, but I assume by 18 they'll be gone. Christian really kind of started things off by talking about their success in the premium tier Android market. And he made a good point that they're very strong in premium tier, whereas in Asia, maybe in lower and middle tier, someone like a MediaTek might be there. But that as more and more people around the world move to premium tier, they can bump up their share, from 50% of the handsets manufactured by a given Android OEM to maybe 65 or 70%, because they're in those premium tiers. I think another thing that they really highlighted was the success of Snapdragon Summit. It's their 10th one, and in much the same way that NVIDIA really promotes GTC as a way to kind of publicize themselves before the broader mass of investors. I think Qualcomm is really trying to position Snapdragon Summit as kind of an event day. They talked about 500 million social media posts around that, and it does give them a chance to really highlight, the Elite, the Snapdragon Elite 8 for PCs and their ride product for the automotive, and of course their Snapdragon AI for handsets. So I think basically the pivot away from Apple is going to be the crucial navigation for this company in the next couple of years.
And Ben, you highlighted another crucial component here for the company in the future is this data center build out. These data center revenues drive into this. With their push into this AI-driven data center world, their partnership with Humane and their Saudi Arabian AI infrastructure play, is Qualcomm quietly becoming an AI hardware play?
Yeah, I think that's the goal, right? And obviously, anybody who's in semiconductors providing chips to the data center it has some pretty high expectations. And I think the nature of the competition is changing there, right? We note that we're still largely in a training era of data center chips. I think the commentary from Cristiano and others about their desire that this will be more of an specific inference design product lines up with our expectations that you'll actually see a wave of products in the data center that are either inference specific, training specific, maybe a hybrid of those. So more fragmentation in the portfolio. So I think they're fairly clear about the opportunity and where they want to go with specifics relative to inference, both obviously CPU and AI accelerators on the back of some pretty good NPU technology that they have. So this is obviously the goal, right? I think they are approaching this purely from what they want to do in data center from a semiconductor standpoint, which is obviously hardware. But like I said, it's one of the biggest growth TAMs that we've seen in terms of rapid pace, and everybody competing there is going to be welcomed competition for the incumbents.
Well, we appreciate you both being with us to talk Qualcomm after their earnings. That's Jim Kelleher from Argus Research and Ben Beharon from Creative Strategies. We are seeing Qualcomm down about 5% after their beat and raise quarter they reported yesterday after the bell. I want to thank all of you for joining us today on Trading 360. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store. You can also tune in 24/7 on SchwabNetwork.com.
getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Oh my god. Boom, boom, boom. Somebody say boom, boom, boom. How come y'all never send me no invites to hoop? I need y'all to send me invites so we can get to it. Not right now, but in general, so we can get to it. I got a 6'10" small forward. And he's really Larry Bird built.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall. Coming up on noon Eastern here at the New York Stock Exchange. Wall Street is taking a step back.
I really got Larry Bird for real.
Let's get right into it and check on your scorecards as we arrive at lunchtime. The S&P 500 is lower by 1.25% there, pacing the loss as consumer discretionary, the biggest laggard of the 11 sector, down about 2.75%. Information technology, the second biggest laggard, off by nearly 2%. Communication services also taking a big step back, not as big as consumer discretionary and information technology, but certainly a step back. The Dow right now lower by more than 1%,
Yeah, I think if you look at the concentration risk that we've had in the markets with taking us up, right? The top 10 names in the S&P 500 make up about 40% of that index. It's not surprising when you see 6 of the 7 seven names in the red today, and pretty steep in the red, led by NVIDIA down about 3%, that you're going to have some concerns here. I think that's causing a lot of the pain for the overall market today. And if you take a look at the government shutdown, 37th day, the jobs data that you commented on, the Challenger job cuts, and that was the highest October in 22 years, I think, and 175% above what we saw from a year ago in this month. So causing some pain here, and then on top of that, you throw into the mix the tariff concerns, where the prediction markets right now are expecting the tariffs to get pulled back. I think it's like 25-30% chance only that they stay in place. Now, that helped markets yesterday, right? We saw a lot of the consumer discretionary names, a lot of the stocks that were impacted by the tariffs starting to do well. Now it's completely reversed. So we're in this chop phase right now, Diane, where there's a lot of variables out there in the overall market, and that's pushing and pulling on equities this week.
It's so wild to see how relevant the prediction markets are on these events, right? You mentioned the tariffs. I hadn't even thought to check the prediction markets on tariffs. I've been checking it on the government shutdown. Kev, what's your take when you think about the headwinds facing the markets today, especially as Tom just mentioned, I'm surprised to hear that the odds are, there may be pushback on the tariffs from the Supreme Court. What's your thought?
Yeah, I think people got the wrong read from the tariff talk yesterday. I think the mainstream media seized on questions from Sotomayor, and remember, that's a liberal judge that they're probably not going to get to side with them anyway, and she was questioning, which all the members of the Supreme Court do. They throw out questions, but the media barely reported on some of the more conservative judges and what they were doing. So I don't think this is an. I don't know what it's going to do, but I would be shocked if the Supreme Court were to come down and rule that these tariffs are unconstitutional. That said, if they do, there's still other ways for them to put these tariffs on. So I think the mainstream media jumped on one question from Justice Sotomayor and they ran with it. And so I think that is what's causing a lot of this. I just, remember, they're not going to rule for weeks or months. They're not going to rule on this. So I think the market might be re-overreacting to that. The jobs data, the Challenger job cut, remember, when we see second level or third level data, we look for something that jumps out at us. Well, this did. It jumped out 153,064 layoffs in October. Now, here's the question. Since the beginning of the year, there's been 1.1 million layoffs. That's the bad news, right? The good news is, but 308,000 of them are government employees. So the government is getting smaller. And these might be some of the Doge cuts jumping onto the radar screen. I think that's why you saw such a big jump. Remember, if you give 9 months of severance and you do it in January or February, guess where that gets you? To October. So I think that might be some of it, but they cited cost-cutting, AI, Doge, and so I think there's some interesting things there. I don't think it's anything too scary. Normally, we don't even report on this number, Diane, but I think the bigger story today is consumer discretionary getting walloped, and you combine that with information technology, this market does not have a big chance to go up if those two sectors are down.
That's a great point. I'm glad you brought up consumer discretionary. Just to add a fine point on Challenger, I do think you're right in that
They're getting some volume right here.
announcements. So, for instance, with Amazon, those people also have
Like they might try to
so that may not show up
bounce.
in an actual job cut.
Nice bounce.
Let's see, they have 90 days to find a new opportunity, and hopefully those individuals who are affected do. So that's the announcement of cuts. So it shows that there's essentially some turbulence in the job market, but you kind of have to read through it. So, but let's dive into that point about consumer discretionary, information technology. This,
This
We're seeing
bounce,
massive drops
this
in
bounce
shares
kind
of
of looks
Ulta
good.
Beauty, DoorDash. We're also seeing a big drop in Celsius. Kind of mixed bag, but they had weak guidance, and then there's tariff concern there. DoorDash coming in significantly short of expectations on EPS. It begs the question, what does this say about the state of the consumer? And obviously you can't get away from the, challenges in tech. Tom, what's your take?
Well, I think if you look at DoorDash, it was a decent report. We talked to Likefolio yesterday about it, and they were pretty amped up about it according to their data. It doesn't seem like less people are using it, but then you start getting into the guidance a little bit and the costs associated with some of the changes that they're rolling out. Those costs are coming into play, squeezing margins a little bit. So that's having a negative impact here on DoorDash today. Now, the bar was really high on this report going into it. We pulled
If you
back
do a call,
from
make sure
those
you got some
all-time
time on
highs
it.
from a couple weeks ago. But the bar was still relatively high because the stock had done pretty well. And I think you have to take that into consideration. But I think it's one of those things, and I've kind of been hammering this home, is that it seems like the consumer is making value choices across, the spectrum as far as consumer-facing stocks and companies at this point. Is DoorDash going to be one of those things that you give up first, right? It seems like a portion of the consumer is doing really well, right? The affluent consumer is still out there spending, and they're a big part of what consumer spending is. Now, if they start to make changes, that's going to be a concern moving forward as far as guidance goes. But I think the negative reaction that you're seeing here in DoorDash is more based on the amount of money that they're spending. The CEO did come out and said that, these investments, these baby step investments that they're making are going to eventually pay off. But right
Trend
now,
is
the street
downward
doesn't
still
like
though.
it.
Baby step investments.
Although
Yeah,
they trying to
one of the
bounce.
things that stood out to me was
I don't
that
like
quote
none of
from,
it.
which was to me was a wild analogy. They said, "quote We wish there was a way to grow a baby into an adult without investment, or to see the baby grow into an adult overnight. But we do not believe this is how life or business works." Obviously, the street does not like this explanation of the plans to spend more. And then, by the way, you have to take into account what they said about Deliveroo. It's not going to contribute as much as they thought. Kev, what's your take either on DoorDash, just the challenges in consumer discretionary, because you are across this?
Yeah, I think consumer discretionary is going to be dominated by Tesla. Remember, they've got their vote today. This stock already today has a range of $32 from low to high. It traded as high as 467, so up $7 or $8, and now it's down $20. So that is a big part of consumer discretionary. Throw in Amazon that's weaker on the day. I think DoorDash is an interesting discussion because remember, we've been reporting on fast food for a while having trouble, but McDonald's doing a little better. Well, if you're getting stretched for dollars, maybe you cut out the delivery and go get McDonald's, right? Maybe that's the first thing that goes if pocketbooks are getting stretched, is the actual delivery of the food that we report. It's not cheap to get that delivery, to get that food delivered. So, but the biggest thing today on consumer discretionary is Tesla's down, $19 after being up 8, and Amazon is real heavy. So those two big names in consumer discretionary are certainly affecting, that sector of the S&P 500. The weakest of all of them, if I still see that correct, down 2.4%, coming off its lows, but still down 2.4% on the day, Diane.
Okay, all right, good stuff there. Yeah, way to bring the attention on Tesla, because that is something I know that we're watching, especially with that pay package in focus. Over at CarMax, those shares, I mean, the CEO is out. The shares been tumbling today. They were already down 50% before this massive plunge. Tom, what's your take on this one? I mean, it's just like falling off a cliff.
Yeah, this is ripping that Band-Aid off the kitchen
All
sink
right.
maybe announcement here. Q3 EPS 18 to 36 cents with items. Consensus was 68 cents.
I
This
seen some
stock
stuff
is hitting
around
13-year
support.
lows today.
It's
We
getting a
all know
bounce.
the story. Carvana's taking market share away from
This trend's
CarMax
broken.
at this point. The Likefolio data that we
I don't
follow
know
on
what kind of
a
bounce we're
forward
gonna get.
basis
We're gonna see.
is reflective that
They
Carvana
got
is
the power.
beating CarMax's lunch. So getting rid of the CEO, Bill Nash, not unexpected at this point. Maybe it took a little
Just
bit
having a
longer
bounce right
than
here
they
all at the
would
same
have
time.
wanted, but this is margin
So I
pressure,
started looking at some
market
calls.
share loss that's causing all this pain. And if you look at the number of the inventory numbers on used cars, that continues to move higher also.
But
Now,
anything
new
that
car
you
sales
get,
have
make
done
sure you
really
got some
well,
time on it.
and previously used car sales
The
has done well,
trend is
but those
downward.
numbers are
It
really
was
starting
downward.
to
I don't
tick
know how
up
it
as far as
started, but
inventory. And where does
it
that hurt?
decided to bounce all at once.
Carvana, that hurts their margins initially. So not surprising that we're
So
seeing
when
the
they did
stock
that,
sell
I
off.
switched the
Now it's at
calls real quick.
13-year lows. Is this a buying opportunity? I don't know, because they didn't really give any clarity on their guidance moving forward, how they're going to turn this around. They better name, a new CEO or somebody, get somebody in there that's going to be able to turn this company around, because this is big business and it's a duopoly almost in that used car space for consumers at this point. So if auto sales start to pick up or at least remain the same, you've got to figure as a shareholder or somebody looking at a stock like this that the turnaround
This
better
trend
be
is definitely downward
relatively
though.
quick because the pain in the stock
So they're gonna go
doesn't
lower
seem to
any
want to go
second.
away.
It's true, and I mean, the board chair said this: "We make car buying," this is a quote, "and selling simple, transparent, and personalized."
I got a lot of time on
However,
my
our
call.
recent results do not reflect
see.
that potential, and change is needed. That's obviously around the conversation of the CEO shakeup, but right now, obviously, it's an interim CEO. What's your take on CarMax, Kev?
I think CarMax is just the story of the
I
better
hear
mousetrap.
resistance.
Carvana, with most of their operations being online, is just doing it better.
Dang, this little stock is going.
CarMax, with a big brick and mortar operation, just can't keep up with the margins that Carvana's doing, and so they continue to leak and leak. I think
They're screaming this on the
replacing
scanner.
CEO, they need fresh blood in there to turn this around. They've got to compete with Carvana, or companies go out of business all the time, and they're on a bad track here. They've got to figure out how to compete against a mostly online Carvana.
They're doing something.
This is brick and mortar grocery stores versus Amazon all over again, just in autos now. And so what happened there is happening to Carvana. And remember, every dealership also has a used
Shooting
car
up,
garage.
ain't you?
So there's plenty of competition out there. But
Where's your
Carvana,
high?
they're clearly doing it different than everyone else. And they're dominating
Bottom
the
bounce.
space. And
Okay.
you're starting to see that show up in
This is
CarMax.
high risk,
And
high
this
reward
company,
play.
they need a
But
complete
they're trading on
overhaul
this
here,
scanner.
Diane.
Yeah, clicks over bricks. It seems to certainly be winning out in this space. And you think about how far Carvana has come over the past 2 to 3 years.
If they
They
are
certainly have
bullish,
come off the mat
they
big
need to
time.
break out.
CarMax falling on the mat. Let's talk Qualcomm. It beat expectations, beating Ray's. Wall Street's
And
a
they
little
trying.
soft fan today. Tom, do you think this is kind of
This little
broad
baby
market
stock is trying
squeezing
today.
Qualcomm in, or is it just because Qualcomm's not a fan favorite in its space?
Alright, rejection right here.
Yeah, you wonder, because you
Trend
see
is still
the headline
downward.
numbers where they beat on EPS, they beat on revenue, they raised guidance. They 3 out of their 4 segments beat expectations here as far as handsets goes, Internet of Things, automotive's doing really well. The CEO came out and said that he expects that to continue. Revenue grew 10% from a year earlier. They did have an income tax expense of $3.12 billion. Maybe that's weighing on the shares here a little bit. But if you look at maybe some of the other data here, $12.2 billion at the midpoint of the range for the next year. That's above the $11.62 billion they expected. EPS expected to be, they raised it 330 to 350, and the consensus was 331. So pretty good numbers here. It's probably getting dragged down by the entire market at this point, but this was an underperformer, Diane, in this space. This and Texas Instruments, and that seems to continue. Maybe one of the caveats here may be that they're losing some of Apple's business. They've replaced Qualcomm in a couple of their products already. They expect that to continue, and Qualcomm expects that also. And then maybe chip restrictions into China might be negatively impacting the outlook here. But yeah, this is an underperformer, and it's a head scratcher a little bit. With the overall market down, maybe that's weighing down on Qualcomm.
I think they're trying to lift the vibes here take? It feels like for Qualcomm, they may be asking the question, what more do you want from me? Because Tom makes that
They can
point
go
about Apple,
lower.
but the street has known about that for a while. They've telegraphed that for a while. What's your take?
Remember, Diane and Tom, I started yesterday's
Hanging on at this
presentation
area
on
though
Qualcomm going, this stock confuses me with its price action based
until
on
they
the
break
news.
down and go
And
lower.
I think if you were a shareholder, if you were an investor or trading Qualcomm, you would have hoped for the numbers that they put up. And yet, the stock is down significantly on these numbers. So, yes, I think all the numbers were pretty solid. Is there a risk in some of their places? Clearly there is. But remember, they're also getting into GPU chips. There should be some hope there in that part of the business. Not so much, Diane. Again, it goes back to go through this release with a fine-tooth comb. It all looks pretty solid, and the stock is down. I can't figure Qualcomm out. Never have. I keep trying. It doesn't work, Diane.
Okay, maybe it's not the, I guess, the prettiest girl in the room in its space, and maybe that's part of the problem here. The IPO here, Evommune, it's a drug developer, shares up 10% off the back of its public debut. All right, guys, let's bookmark this. We got Bull versus Bear coming up. The guys will get their example trades put together for Airbnb. It has earnings due after the bell. Today, we'll be right
Looking
back.
for a bounce still. Yeah, hell yeah. It looks like some bullish divergence somehow. This is weird right here. I might be done selling off.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Airbnb is set to release its quarterly report card after the close of trading today. Wall Street is expecting the home rental platform to surpass $229 billion. Revenue is expected to top $4 billion. That will be a 9% increase. Now keep in mind that stock is down 8% year to date. All right, let's put on the trading glasses. Welcome back in our co-hosts Tom White and Kevin Hayes. It is bull versus bear time. Before we get to your example trades, we have to talk Airbnb. Kev, I know you have, well, you like Airbnb, the experience. I don't know the stock, if I remember, because you went to you had an Airbnb that had a tiki beach situation or something like that. I haven't been Airbnb has left me with more questions than answers, so I haven't used it in a while. What's your take, Kev, before we get an example trade?
Right now, as we sit, I have 2 Airbnbs lined up for winter and spring of next year. So I use this a lot when we go away with friends. But this is a company, their biggest problem is their growth is moderated. And so the growth that they've had since 2021 in this asset-light model, but the growth has started to moderate. So they need three things that we need to hear on this earnings release to get growth going. International, they need to show that that's taking over their growth. And like Japan, Brazil, China, India, Vietnam, they need to show that aspect is growing. Then this hotel app that they're going to do, they're going to put hotel rooms on Airbnb as a way to book hotels for people that are looking for a place but can't find one. They're going to link to hotels as well. They made an acquisition of a company, Hotel Tonight, that is gonna add to the platform. And then the final thing, services like chefs and spas and things like that. Those are the three areas where they're gonna try to initiate growth. International is gonna be key though, Diane, I think. And then maybe that can spur some growth in this company. Because right now, the moderating growth, stock traders do not like it.
Now, an international B&B might bring me back there because, listen, those cleaning fees are getting out of hand. You can just go to a hotel and have them take, but I guess the acquisition of Hotel Tonight helps that. Tom, what's your take?
Well, I like a hotel bar, so I'm not as high up on Airbnb as maybe Kevin is. Use them when you have big groups, but at the same time, you have to start looking at average daily rate that they take in. It grew 3% last quarter. They need to keep expanding that. And this asset-light model, as Kevin mentioned, you know what? They need more hosts. And one of the problems with not having more hosts come online is the fact that, hey, mortgage rates are still 6.3%. So people aren't out there buying new properties to use them as Airbnbs. International, that's their growth area, right? As Kevin mentioned, that's going to be key. But then again, you have cities like Barcelona that are saying, hey, by 2028, 2027, we're getting rid of all Airbnbs, short-term stays in our cities. So is that becoming a concern? There's a lot of things that you have to take a look at, but the biggest thing is they need more hosts on their platform because that's, in an asset-light model like this, that's where you drive up growth, and we're just not seeing it. That's a concern, I think, for Airbnb, and that's why the stock's down 8% this year and underperforming. It's in, a downtrend over the last year and a half.
Yeah, okay, great point. Kev, let's get into it. You're up first with your example trade.
Yeah, the genesis for this trade is the fact that they're going to show those three categories and reestablish growth. So what I looked at is a long call diagonal focusing on November 14th, buying the 122 call, looking at the expected move of about $9.5, rounding that to 10. I'm looking at the November 14th 122, November 7th 132 call diagonal, Diane and Tom. It was trading about 4.25, 420. Now it's trading about 380 as the overall market has backed off a bit here. But this is one that looks for that move right in line with the one standard deviation move, Tom. About $9.5, $10 higher than where we are right now, but the stock has backed off a little bit.
Let's break this one down. It's a bullish trade. You definitely need to move to the upside. But going out to the November 14th weekly options that expire in 8 days, you're buying that 122 strike call, selling in the near term November 7th weekly options that expire in just 1 day.
The market is showing some very bullish
bullish $10
not bullish
call
divergence, but
diagonal. You're paying a lot
they're doing
less
some
than half the
choppy
width
stuff over here.
of this spread here. We've got 425 debit, as Kevin mentioned. That's going to be your risk, $425 per
It's a
spread.
lot of
Trading
chop.
closer to 380 because the stock
The trend is
has pulled
downward,
back
but
the overall
I
market.
think they
So
finna
the debt you
reverse
pay,
it.
if you pay $380 in risk, so you can get that a little bit cheaper. But you need a move to the upside on this one. The option market pricing in about a plus or minus $9.5 move either way in the shares. That sets up near that 132 strike, 130, 132 level is where you want it to go. That peaks the profitability on this type of position, but anything above about 122 or 124 is going to be potential profitability
Filling
on
up
this
the gas.
trade. And that vol dispersion we talked about, it's less than half the width of this call diagonal. That's because in the November 14th options, Kevin's buying about a 77% implied volatility on aggregate in that option series, selling about 176% implied volatility in the near-term options on that 132 strike call. But definitely need to move to the upside. Now, I looked at it a little bit differently. If this bull-bear debate's going to be, come to fruition, I looked at a different strategy to the downside. If you think this stock's going to fall, remember, they reported pretty good earnings last quarter. A $6 billion buyback was announced also, and the stock still fell. If you feel like it's going to go down, maybe that 1 standard deviation, this strategy takes advantage of it. I looked at a 1-week wide put calendar to the downside, where I'm going to buy one of the November 14th weekly options, the 112 strike put, and then in the near term, November 7th weekly options, sell the 112 strike put. So 1 week wide put calendar to the downside. If you think it's going to go down about that 1 standard deviation, you're going to pay roughly a debit of about 40 cents for this. I think it's trading closer to 50 cents now, but the debit you pay is going to be a risk. So if you pay 40-cent debit like we've got here, $40 in risk to get some downside exposure here. And Kevin, you want it to go at or near 112, but you probably got a range between 105, 106 on the downside, and maybe 118 to 120 on the upside, and you can still be profitable on this type of bearish put calendar.
Yeah, this is actually
Bulls like it, trying to fill up the gas.
Besides bullish and bearish, it's diagonal versus calendar spread, right? And you see the difference. There's a big debit on the diagonal spread, much less on the calendar spread. But you target that short strike on the calendar spread, and you can lose some of that profit if it were to keep going through that strike back to the other side, whereas the diagonal holds onto it. But there's trade-offs. We talk about trade-offs all the time in options, and the trade-off is you're spending a lot less. But if you get it right with the calendar spread and it were to settle around that 112 strike, well, you've got the directional play and you've got the long Vega component of this. So the downside put calendar, if you're bearish on Airbnb, is something that can really work because of that directional and the Vega play.
And on your call, a diagonal that was bullish, anything above maybe that 124 level is going to be profitability because you're paying less in the width of it. With the put calendar on this example, if you get that 2 or 3 standard deviation move to the downside, you really start to get hurt, and you do need a move to the downside also. Both strategies have some assignment risk on those short options over the next 24 hours going into expiration also. So keep that in mind, Diane. So there's your bull-bear debate here on Airbnb, Diane.
Bull-bear, diagonal versus calendar. You guys covered it all. Thanks, guys. Coming up, we got cash tags. We are putting the microscope on buy now, pay later with the firm in focus. We'll dive into Likefolio's data ahead of its earnings report, ahead of the firm's earnings report. Keep it right here on Schwab Network. Fast Market will be back after this break.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand.
My bad,
Head
y'all.
over to
I didn't tell this person
schwab.com/coaching and start learning today.
you can invest as little as $1, 50 cents. You can invest any amount of
No
money.
politics, no spin. Just
As
the
much as
market.
we spending in the
Close and
world,
beyond.
you can invest
Streaming
5
24/7.
cents,
Any
10
speed,
cents,
anywhere.
any
at
amount that's gonna help
SheldronFrost.com.
you make some money.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Kevin Hinks over at the SIBO. Time now for
It's
our
starting to almost
hashtag
becoming a
segment.
pet
We take a
peeve
look
for
at
him
a
that people
firm
don't
that
have
moves
no
into
money
next
to
year.
invest
That
in
is
themselves,
Andy Swan,
but they rather
co-founder of
just,
Like
you know,
Folio.
spend
All right,
money or
Andy. So we're talking BNPL.
not have enough.
And a firm, when you think about it, it's kind of a real-time gauge of the consumer.
You
So
can put a
when
little
you
bit of
look
money into the market
across the landscape of
and it'll turn into a
BNPL,
whole lot.
where is the mind share now?
Oh, when Beyond Beach was
I think
running
the
up,
firm really
boy,
for us
I had a
is
$50 card
is
in the money
discipline
that printed,
and
and
they're
I
a
bought
global
shares.
player in the space. They lead
Printed.
market share, repeat usage, and credit performance.
Like that's why we
They're
was
not really
screaming
chasing
PL and
volume like other
QS.
players. I think they're chasing quality rather
Like I
than
got in at
quantity, and
QS
that's
way down
really
here,
helping
boy.
them out. If we look at
Talking about you don't got no money
portfolio
to
data,
invest.
web visits are up sharply since May.
I got in QS down here when it was
Perfectly
$1, so $3.
You know, if we look at volume share,
First bull run, took profits up
firm
here.
is at 47%, which
Used
is
that
the
money to
lowest
pay for
ever,
my lawyer
considering the
so
number
I
of
could try to get
competitors
my
that they
kids.
have. And so
You know what I'm talking about?
we really see Affirm as the category leader by usage.
Went all in on
If you
QS.
just look at
Down here about
the
hundreds of shares.
Klarna definitely
It sold up here at
strong,
$15.
83% growth in visits overall, but when you look at it from a size,
Don't tell me you don't got no money to invest. When there's so much money to be made in the market and you need money for groceries, bills, all that stuff.
Is on a much larger base, and it tells us that you know,
I don't
compared to some
understand
of
it.
these other players, the firm is really taking market share
Better come out here and
doing
get this
it,
money.
we think, the right way. Now, there's a huge question mark, which I know is what Kevin's going to talk about. Is you know what's going on with the consumer, and that's the biggest yellow flag. That's the biggest wild card in this whole debate going into earnings. But in terms of across the landscape of buy now, pay later, we really see Affirm as a leader in both quality and you know, sound growth metrics at this point.
You know, Andy, when this started, when buy now, pay later started, it felt like a fad. It felt like something that may jump on the screen and then fade away. It got the, you know, the nickname buy now, pay never. But now these companies are established and big, and they're doing extremely well. They've, you know, Affirm has jumped to profitability. My question is, all your charts look really positive for Affirm. It's the leader in market share. It's growing a big pie at 39%. Here's my question, Andy. Is Klarna a real competitor? Because their growth is big. You mentioned that was the obvious question was, how big is Klarna that their growth is so much better than Affirm? Is this like a Nike on holdings kind of growth, or are they a real competitor? Because the numbers look pretty solid on a Klarna. If that keeps up, they're going to start making some headway here.
Yeah, I think Klarna got a real pop after its IPO and just investor interest in their website, so that may be throwing things off a little bit in terms of our data. But when we look at Affirm, you know, their integrations with merchants are top of the line. I think that's where they really shine, is they've really dug in with the merchants. They're able to show through some of their you know, AI-driven checkout optimizations. They've been able to prove to merchants that they can create 5% sales lift for the merchant. So in an economy where things are getting a little shaky, if a checkout provider can add 5% sales lift, then all of a sudden that checkout provider, in this case Affirm, becomes a critical part of a lot of merchants' processes. And so I think that
I don't know if I told you I got a call in the market. I put some time on it though. I put a call in the market.
But also from the
Try to catch this bottom bounce.
that they're delivering,
I put some time on it though.
higher
You heard what they were saying about Microsoft Meta and all this stuff, putting calls on stuff. After all this
few
big pullback.
players that can really claim that. I think that most of the other players are trying to figure out the consumer side of the equation still, while a firm has really
I'm
seemed to
trying to
move on
see
to
if something great happen.
providing value also to the merchants.
Let me ask you this, Andy. I am curious to know because you talked about, you're talking about the credit
Most
quality
important
of
thing is
their
risk management, though.
base, their user base. I was talking to a
Stop
CIO earlier
losses,
today, and he
whatever you
says their
gotta do.
customers skew younger and lower income. Now, younger, fresh to the workforce, and he pointed out those would be the most exposed to inflation, student loan pressures, and just overall installment fatigue. So he was a little concerned. And then the other thing that was a flag around it was it can sometimes be perceived as a meme stock. What's your thought on that heading into earnings?
Yeah, no, I agree with both of those points. I think all of our metrics show very positive things for a firm in leadership in the buy now pay later space. So if you're bullish on buy now pay later, then I think a firm is the stock for you. It's better than its competitors. And if
Jackson
you're
right here
bearish
still.
on buy now pay later, then I don't think any of these companies should be
They ain't broke out
in
yet.
your portfolio because it's really
Don't
just
call it a comeback yet.
now a question of macroeconomic trends and pressures. And, I think investors need to have their own opinion on that. But from our standpoint, from a Lifefolio data standpoint, everything we see about a firm in terms of the traction with its customers, the traction with its merchants, the value that it's delivering to both sides of the equation, and the loyalty that it's generating on both sides of the equation are all very positive. And so we like a firm from a pure data standpoint. They're winning.
Okay. All right. We'll leave our conversation there for today. That is Andy Swan, co-founder of Lifefolio, with the latest look across a firm in the BNPL space. Now, for the trading perspective on all things a firm, I want to get Tom White back into this conversation. So, Tom, I'm sure you heard all the data that Lifefolio brought. Then you've got the expectations, earnings expected to come in at 11 cents per share, which would be up from a year ago, but down from last quarter. What's your thought on this before you guys get to the example trade?
Yeah, it's all going to be about gross merchandise value, GMV, on this one. Those growth rates, they're expected to be in a $10.1 to $10.4 billion range. And then that's 20% growth there. And then if you look at transactions per active customer, that's supposed to be up about 12.4%, according to estimates. So I think those are the things that you're going to have to take a look at. The stock's pulled back about 33% from last earnings, where the stock popped up to 100. And Kevin, you look at this, option market's pricing in nearly an $8 move either way in the stock. But I mean, that was a pretty good report last quarter when the stock popped to 100, and now we're back under $67 a share. How do you look at this one from an example trade?
Yeah, I mean, their gross merchandise value
Objection right here.
was up 43% last quarter. I mean, they're putting up good numbers. Andy's data says they're dominating. And if you notice, there was some divergence there in their charts from the stock versus the overall activity. So, Tom, I kept this one a little more simple, a little more like your put vertical or your put calendar in Airbnb. I did it from the call side here. I looked at the expected move, about $8. Let's call it $7.87. Let's call that $8, Tom. And then I just looked at something, the 1 week 77 call calendar, buying the November 14th, selling the November 7th, just the 77 call. It's trading, we put it in about 75 cents, trading about 66 cents as the stock with the overall market has backed off a bit here. But this one is just, it's got a big landing area. You're collecting a fair amount of theta. You're buying a much cheaper vol. 122 is the vol on the November 14th. 272 on the November 7th. So
I'm looking for a balance. Everything should be bouncing for the most part. Market should be bouncing.
A bit more expensive. Doesn't mean you'll be profitable, but if you get a move towards 77, that doesn't blow
Going right here.
strike.
It's going right here to this target.
Shot here if you get that bullish move in line.
Everything is Should get a
Let's
bounce.
break this one down. Sets up with like Folio's positive data
Banger on this
here,
sloping
but
resistance.
kind of in that same
I'm looking for a breakout.
strategy as that we use in the Airbnb on the put side. This is a call calendar 1 week wide, buying the November 14th weekly options that expire in 8 days. Buy that 77 strike call, about that 1 standard deviation above the current share price, maybe a little bit more. And then selling in the near term the 77 strike call in the November 7th weekly options that expire in just 1 day. Paying roughly about 70-cent debit, 75-cent debit. The debit you pay is going to be your risk. So it gives you upside exposure for a low entry point price because, as Kevin mentioned, that vol dispersion between what you're buying, which is lower in implied volatility, than what you're selling. That contracts the price of this spread. Now, you want the stock to go at or near 77, right? But at the same time, you probably got a range between about 70 bucks on the downside and maybe 84 on the upside, and you can be potentially profitable on this 1 week wide short-term trade. You've got some assignment risk on that short 77 strike call into expiration over the next 24 hours also. So keep that in mind. But Kevin, this is just, especially in a market like this right now, Kevin, where, you know, implied volatility going into the earnings is always going to be elevated, right? Because there's a bet risk. Then you throw on top of it the fact that, hey, everything's getting hit today, and you got the VIX near the 20 level, and that exacerbates and actually increases that near-term volatility, right?
Yeah, exactly right. I mean, you know, this stock is down a couple percent today, but look at like Folio's data and look at the move it had last quarter, Tom, and now it's lower than that. So unless something has catastrophically changed, this is a way to use that vol dispersion to get a moderately bullish play on. That's what this calendar spread is. You're looking for a move towards $77, collecting theta. Remember, the debit you pay is the risk on this trade.
Alright, add one more
You're looking for
to
a
my
move
long list
in line
position.
with the 1 standard deviation move up towards $77, Tom.
And it sets up with like Folio's data, as Kevin mentioned, and
Bottom box
lower
right here.
risk.
I'm looking for a W pattern on the market.
That vol dispersion
Reversal.
on calendars right now, Diane, with
On the
the
short time.
volatility elevated in the
On
near
like the
term.
1 minute, 5 minute, maybe like, I don't know, however long. They might try to reverse this.
Breakdown. We are taking a look at Block, the artist formerly known as Square, ahead of its results. Those will come after the bell today. We'll be right back.
So they break this. I'm looking for it to go right here.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall on the floor of the big board. Before we get to the breakdown, let's take a look at where the markets stand as we get closer to the bottom of this lunch hour. The S&P 500 lower by nearly 1%. The Dow off by 0.8%. NASDAQ 100 down by more than 1.5%, 1.6% to be precise. Russell 2000 down 1.5%. On the earnings front, Block set to report its quarterly results after the close today. The street is projecting earnings of 63 cents per share on revenue of more than $6.3 billion. Investors will keep an eye on transaction volumes for Cash App as it competes with Venmo. Keep in mind that stock is now down about 15%, more than 15% year to date. Time now for the breakdown. For that, let's welcome in George Silla, senior markets correspondent, taking a look at this one. So I always have to take a second to think about this one because it's block, it's square, it's ticker XYZ. How are you looking at this as we head into earnings, George?
Well, I mean, if we consider Block itself, in terms of what they own in Bitcoin, it's around 8,700 coin, which again is quite large on top of the $7 billion in cash they have on the balance sheet. But there are a lot of questions about how they're actually monetizing Bitcoin. In other words, providing positive free cash flow. That's essentially what we want to see on it as a return on investment. If you also consider what's been going on in the payment processing space, both on the merchant side as well as the consumer side of the equation, lots of competition. Companies like SoFi have been encroaching in the business-to-consumer areas as well as B2B business. And we also have companies like Affirm, which again compete with Afterpay, which Block is still trying to get sorted out in terms of improving margins from that division of its business. But nonetheless, if you consider the estimates for the quarter, as you mentioned, the 63 cents, that's down 22 cents compared to the same quarter last year, with sales higher by about 6%. So we are seeing improving sales trends, positive ones, but nonetheless they are in the mid-single digits. And again, there's some questions about monetization of what they're doing with their Bitcoin strategy, as well as elements to competition. But one of the things I notice, and I always pull this up when I look at Block or essentially PayPal. If you look at the 5-year chart, it really hasn't recovered since the 2021 highs it's published. It's still trading close to its 200-week moving average, slightly below or above, and it's been just trading in a trading range. And I think the story here for the company is essentially multiple compression. If you look at the earnings multiple for the stock going forward into next year, it's trading around 20 times earnings. Historically, it was around 75 times. So the earnings multiple has gone down, but so has the price significantly. And if you look at the last 5 years, it's still down about 62%.
That's a great perspective there. So why now to that 5-year chart? I'm glad you brought that to our attention. I was just checking across the landscape to see if there was any recent analyst activity. I haven't seen that one, so I guess they will wait for the results coming after the close today. All right, we'll leave it there. That is George Silla, senior markets correspondent, with a look across Block. Those earnings due after the bell. Let's get Tom and Kevin back in here for the example trade perspective. So you heard the breakdown from George. And then, of course, they're taking on that strategy, similar to strategy of buying Bitcoin as well. Tom, what's your example trade approach for this one?
Well, you take a look at last quarter, they made over $2.1 billion on Bitcoin on their investment. Now, we've got Bitcoin back at near the 102,000 level. I'm not sure if that's going to continue, because Bitcoin went to all-time highs during the last quarter. So you have to take that into consideration. And just like what we talked about with Affirm, you got to start talking about GMVs or GPVs, in Block. They're supposed to be growing about 7% year over year. International is supposed to be growing about 25% year over year. I think one of the biggest concerns is Jack Dorsey leading this company and the monetization that they're seeing on the users across their platform. He
catch that bottom?
to kind of fit in
Catch that bottom bounce?
narrative.
I ain't playing with him. I told you I'm the
blockchain
coldest.
narrative. And, is it going to pay off? I think that's what it investors concerned. The stock's down about 15% so far this year going into this result. And off of 52-week highs, it's down about 27.5%. But it's been consolidating. So I looked at a strategy where I don't have to pick a direction. I just think maybe it's going to move. The option market's pricing in about a plus or minus $7.80 move either way for a one-day move, according to the market maker move from the platform. So I took that into consideration when setting up the strikes on this example trade. So going out to the November 14th weekly options that expire in 8 days, I'm going to buy an out-of-the-money 80 strike call and then buy an out-of-the-money 65 strike put. And then in the near term, November 7th weekly options that expire in just 1 day, I'm going to sell those same strikes. I'm going to sell the 80 call and sell the 65 strike put. So those strategies we talked about on the put calendar in Airbnb and the call calendar in Affirm that we just kind of went through, this sets up the same way, but you're using one of each, so you don't have to pick a direction. On this double calendar position that's 1 week wide, you're going to pay roughly about a 75-cent debit for exposure to the upside and the downside. It's trading about 75 cents, so that's your risk. $75 to get upside and downside exposure. Kevin, when you look at it, we've talked about calendars quite a bit today, and that seems to be the strategy du jour for us, but it's all about vol dispersion and lowering your risk and exposure, right?
Well, the only consistency is we look for the most efficient use of implied volatility. And when you can do both sides, remember what a double calendar is, it's a $7.50 on the upside call calendar. It's also a $7.50 on the downside put calendar. It's two individual trades. You can do one or the other, but what we've done here is shown both. And so the good news is for traders is both of these are relatively inexpensive because both of them combined only come out to 75 cents, Tom. And much like Qualcomm yesterday, if you're not sure where it's going, up or down, this gives you an opportunity to be profitable in either direction, Tom. You need a move near those strikes, but you know the difference in implied volatility, 248 versus 108, that makes for the inexpensive calendars, both on the upside and downside. When you combine them, it's an inexpensive double calendar, Tom.
Yeah, and Kevin, when you look at a risk profile like this, you know, you're paying 75-cent debit for it, and you know, the risk profile, because implied volatility is historically falls post the event risk, right? But it's also going to fall in the options that you're long. So this thing might show that you can make $300, $400 on a strategy like this, but at the same time, on a double calendar like this, Kevin, you're paying 75 cents. Say the stock goes up to $79, $81, $80, and it expands. If I'm looking at this thing, you know, trading $1.50 is probably when you're going to have to do some trade management if the market's open, right? Where, hey, maybe I just get out of this because it has expanded in price, and maybe I'm not going to make $300 per spread, right? You've got to limit your expectations on these calendars, right?
Yeah, and the other thing is, Tom, you may have to be a little patient if it goes towards the strike, because that short could hold some value. But yeah, don't ever look for max value if you get a good double or triple on this spread.
Yep. And there you go, Diane. Bullish and bearish all in one strategy right there.
Oh, there we go. Exactly. All right, that's that double calendar approach there. That's going to do it for us today on Fast Market. You got markets coming off the lows of the session right now, but still under pressure. I'm Diane King Hall. That was Tom White and Kevin Higgs. Download the Schwab Network app. It's in the App Store. Tune in 24/7 on SchwabNetwork.com. Stay with us. You've got Next Gen Investing with Jenny Horn and Alex Coffey coming up.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey, and we've seen some pressure throughout today's session, which right now is picking up a bit here as the Nasdaq's down just over 1.5%. We're seeing some weakness across our Mag 7, with really the only standout today being Apple as well as Alphabet. And so leading to some of this pressure, S&P's down about 1%, Dow down about 0.9%, and the Russell, a very strange day. We see parity with the Russell, of course, and the Nasdaq. The Russell down also just under 1.5%.
Yeah, there's some, kind of ugliness brewing underneath the surface today. 20% of the Nasdaq 100 higher, 30% in the S&Ps. The Magnificent 7 as a cohort of stocks is down, if you index it, by 1.6%, so almost exactly the same as the Nasdaq 100. We've talked about that, countless times in terms of the importance of it. Technically maybe a bit of a head and shoulders pattern forming on the S&P 500 over the last, I guess 2 weeks of trading. You go back to, that October 20th or so time frame. And if that pattern were to complete, about 200 points, high to low there for that pattern, maybe targets for the S&P 500 around 65.50 or so. So another couple hundred points if those technical targets came into play. Now, you do need a little bit more downside for that to happen, but we're now down about 2% over the last week. We're down for the last month for the S&P 500. So things have turned in a hurry, but we haven't gone anywhere yet. I think that's the biggest thing. And sometimes the best correction for the market is just simply going sideways first.
I couldn't agree more. I think especially after it felt like bloodbath of earnings we discussed mostly on the Tuesday session, then yesterday was characterized as definitely more
Oh, my bad,
positive,
y'all.
but we're seeing still a pretty mixed picture as far as some of these
This is a
earnings
trend reversal.
go. So at least we have some green shoots
You can
today,
see the
but
MACD
it does
filling up
feel
the
like the
gas.
sentiment is still pretty downbeat on some
And
of these
then I'm
names
pulling
coming
back.
from earnings release.
I do want to say one thing too, as we kind of take it back to the overall market. Now, this is going to be very, very obvious when I say it, but sometimes I think we don't think about it this way. What's the best way to predict whether a stock's been down over the last week? Is it down today? The same goes for how would you know if it's down over the last month? Is it down for the last week? So if you're looking at the S&P 500, down today, down over the last week, down over the last month. Okay, we're still up about 5.5% over the last quarter. So there hasn't been too much damage done yet. It's been a nice run over the last 3 months. But how do you get that closer to an unchanged? Well, a couple more down days and that can turn in a hurry.
Yeah, that can turn in a hurry. And to speak to that also, anything right now that it does seem like it's higher, like for example, we're seeing still some strength today in Alphabet, but to your point, I mean, the winning recipe, it's actually our only Max 7 name that's positive. Apple as well, yeah.
Trend on the 1 minute
the
broke.
Max 7 name right now that's higher on the week.
I believe they
And
filling
also
up
now
gas to go higher.
on the year. So it's right now has outpaced Nvidia's gain, at least since 25. But to your point, Apple also a point of strength today, which is actually probably easing some of the overall
what's
pressure.
the most fascinating piece about this? I know we circle around this a lot, but it was with Nicole today, but normally on Morning Trade Live with Sam Vadas, I go through sort of the sector performance, and I always circle back to the Magnificent Seven because we've talked about that correlation. When I was kind of compiling that information today, it was 6 of 7 were lower on the session. It was a trade back and forth between Apple and Alphabet. But at the time, the Magnificent Seven was down about 1%. So it's actually improved to where only 5 of the 7 are lower on the day, but the indexed version of the Mag 7 has gotten worse. So what that tells me is names like Nvidia have gotten a little bit weaker. Names like Meta and Microsoft have gotten a little bit weaker, despite the fact that Apple and Alphabet have done a little bit better.
Okay, and actually, to speak to that, actually, Apple now, you have me looking at this
Oh,
chart.
still gotta be careful though. They can switch this at any
on a
moment.
week-to-date basis, also in Apple.
About 0.25%.
Yeah, modestly, but still also at least tracking higher for the week, whereas we're seeing some significant declines on the week for, say, names like Nvidia, which is now contracted about 6.6%. So does speak to your point. Today, lower. What we're seeing on the week can easily be characterized as a metric. Of course, there's exceptions to this.
Right when I said they bullish, trying to reverse, they pull it back.
Especially on the these earnings events to kick off our show today.
That's crazy.
We will also be then discussing Alphabet's YouTube and Disney's ESPN.
We gotta see if these
escalates
resistances hold up too.
Carriage fees. And then we'll be joined by a slew of guests that are coming to us from the Impact Conference in Denver. So we have a wide variety of guests throughout our show today, as well as discussing
anything on the call side. You need some time
in their third quarter, and
the equity, the dollar cost average, any of these pullbacks.
Swinging also to a loss in the third quarter. So some big moves.
That should be the first thing of trading. You gotta have the.
Yeah, you know where the biggest
you gotta have your
though are post-earnings
equity for this.
These first 2 names that we're going to discuss today.
Having
if you want to start with positive,
education, to picking the right strikes.
Datadog, what a move.
Having the right entries and exits, knowing where the dollar cost average at.
To see this move of upside that is held pretty much throughout today's session.
Anything on
we pulled back about 2.5%
the Max 7s,
from those highs made earlier.
ETFs, need some time and liquidity.
November of 2021, pacing for its best percentage increase since November of 23, and also snapping now its 3-day.
We're trying to trade with bill money.
I find it fascinating that
you're gonna do that with bill money, you might as well invest.
20% jump.
That's how you're gonna get your money back.
About
plus more.
Below, at
Just
least
invest.
at its peak today, is still about 4% below those all-time highs at around just shy of $200 a share. So speaks to where we've come in Datadog here. Adjusted earnings did beat expectations.
I believe they're filling up the gas
revenue
though.
rise by 28%.
This is the slope and resistance they bounced from.
Margins remained relatively flat, while
So
adjusted
they could come right here and bounce.
dropped by 200 bips. Now,
Right here at this same area they've been at the whole time.
Continue to accelerate innovation to help their customers address some of the challenges in AI. Like they've launched several products, AI observability and security products, as well as various security teams that have been implemented to focus on AI. So now expects fourth quarter revenue to fall between 912 to 916 million. That was well ahead of forecasts, which were around 887 million. And adjusted earnings also did easily top expectations now for their fourth quarter. And so, I mean, their biggest high-profile customer has been for quite some time been seen as OpenAI. I did read some skepticism about that because OpenAI has been shifting to develop its own in-house solutions. That right now it does contract out for Datadog, but they have other major customers mentioned on this call. I mean, Shell, PayPal, Comcast, Samsung,
Pullbacks
Autodesk,
are normal.
just to name a few. So it's not just an OpenAI story at all. It's just, you know, one of its largest customers, which Guggenheim says poses this risk.
Yeah, KeyBank, I thought, said it pretty nicely. They say the strong results show steady growth and suggest no looming optimization from the AI native.
While everything
I
is
think
going
the big
back,
fear for this company was that some of these AI
the market, that
transitions
is,
and things
everything's going to be
could really disrupt
going
the
back and
growth
filling up the gas.
trajectory for this company and just not showing there. But, you know, this is the perfect example. This stock is up about 20% today. Well, now it's up about, 18,
filling up the gas.
over the last week and up about 18% over the last month. So, again, it made the month. And it's a little bit dramatic, of course. Not every stock's going to move 20% in a day. But you can really see, why I said the things that I said in terms of the predictive factor. The more information you have, the easier it is to kind of, take that trajectory down the line.
Yeah, and I think that this one has continued to be, I mean, it wasn't really an outperformer. It was higher on the year into today's report, but now, I mean, 3-year highs showing that they obviously have a place at the table. I mean, yeah, this is a move that definitely rewrites some of perhaps the more murky picture that we've gotten from a lot of these cybersecurity and various solution-based tech names.
So you want to talk about a year maker the other way? Let's talk some DoorDash here, Jenny, because this stock is
The only thing that looks
really
semi-promising.
lows. I know it traded a little bit lower than this in kind of the pre and post market sessions in reaction to the earnings, but it was like immediately down 15-20% after this report hit the wire.
It's kind of difficult to fully even understand why, as they did say they're expecting to ramp up spending. Growth accelerated in their third quarter to actually their highest rate in more than 2 years. I mean, revenue rose 27%. But marketplace gross order value, that's the dollar value of all orders placed on their platform, that was also up 25%, beating even their own projections. They do, again, though, intend to ramp spending by several hundreds of millions of dollars in their new initiatives and platform development in 2026. Maybe that's where we see some pause from the street, but I do think that when you look at their metrics going forward, I mean, for example, their gross order value is expected to come in well beyond what the street had been expecting. Now, adjusted EBITDA, that was one forecast that was a clear miss. They're projecting now 710 to 810 million.
Growth came in strong right here.
Beneath, if at the midpoint, the 804 million estimated.
That's also super wide for a current quarter.
That was exactly
Retesting
my
support.
thought. That tells you that you have a wide goalpost for a reason. I don't typically think that means that you have
This would be a spot where you load up another contract.
in your quarter, and so that always
On
does
support
give
on
me
your long, on your lead though.
So it's like, okay, margins are in question right now.
Absolutely.
And maybe they don't want to say that just yet, but
I like
you
to
go
see
around
them
710
actually
to
bouncing
down,
first though.
As the low point, unless you're like,
Not a
we don't
rejection.
get some things
If they look like they
this could
breaking
be kind of
support,
Right,
that'd be
I thought that's
bad.
like a cushion. You have like a safety net at that point. But this was one of the weirdest earnings reports
like I said,
I've ever seen from a company.
it really
The
filling up
company
the
said,
gas.
verbatim, we wish there was a way to grow a baby into an adult without investment, or to see the baby grow into an adult overnight. We do not believe this is how life or businesses work. I mean, what
And is
does
this
that
in reference
mean?
to Deliveroo in terms of like trying to get that integrated and grow internationally and some of those things? So this is what I also think too. You start looking at what you're seeing from other big companies, whether it's Target or UPS or Amazon. They haven't outright said it, but all of those companies have kind of said through their decisions to reduce headcount and announce layoffs that one, maybe there'll be some AI, even though Amazon directly said this isn't the case, maybe some AI disruption.
Even PL filling up the gas.
The information they have doesn't set up for like robust holiday spending. There's also been reports out of some of the cardboard box makers that shipments around that are a little bit lower. So
support.
start looking at this. DoorDash is spending into what could be a bit of a consumer slowdown. This is like peak discretionary spend if you're getting DoorDash on a regular basis. So maybe it's just ill-timed and maybe they could be benefiting from a year of efficiency.
And hey, it's not cheap. It's one of those things where when you think about trying to cut back on your expenses, this is the first place I look because I am too well versed in these food delivery apps,
You
and it's
notice it
expensive.
the
Filling
most
up
too
the
when it's
gas,
something
boy.
that you typically go to the place and get, and you realize that there's like hidden fees, and that, like, say you went to, you know, XYZ QSR restaurant and you ordered in the
Look at
drive-thru.
that McD
It
filling
might
up
be
the
$4 or
gas, boy.
$5 for the item. I don't know. I'm just throwing it. It might be $6 on DoorDash. So the subtle price increases in the menu itself add up a lot over time. Not even to mention the fees.
And that's almost the brilliance of the business model, because I've noticed the same thing recently where you can be a various loyalty, you know, follower. As like I do have Uber
Filling
One,
up the
which I
gas.
actually subscribe to because I really wanted to understand the platform more. But it does then, when you go to check out, you have like zero additional fees, zero delivery fees, and that all sounds so great from a consumer standpoint. But then you actually consider, yeah, on cost per item is what really those hidden fees, I think, have just, you know, they've just basically reallocated that.
Yeah, and it's super interesting too. And I'll use an example, and I don't want to spend too much time on this. I know we are. Crumble Cookies is a place that, you know, you get cookies, right? I was going to send them to somebody. You could go on Crumble Cookies and do it, and they were cheaper, but you had to pay for the delivery. But then on Uber Eats, it was like they were more expensive, but the delivery was fee if you had like the Uber One, and it ended up being a wash. And it was like, I don't know what to do here now.
I know that's I think again shows you the nature of the discretionary right now world that you are trying to work with. As I think are trying to at least spend as little money as possible on some of these platforms, but they get you no matter what. But last name today, a pretty nice move today in AppLovin, as we did see earnings come in above expectations.
Look for a retest around this.
DraftKings, I'm jumping
Support
far too
somewhere.
ahead. No, DraftKings is where we'll look next, as DraftKings is up about 1% today. Also actually seeing a more favorable move than AppLovin, which is giving back some of that strength. But ESPN and Penn Entertainment did end their deal about 8 years early, and ESPN is now staking on its bet in larger DraftKings as its official sportsbook. So now the two entities, of course, ending that deal early. They're placing that bet on DraftKings. And the chair of ESPN said their approach has very much been focused on integrating their experience within their products, and working with DraftKings, a leader in that space, allows them to build upon that foundation and continue to serve these sports fans and grow their ESPN direct-to-consumer business. So Penn did also give a statement saying that it was an amicable end to their collaboration, but I think you consider
Right
the
here.
size
Oh,
of
this
this
love and
company.
resistance, they
DraftKings
found a
has a
support,
market cap right now
which
of
is
roughly
crazy.
25 billion. Penn has a market cap of roughly 2.3 billion.
Which is crazy.
And their products will start being integrated into ESPN systems in December. Will be fully switched by next year. So I think that this is interesting. I mean, the deal, of course, Penn did have to pay ESPN about 1.5 billion. That was initially the 10-year term. So now we're going to see, I'm sure, some breakup fees, not, you know, necessarily having to pay that entire fund per this statement. But it will also change. It will no longer be called ESPN Bet, which I also think is interesting.
Yeah, there's a lot of moving parts in this space at the moment. We questioned that partnership to begin with and the value that ESPN was even bringing Penn. It seems that, you know, maybe it wasn't working out well, clearly. But this is a space that is so disruptable at the moment with some of the things that you're seeing within, you know, the Kalshis, the poly markets, the prediction market landscape. So, yeah, watch this space, but maybe from an investment standpoint, volatility is going to increase as there's just a lot of uncertainty at the moment. And you see it with DraftKings currently, you know, with a 79% implied volatility. That is a massive, massive number as it trades near its lows over the last year. But let's get to AppLovin. This is our favorite company to talk about. I feel like we've talked about it so much this year. And for good reason. It's made just monstrous performance.
It has, and it's been making the right steps to continue to show signs of a more mature AppLovin. Like we did see, it sold its mobile games in the quarter to focus on fast-growing and high-margin mobile advertising. And games showed segment growth, came in at an adjusted EBITDA of around 20%, but that ad business has now double-digit growth and a near 80% adjusted EBITDA margin. So that was, I think, clearly the right move. And AppLovin has a niche ad platform for mobile apps, and really has been seen as one of the final frontiers of the rapid digital advertising growth. And it's been an underserved market for quite some time. And as we continue to see AppLovin lead a pretty saturated market, it's doing so very well. And so, I mean, like earnings per share beating expectations, rising from a year ago. Also, ad revenue for the quarter was above expectations, up 68%. And guidance for the fourth quarter was equally strong. So I think there's a lot to like with this company, and not only really brushing off a short report that
this stock is
came
finna break out.
in February that was basically saying this company is somewhat fabricates its growth
Is
rate.
this the fuzzy panda or is this somebody else?
Yeah, I'm not sure who exactly the short report was from. I'll check that. But they did, I mean, they've been able to prove that wrong every step of the way, which I always think is so encouraging. Your numbers can really speak the story to like, sort of to just,
Yo, SheldronFrost here, live. I got Datadog pulled up. Man, what is going on? I'm looking for a breakout today. I don't know. Just put it on your watch list. We're gonna see.
Maybe for AppLovin than TTD, but they're growing revenue at a comparable pace. It's just the ability for AppLovin to turn into earnings in a high margin way is just not comparable at the moment. It's really what's held back Trade Desk. So fascinated to see if Trade Desk can follow suit or not. But you have to tip your cap to AppLovin. They've weathered the questions pretty well. And it's over a $200 billion market cap. Named
Filling
AppLovin.
up the
At least as of the end
gas.
of last year, less than 2,000 employees. That's really, really impressive.
Somewhere in here, I'm looking for either a retest.
Muddy Waters
Somewhere in here, they're gonna bounce.
They're always
We're
great.
gonna see
I
it.
know, they are always great. It was the ledger, of course, of that short report back in February. But hey, AppLovin has been an outperformer really ever since. So also getting that S&P inclusion was a huge catalyst for this name this year.
Market filling up the
We'll leave it
gas
there
too.
for the top of our show today. Now coming up next,
Retest somewhere.
into the world of streaming
Up.
and Alphabet's YouTube, Disney's ESPN. Still seeing a resolution between the two, fairly unclear at this point.
Somebody's getting them calls ready, boy. Filling up the gas. Yeah. Continue investing. Anything but time, boy, I'm telling you. We're gonna be alright.
Stay connected to
And they
our
pulled
news
that
alerts.
back far.
Download the Schwab Network
I gotta take my
app
money
and
out of that
stream
crap.
live coverage
I left a runner on there though. I have a lot of
What's up,
time on it.
World Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network. Welcome back to Next Gen Investing. It's now time to dive into the charts with, of course, our chart master, Rick Ducat, today talking about Walt Disney as well as Alphabet. But the tie between these two is, of course, Alphabet's YouTube and Walt Disney's ESPN, which have not reached a
This is
deal
wild.
yet. Really angry.
They bouncing off the
Specifically
sloping
myself.
resistance,
I did not
bro.
watch Monday Night Football. I was not happy
They was
about
rejecting
it.
off of it.
Doesn't seem like there's a resolution, at least.
They're showing some bullish divergence right here on the 1 minute.
But I'm personally angry about these days. But outside of that, we are seeing Walt Disney down about 1.2% today, Rick. And I have to say that we were
Right here on the 5 minute. If we get some greens right here,
we've just been sort of drifting.
I'm looking for a W pattern
Yes, after we hit those highs near
on the daily. I mean on the 1
all
minute.
the way back here, that is when the decline really started to take form here. And from there, we've connected these subsequent high points here repeatedly, mostly sticking within the confines of this pattern here. Now, you could also draw another line going across these lows here It's not quite parallel. But if you put these together, that would give you more of a falling wedge type shape here, typically regarded as more of a bullish type of pattern, but certainly not a sure thing. It can go either way. What you'd be looking for in this case, though, would be breakouts from beyond either of these two lines. But we also have some horizontal areas to consider here. We have our low points that we established here after our earnings gap up. That comes in just below 109. That's about where we hit our lows recently here. So we would, if we were to get through that point and through our trend line, the next point to consider would be right around 106, where we had this further gap. So that gives us a supportive zone potentially between about 106 to 109 roughly or so. To the upside, 114 stands out as a frequent stopping point for price. This general area around where price had some trouble breaking above for a while here, but then that would come back into prominence most recently here, where we topped out around that same level again here. So 106 to 109 to the downside, 114 potentially to the upside. If we were to look at some of our other studies here, we can see that our moving averages that we follow are yellow 21-day, orange 63-day, purple 252-day exponential moving averages, all kind of clustered together here, moving sideways, suggesting there's really not very much strong trend directionality in this case here. We can see as well, price is currently sitting at the purple 252-day EMA that comes in just below 110. That could be a notable point to watch for potential support as we head into the close. RSI continuing to decline. Green trend line has been broken. 50 midline was rejected. More of a bearish lean once again here for this momentum indicator. When we look at our standard deviation channel studies and volume profile, this area right here once again comes into focus. Our point of control, the area of heaviest trading of all, is right around 112. So it's not necessarily a good sign for the bulls that we're starting to move below this area. Not really any significant volume either until we get down here back near 98. If we were to move higher, 120, a repeated high point right here, that's the mark that stands out to the upside beyond 114.
Yeah, and of course, lower now on the week by just over 3% and modestly lower on the year. So a bit of a lackluster performance we've seen through all of 2025 for Walt Disney. And so now, Alex, as we think through trading this name, as I'm sure you're as unhappy with this lack of deal as I am, but say leaning into some more neutral to pessimism ahead of their earnings, which I do believe are next Thursday, so a week from today after the close.
What I will say is that it seems like a tough negotiating partner to try to think you got leverage on Google, but that's a different conversation for a different day. Example trade, we do have earnings next week, so this would kind of be an earnings trade. Say you wanted to be a little bit neutral to bearish and establish that now. Maybe you look to that resistance point that Rick talked about around 114, and you look at the 114, 116 short call vertical, and try to get 30 cents per every dollar in risk. In this case, $2 wide spread, that would be 60 cents. So you have a 60-cent credit. That would be your max profit potential on this elongated Z risk profile. $60 max profit, 140 max loss. Your break even, you simply add that 60 cents to the 114 short strike and you get 114.60, Jenny. So basically at resistance, asking the earnings to be good enough to surprise to the upside and get through that resistance point. Of course, if it does, that's fine. It's risk defined, 140 at risk, but several scenarios, especially in this earnings season where good news outside of Datadog really not being rewarded.
It's very true, and good news has actually continued to be good news for our next name, which has somewhat bucked the overall trend we've seen with a lot of tech, that being Alphabet here. Alphabet now the best performing Mac 7 on the year to surpass NVIDIA, just given this week's underperformance, frankly, as we've still actually been able to maintain a modest lift this week. We're off of highs made last week, though, by about 3%. So seeing some strength today, again, modest strength, but hey, on a day of red for tech, we'll take it.
Modest strength during a week like this is strength, to be truth be told here. And this is an interesting chart for several reasons. We have the opposite pattern of what I was discussing in our previous chart. This is more of a rising wedge type shape here. But as I said, really it can go either way. This would typically be viewed as more of a bearish pattern, but obviously once we broke out above that area here, we never even really looked back. We have low points here around around 225, and then again here near 236. Meanwhile, the ceiling for that range was around 256, but we have once again not really even looked back on our ascent further to the upside here. We topped out near 291.59. Our steep white trend line does look like it's being broken here, though, even as price struggles to retake that area here. So possible support could be found around 275, the high point before we had our gap up, and then the subsequent low point aligned with each other. So that seems like the short-term supportive area to consider. When we look at our moving averages, during fast, steep price moves, moving averages are lagging indicators. They're not too terribly much help sometimes. But in this case, our 21-day EMA is near 266. That could be one potential foothold if things do start to decline. We can also see, though, RSI is showing some bearish divergence here. We had those old highs on the RSI matching up with high closing prices here, but now we are seeing higher closes in price, but RSI is lower. This is especially complicated, though, because RSI has re-entered that overbought area. RSI is a very nuanced indicator. It can be difficult to make sense out of sometimes. So the thing to be looking for in the short term would be for price to continue making new highs, as well as for RSI to hang on to the overbought area and to retake those old highs that it reached near 80 recently here. So finally, when we look at our volume profile and standard deviation channel studies, the only notable volume node anywhere near current price is right around here, just above 250, 255 or so. Our +2 channel, meanwhile, lines up fairly closely with those recent highs that we saw. That comes in at around 293.60 at this point.
Okay, and Alphabet has really been our standout amongst the Mag 7 as of late, just continuing to see outperformance. And it hasn't been in that way all week, but at least for today's session and on a week-to-date basis now. So appreciate it to Rick, our chart master. But now, as we do look to trade Alphabet here, Alex, leaning into the optimism, frankly, that we've continued to see from this name.
Yeah, we've got no FOMO segment today, so this is going to serve as sort of our FOMO example of the day. Going out to the December monthly cycle, we're already through earnings for Alphabet. But say you believe this stock can test the 300 level over the next month and a half. It's a call butterfly spread, $15 wide wings. So December 19th, 285, 300, 315, call butterfly, $2.50 debit means you're risking $250. Now, where does that risk take place? It takes place if the stock's below 285 at that point, or above 315 at that point. It has two break-even points, Jenny, of which you want to get between by that time frame. It's 287.5 to the downside and 312.50 to the upside. Now, this is where things get fun. If it does go exactly to 300 by that expiration, can expand to as much of a $1,250 profit. Now, we know it's not the most likely of outcomes, but these really positive asymmetry trades, the ones that really perform well, the better you can be accurate in your projection and precise, I think are a lot of fun.
I do too, and especially leaning into some optimism today, as of course we're in still a sea of red, but we'll leave it there. It actually speaks to the theme of our next segment, though, which is all things optimism in regards to investing. We'll be joined by the host of the Blue Sky podcast, as well as the founder of the Optimism Institute, Bill Burke, on how to stay optimistic while investing.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of think or swim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Oh.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time to discuss how to stay positive in investing, which is a very fitting topic for this day as we're seeing some pressure throughout the overall markets. But joining us now is Bill Burke, founder of the Optimism Institute and the host of the Blue Sky podcast. Bill, thanks so much for being with us today. Let's start broadly here. I mean, do you think optimism is a skill that can be developed, or is it more of a personality trait?
Thanks for having me. And the first thing I should say is I'm at this jam-packed convention. I think I'm the only one here who's not a finance professional. So anything I say about optimism, please take it or investing with a grain of salt. I might know a little bit more.
I don't know if you guys were here this morning.
But I think for sure,
I have a couple more
positive
things
outlook and
for
an
you guys.
optimistic outlook can be learned.
Here
We're
in the
all
future.
born
I'm
differently.
always gonna be making
I like to
content.
compare it to athletics.
Oh,
born
I
with
got you guys.
A Major League Baseball player or a professional athlete.
So I have to
we
go
can all
over.
work and get better with the skills that we have. And the same thing happens with optimism. There are people, and their science proves this, are more naturally positive and optimistic. But even those who aren't can work at it and practice it. And even someone like me who is sort of wired that way, I have to keep working at it and practicing. So if you don't feel like you were born that way, it's not too late. And you can work on that part of your life for sure.
Bill, it seems like a really fine line between like realistic potential and limiting belief at the same time. So how does one kind of toe those lines and kind of do what you're talking about, which is maybe nurture that skill or that mindset over time?
Yeah, so over time I think is really important in all of this, because just as, for example, the stock market over time outperforms other forms of investment, the world continues to improve over time as well. And one of the challenges we all face is that slow change, which is often what happens in world improvement, does not make news. It doesn't happen overnight. And so we get trapped, I think, by the panic, by, the market's down today, versus over time we know it's going to keep growing. So I think one of the biggest challenges we all have is balancing the reality of what's happening today, but the other reality that over time things will continue to improve and get better. Frankly, as long as we stay optimistic. If we as a society give in and give up to pessimism, then that improvement might stop. So I think that's a really important part of this, is that we don't overreact to the minute-by-minute news cycle, the social media cycle. With all apologies, the ticker constantly. I think it's really important to take a longer view on these things.
Okay, and have you seen a shift amongst different generations, like the different ways of thinking, the different degrees of optimism? Are we seeing that start to change as right now the majority of the working world is the millennials, but now we're seeing this more Gen Z, Gen Alpha come up this?
Yes, one of the reasons I'm doing this work is I have genuine concerns about people younger than I am, which is most people these days. And one of the reasons I think this happens is because older people have been through a lot. My father's passed away, but not that long ago, and he was born during the Depression. He lived through World War II. He fought in Korea. We have young people today who are fed information on social media and other places that this is the worst time to be alive, and this country's never been more divided. We fought a civil war for 4 years that killed almost 1 million people. We have been more divided. And so I think a real challenge for young people is managing their media diet, managing their outlook. And I imagine that happens in investing. Looking for quick hits, short-term results, day trading, that sort of thing, does not, in my view, breed optimism. This is not gambling on sports teams. This is investing for a longer term. And I think that's really important. And the other thing I would say to young people, Morgan Housel has a line that I've always liked, which is invest like a pessimist, save like a pessimist, invest like an optimist. And for young people, the only thing I would suggest is set aside money, save money, don't go into too much debt. It's not a lesson that a lot of young people are taught, but I think if you can save pessimistically, it allows you to invest optimistically and know that you can weather some of the storms ahead that are inevitable, that will happen.
Yeah, I think another way to say that, to even make it more applicable beyond just investing, is sort of, plan for the worst, but expect the best. If you're a sports team and you go in kind of looking for your deficiencies and you plan around that, but you expect to win the games that you play,
I'm looking for a
there's a
breakout.
lot better chance than going in there
Come on,
saying, oh,
baby.
this other
Y'all
team's
can do
better
it.
here than
Reversal.
we are, etc. But I want to get back to the discussion of sort of life experience and some of the hardships you describe of other generations. In my own personal experience, it sometimes feels like when you look back, there's moments in time that you can see has sort of shifted your mindset. Do you feel there has to maybe be moments for people to kind of shake them out of maybe these pessimistic mindsets if they don't naturally lean a little bit more optimistic?
Yeah, that's a great question, and I think the answer is probably yes. I think one of the challenges is I think there are moments in time happening all around us all the time. We just are bathing ourselves in the negativity. So it doesn't have to be some big seismic event, I don't think. I also believe, and probably one of the reasons I'm doing this work is I was a history major, I'm a history buff, and I had a guest on my podcast, a guy named Kevin Kelly, and he said, if you only read the news, you'll think things have never been worse. But if you read history, you'll realize things have never been better. And I worry that young people, and I don't want to sound like the old get off my lawn guy, but I do worry sometimes that young people don't have as much knowledge of history. Again, to be able to say with a straight face, this country's never been more divided. Or, you could hear some say, markets have never been this volatile. Really? So I think that framework in history is really important, and it frees us up, I think, to see those moments that you described that are around us all the time.
Okay, and really quickly before we let you go, I am curious your thoughts on AI. Specifically, there's a lot of pessimism around AI. We talk a lot about the optimism, of course, in terms of price and finance, but are you seeing any degree of caution when it comes to overall perception of AI?
Yes, I think, look, AI to me is astounding, and we are only, the same Kevin Kelly was on my show, and he said, we're like in the second inning with AI. We are nowhere near where this is all going to go. I think we have reason to be concerned. I think we need to be vigilant about what this could turn into in negative ways. But I think the positive potential is astounding. I use it in small ways in my own work. I bet you guys do too. And I had Sal Khan on my show of Khan Academy, and he's doing remarkable work with a product called Khanmigo, AI in education. And he said, I think we should approach AI with educated bravery. And what he meant was we shouldn't be foolhardy. We shouldn't just rush into this. We should be educated about it, but we should be brave. We shouldn't be scared of it. And so I am relatively bullish on AI, knowing that there are going to be bumps in the road, knowing that there's a lot of vigilance required to make sure it continues to bring out the best in society and not exploit the worst. But in general, I'm pretty optimistic about it. No surprise there.
Okay, that's a great place to leave it. Love to have a positive conversation today. As of course, we've just talked about a lot of pressure that's been weighing on the overall market, but such a refreshing take on the overall landscape of the world right now. So we so appreciate your time, Bill Burke, founder of the Optimism Institute and host of the Blue Sky podcast. Now, coming up next, unfortunately, we are taking a bit more of a pessimistic turn here. We'll dive into CarMax, selling off after seeing a C-suite shakeup. Shares are now down 23% nearly on the session.
Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network. Welcome back to Next Gen Investing. It's now time to discuss the move to the downside we're seeing today in CarMax, plummeting after saying its CEO is out and also giving some guidance now for a weak third quarter. So joining us now is Diane King Hall, the host of Morning Movers. So Diane, is this all really focused on the CEO, or is it also, giving some credit to the fact that they gave some pretty downbeat now sentiment into their third quarter? Yeah, look, this stock was already under major pressure year to date, heading into today, down significantly. So the pace of loss is just accelerating right now, down more than 20% off the news that there is a big shakeup in the C-suite, and obviously the board felt like it needed to do something because, look, this has faced some difficulties this year. Carvana has been beating CarMax at its own game. So the CEO, Bill Nash, is going to be out effective December 1st. So it's clear they saw that a need for change is coming. They'll clearly need to identify who is the right person to ultimately fill this role, because it's going to be an interim CEO for now. It's going to be board member David McCray, who will be the interim CEO while they search for a permanent replacement. It comes as CarMax's performance lags compared to peers. You look at, for instance, Carvana, that's been an outperformer year to date. Before today's move, that's up more than 50%. The exact reverse of that for CarMax. In fact, Tom White pointed this out earlier. The stock now is at a place it hasn't seen in about 13 years. So it's sitting at 13-year lows now. In terms of the preliminary results they guided for, they're expecting fiscal Q3 earnings to come in between 18 to 36 cents. That's well below what Wall Street was expecting. They were looking for closer to 70 cents. 69 cents. They're projecting comps to fall 8 to 12% year over year. So there is essentially, in their view, still some strain in the used car market. And part of this for CarMax, the challenge is they're operating both a on-the-ground, brick-and-mortar traditional sales environment and online. But when it comes to online, that's where Carvana is eating its lunch. And you have more and more people coming back to Carvana, because we know Carvana has went through some challenging years, but it's come out of that with flying colors. On the flip side, you have CarMax, who hasn't been able to meet the moment.
Absolutely. Never would I have thought we'd be in a market environment where we're actually talking about CarMax losing to Carvana. I know still it's the larger player of the two, but it's really shown the impressive nature that Carvana has been able to grow into, and now stealing some of that coveted market share from CarMax. So really great takeaways here. Thank you so much, Diane King Hall, the host of Morning Movers. But now we're going to send it back, of course, to the Impact Conference in Denver. And I'd like to welcome in Susan Frew, entrepreneurial and AI innovator and keynote speaker at the Schwab Impact Conference in, of course, Denver. Thank you so much for joining us today. And really, you're considered a very important voice in AI right now, which we talk about very thoroughly on our show here. So what really sparked your interest in the AI space, and what are you paying attention to right now?
Well, my background is in tech. I started with AT&T Wireless in New York City many years ago, and ended up being a general manager for 2 countries. And I was on the wireless data launch team, so I've always loved tech, and I understand it, and I think that's key. You need to love it and understand it in order to get on board with AI. And my husband and I had a small business which we needed to sell a couple of years ago. We weren't really ready, and I used all AI in order to put it together and get it sold on the market. And now I really teach people how to do that. And I've been speaking for many years about tech, but I really have spent infinite amount of time learning, and it still takes, 8 to 10 hours a week of learning to keep up.
Susan, our last guest, Bill Burke, used the phrase educated bravery, and I love that in terms of how we should approach our interactions with this technology. But even with that, I think it's still pretty intimidating the first time you start to interact with some of these platforms. For those who are, maybe just getting into investing and then they're being augmented with this AI, like, what would you say to them to help simplify and maybe improve their experience with this tech?
Well, I say that you need to go old school before you go new school. So you really need to evaluate your business and all of your processes and find the friction in there. And that will give you the right formula to implement the AI. I see countless companies try to implement too quickly, and they end up feeling very disappointed. They're not getting the results. It's overwhelming. And I think that that's the way to do it. You need to figure that out. And then you look at humanizing the exception and automating the routine. And I believe that will take you on to being really successful with AI, one step at a time, one process at a time. Understand it. Understand that it's a heavy lift in the beginning, the learning, the training, and all of that. And then, once you get to the top of the hill, you'll be able to see over, and it's going to feel so much better. You'll be able to get rid of all the things you don't like doing. And that's really the best key to all of this.
I could not agree more. And for just like our own day-to-day sake, I just think that right now, just the very much the tip of the iceberg has already been so useful. But now to go on the other side of the coin and more of the concern. I mean, what ethical guardrails do you believe are really critical as AI becomes more embedded in our daily lives?
Well, one thing that I've observed is that if a company doesn't have an AI policy and the CEO or leadership doesn't make a statement on what's okay and what's not okay with AI, employees are using it without guardrails because there's no policy in place. So I think that's very important. Also, a lot of the AI now, you can connect it to your internal systems, which seems very convenient. Connect it to your OneDrive, connect it to your CRM, so on and so forth. But if you have confidential data in there, you are not being protected. I would say that that's a hard no on connecting your data to the AI at this point. Also, something that most people don't realize is that on the free versions of all of the AIs, regardless if it's Google or OpenAI, ChatGPT, Llama, whichever one it is, if it's on the free version, they are training on your data. And you want to really be able to wall that off. And in some circumstances, I recommend that the IT department put a lockdown on what's not approved by the company. So if the company buys 30 seats of Microsoft Copilot and they don't want everyone else using it, there's a way for IT to get involved and sort of wall that off to protect their confidential client information.
Yeah, and I think there's a lot of exciting innovations that we'll be witnessing just over the next several years. So exciting time definitely for all of us to be able to engage and sort of watch this transformation. So we so appreciate your time, Susan Frew, entrepreneur and AI innovator. Thank you so much for joining us on Next Gen today. Now coming up next, last but not least, it's time to discuss Bloomin' Brands, which is seeing also some weakness today on the session on the heels of some disappointment now expected from the Outback Steakhouse parent company.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is The Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to discuss Bloomin' Brands, which saw its third quarter report this morning and is taking it on the chin here a bit in real time. So joining us now is George Tillis, senior markets correspondent for the network. And so George, what went wrong here? Because I closely link this, of course, to Outback Steakhouse. This is, I mean, like the Bloomin' Onion is a great product, but not enough to resonate this quarter.
Yeah, not enough. I mean, if you think about what's been going on with the brand itself, I mean, it's very popular. I didn't realize they have about 1,400 plus stores, which include things like, Outback Steakhouse and Fleming's and so forth. There's a whole slew of different brands that they own, like the Wine Bar, another example. But nonetheless, I was looking at some of these restaurants in the past couple of quarters. I've noticed some downtrends in many. I mean, just Starbucks, for instance. Chipotle is another one. Faces some challenges. So these are, again, some macro challenges that a lot of these companies are facing with the more fickle customer and discretionary spending actually just being retraced back, and maybe people aren't spending much out and eating. But if you look at this company, I did notice in the last, like 5 years, for instance, it's down like 50 or so percent. So it's been sort of a secular thing going on with Bloomin', but I'll explain my thoughts about what the price actually means today in just a second. If you look at the adjusted EPS for the quarter, they actually beat the estimates, but they posted a loss of 3 cents. They were expected to lose 12 cents, but irrespective of better earnings than estimated, or the loss in this case wasn't as bad as estimated. Let's reframe it. They were still down because last year they earned around 21 cents adjusted profit. Now sales also for the quarter beat the estimates. They were $928 million, beating the 906 estimate, but they were only higher by about 2%. So those are good, things in terms of improvements versus the estimates. But comp sales, for the remainder of the year are still expected to be between 0 and plus 0.5%, irrespective of the fact that the quarter they posted comp sales that were higher by 1.2%. Kind of a mixed reaction, because if you look at the pre-market, there was some positive push higher, and then it just started selling off. So I think what's happening here in this name is a couple of things. As the price has been going down, the market capitalization in terms of dollars and cents has been falling as well. It's around $600 or so million. They have increased their debt load in the past 5 years to about $2 billion, so debt to equity is a little bit high. But they are still eking out a very small adjusted profit. And again, if you look at the non-adjusted profit, the GAAP profit I meant, that's actually one of the positive things I noticed in the last 4 quarters. But if you look at the guidance the company provided, they actually reduced for the full fiscal year the GAAP profits to now from 98 cents to between 75 and 80 cents. They also cut back their dividend, or just suspended it completely, which may be a good thing considering it was around 60 cents estimated, relative to $1 earnings on adjusted basis. So it seems to be moving in the right direction. Let's just put it that way, in terms of right-sizing the ship. Because right now sales are still relatively low, very low single digits, and net income now is barely profitable. I always talk about how these metrics, when they're at that flatline level, you can see reversals, not just on a quarterly basis, but really from a business basis. So any cost savings initiatives the company provides, maybe shutting down some unprofitable stores, this one may be worth watching going forward.
Yeah, and I know that the restaurant space has been fairly challenged this quarter, so not necessarily abnormal to see a move to the downside, but obviously, I mean, a substantial move at that, which has been not so great for the company that does operate several brands that are pretty major to us all here in the United States. So appreciate it, George, for that breakdown. That will also do it for us for Next Gen Investing for this Thursday. We will watch this next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com.
What do you like to do? I know you like to watch movies. I know a bunch of something about you already, but I like music.
Good afternoon. Welcome to the Watch List, live from the Schwab Impact Conference here at the Colorado Convention Center. Over 5,000 people, around 5,000 people, the largest ever Schwab Impact Conference. It has been very exciting, a lot of great conversations, and we have a big show for you today with a lot of heavy hitters too. We'll discuss the topics here, the rise in retail options trading, option strategies for every type of investor. We'll break down Schwab's ETFs and beyond study with the team from Schwab Asset Management. Our panel ready to discuss portfolio positioning strategies for 2026, the outlook for the markets. We'll be kicking off our show with Liz Ann Saunders. So I know you'll want to hear more from Liz Ann in just a moment. She's standing by, ready to go. In the meantime, just a quick look here at the markets. We know tech has been the topic of this week, getting hit hard. We had some comments early in the week from Goldman and Morgan Stanley, from David Solomon and Ted Pick, talking about some cautiousness in the market. Names like NVIDIA and Palantir and AMD getting thrown around. Here's a look right now at the markets. The NASDAQ, the worst of the bunch, which is down about 1.5%, but down arrows there across the board. Still, the S&P 500's, about 2% or so off the all-time highs. So that shows you that, some of the guests who come on want a little bit of a pullback. We'll have some of those conversations. Here's a look at some of the commodities. Bitcoin, for example, has also been somewhat volatile. We've seen that above 125,000, below 100,000. Right now, sitting just above the 100,000 mark. And there's a look at the rest. You can see there oil and gold, and also the 10-year bond yield, which has ticked just slightly, now at 4.08 there. And we've seen that in a swing over the last week or so. It was below 4%. It was up to 4.14. So there you have it. Let's bring in Kevin Hicks, host of Fast Market here on Schwab Network. It's also day 37 of the government shutdown. we're taking a look at Qualcomm is lower. It did have some good news within the report, but it's showing some weakness. Tell us about that, Kevin.
Yes. Hi, Nicole. Qualcomm down about 3.3% on earnings that did quite well, $3 versus $2.88 estimates. Revenue $11.27 billion versus estimates about $10.79. They did take a charge that lowered their overall earnings, their GAAP earnings per share to about $5.01. But I think, remember, this company, Qualcomm, they announced that they were going to get into GPU chips, and the street got very excited about that, Nicole, as you know. Now they announced in this earnings release that they won't see any returns from that until 2027. And so I think the overall enthusiasm about those chips, remember, it gapped up that day and has slowly worked its way back down. So Qualcomm, good earnings, but this has always been a head-scratching stock for someone to follow, Nicole. Good earnings, stock trading a bit lower on a charge that hurt their earnings per share.
And then we saw DoorDash selling off as well after its quarterly report. Tell us about that story.
Now that's a much bigger number, and this another company that put up relatively good numbers, but this gets into that CapEx spending. They put up good numbers. So here's the numbers. Total orders increased 21%. Revenue rose 21%. Marketplace gross order volume grew 25%. GAAP net income increased 51%. All these great numbers, but they said they're going to spend hundreds of millions of dollars on different initiatives, and the street didn't like it, Nicole. And so I think, remember, we're starting to hit that inflection point with some of this CapEx spending. The street really didn't like that DoorDash said how much money they were going to spend, and there's worry about the overall consumer, right? If they're cutting back, if they're trading down in terms of their price, maybe one of the first things they're going to exclude is the delivery charge, Nicole. So pretty substantial sell-off here in DoorDash today.
And we heard some concerns, Cava, Chipotle. Thank you. Kevin Hinks, great to see you there live at the CBOE. And it's time now to take a look at the bigger picture. We have a very special guest, an esteemed guest with us, and that is Liz Ann Saunders, Chief Investment Strategist, Schwab Center for Financial Research, here with us today. How are you enjoying the conference?
This is such a fabulous event every year, and it's big, but I love this event. The energy and the enthusiasm, it's infectious.
People love having the conversations, RIAs, wealth managers, asset managers. It's a great time to get together and hear some of the trends that have been going on. What are some of the folks talking about right now with the market? What are you watching?
I would say the two subjects about which I'm getting the most questions, and I'm not going to surprise you here with these two, AI and tariffs. A few weeks ago, pre the Fed meeting, a lot of questions on what the Fed would do. That seems to have died down. But in general, most of the questions that I get are macro, they're big picture. There's not actually a lot of questions that's really market specific, leadership, sector kind of stuff. So there seems to be more of a focus on the macro.
Within your notes, you talked about AI and actually some of the debt that's been building up versus the cash flows of yesteryear. That dynamic's changing a little bit, right, when we're seeing the balance sheets?
Yeah, so this boom, and I hesitate to, at this point, call it a bubble, but the boom in AI has largely been financed out of cash flows. It's been an equity-financed boom. But in the last 6 quarters,
just bullish divergence right here the whole time, right?
7 has gone from up more than 60% to now 2 quarters in a row in slight negative territory. So you're seeing more deals that are debt financed. Now, some of that is also because of a change that came about through the One Big Beautiful Bill in terms of interest expensing, shifting from EBIT to EBITDA, which is a sort of policy supportive of debt. And me mentioning this is not a signal of impending doom, but it's a changed backdrop to how this ongoing boom is being financed. And I think it maybe is adding a little bit of angst into the picture that has just escalated in the last several days.
And it's so different than what we were used to prior. And you're seeing that circular funding and the billions from me to you to this one to that one, and even OpenAI looking to the government but they're out, offering billions to make deals. So it does leave questions for folks, but the AI boom and the AI excitement and the growth that we've been seeing in the AI names, the Max 7, and the trickling out to some of those others, still seems to be on board. And while some of the folks I speak with talk about pullbacks, they still say buy the dips. Is there a big picture thought or strategy there just now, or not yet? I mean, I know you always look for value too.
I think we could be in maybe a more volatile phase for the mega cap AI related names. We're even in small cohorts like the Mag 7. We're seeing wider dispersion, bigger spread between the best and the worst. There's only 3 of the Mag 7 right now that are outperforming the S&P on a year-to-date basis. And interestingly, as of yesterday's close, Alphabet just leapfrogged NVIDIA to be the best among the Mag 7. But
how's everybody doing?
It's ranked 40th from a price performance standpoint in the S&P. So one of the messages I always like to impart, especially when we're dealing with an audience of people who deal with individual investors, is I think there's conflating that happens in the minds of individual investors when they hear about and they talk about cohorts like the Mag 7, the concentration problem. They have this sense that these are the best performers. They're among the biggest contributors to cap-weighted index gains, but that's largely by virtue of the multiplier of their cap size. They're not the best for us. So there are places in the market.
I'm here for you guys. What's up?
To find performance. You don't have to bring that same kind of concentration risk into your own portfolios.
So then I have to ask you, how do you find performance? Because you talk about folks being so heavily concentrated in some of those names. And also, as they've grown, you have the biggest gains, and then they now are even a larger part of a portfolio, and people want to diversify. So tell me about some of the other areas that you think might be a good way.
I believe it's already starting to come into clearer focus. A little bit more of a shift in attention toward the usage of AI and the companies that are effectively bringing AI into their business and putting meat on the bones of what it means for productivity. It effectively, in the era of QE and zero interest rate policy, that lowered the cost of borrowing. It lowered the cost of capital. It brought about the era of financial engineering and stock buybacks. AI is lowering the cost of work. And so it immediately goes to company bottom lines from a margins perspective. So I think there will continue to be now a lot of focus on that as opposed to the initial focus on just the hyperscalers. Then we saw the shift more into data center focus and the energy needs. Now I think it's going to be more about who is effectively using this at the industry level, at the company level. So that's one way to think about where to find opportunities.
And there may be new jobs for AI, and there may be jobs that are discontinued because of AI.
We're in an era of creative destruction right now, to quote Joseph Schumpeter. That's natural. That happens through periods of innovation. I think, though, that I agree with you. I think ultimately you create brand new jobs that didn't exist before. But I also think at this point, AI and large language models replaces tasks more than entire occupations. And I think that's maybe a more benign way to think about the disruption that it's bringing into the mix from a labor market standpoint.
Right, and that sounds more positive. It's not a doom report.
I'm not a doomsayer as it relates to the labor market side of things. But not whistling past the graveyard either. I mean, there will be disruption. Yeah.
Understood. You also talked about as these companies are taking on more debt, how the market breadth. I mean, are we still in a healthy situation?
Market breadth is not great. So actually a week ago, last Tuesday, was the single worst day of breadth on an up market day in history. Now, the history of that data only goes back to 1990. It's still 35 years worth of data. And breadth does not look great. There have been a lot of divergences happening within the market, very weak participation. And that's not just very recently. Over the past 1 year period, only 17% of the constituents breadth would certainly find its way to the top of the list.
And that goes back to your diversification and looking for value in other places and other AI productivity names. And I also think about earnings season, and we've had a lot of beats. There's been some lowered expectations. What's the takeaway? You look at guidance, your thoughts?
In the aggregate, earnings have been phenomenal. So right now we're well past the halfway point. What is the blended growth rate, which is a blend of the results for companies that have already reported with the consensus estimates for those that have yet to report. That's running at about 17% right now. That is about triple where we were before the start of earnings season and well above where the growth rate was in the first 2 quarters of the year. But what we're seeing is a little bit of a change in the margin for error as it relates to beats. The stocks that have done really well are only those that have beaten significantly. If you miss even slightly on one metric, that's where the punishment comes in.
Thank you for your perspective. All right, we'll leave it there. Thank you, Lizanne. It's great to have you on because it's always, tough to navigate markets, and glad to have your perspective. Lizanne Saunders, Schwab Center for Financial Research. Coming up, we're going to discuss the increasing prevalence of options trading strategies for every type of trader, investor, all the things that you want to know. The watch list from Schwab Impact. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe.
Everything is getting a bounce. Market is bouncing. I'm looking for a retest up here too eventually.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a
Carl's Way
I decided to be bearish in the morning.
Is it?
And then
At
reverse
Schwab,
it
how I
again.
choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
Now they're trying to reverse it. Looks like a trend.
Where are
Looks
you
like
going?
they're trying to reverse this trend. I just don't know. I don't know how long the bulls are gonna last before they reverse all this again.
Opportunities don't stop when the market day ends.
Somebody
So
found
never
the
do
bottom.
it.
Everybody's on the bottom
Schwab
right.
gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Welcome back to the Watch List, live from the Schwab Impact Conference, where we're ready to talk about some of the hot trends in trading. And now, time to discuss the increasing prevalence of options trading. And we welcome in some pros. Our special guests are with us here today, and we're happy to have with us Devin Anderson, co-founder, CEO of Convexitas, and also Zed Francis, co-founder, CIO, with us as well. Zed Francis, Convexitas, and Devin Anderson, Convexitas as well. Great to see you both. Thank you so much for being with us. So Devin, I'll start with you. We were just talking about the excitement that we've been seeing in options trading that we did not see 5 or 10 years ago. What's going on?
So I'm, even as someone that's founded an options business, when I walk around Schwab Impact, I'm kind of impressed at the amount of engagement around options usage, and it really makes me very bullish on the space and our products. I will say though that I think if I were an advisor, I'd have a really tough time deciphering this world, right? Schwab's giving presentations about self-implementing strategies. There are managers here, there are ETF sponsors here, all kind of in this option space. And I feel like the volume around all of it actually really rallies like the AI excitement. So, one thing that makes us, it gives us a lot of excitement about our world, but also, we're here to educate and really try and help investors understand.
They get no volume.
Use these different tools. How do I interact?
All the volume
with
they are getting, they are getting is bullish.
Of the firm, and
It's
we
great.
were saying that it used to be buy low, sell high, or buy and hold. Now I hear more and more, you can't trade without trading options. Is that a thing?
Yeah, retest, rejection.
Telling folks, because there are
There
some
needs to be
risks and
support.
there are rewards.
There
Tell
needs
us
to find
about
support
that.
up here.
I mean, it's gone from a little niche thing to, over the last 2 years, it's almost mandatory to at least have a little bit of knowledge of how to utilize options in portfolios. They're not appropriate everywhere. We actually have to be educated to make that decision. Should this be in there or not? And ultimately, to distill it a bit, option style strategies fall into like 3 main categories. Let's say number 1, hedging, taking down risk of current exposure. Number 2, leverage, increasing exposure in certain areas using options. And finally, number 3, kind of like fixed income replacement, derivative income products. Like, how do we use options to create distributions? But like in each of those categories, there's very important kind of do's and don'ts and things to think about for your specific client portfolio and especially
Slow down.
When we think
Blood didn't want to break out
what's
here.
going on
Go
in
higher.
you talked about 3 ideas, very general categories, but we can get into them more because there is risk involved, but there's also a risk reducing strategy too, right, Devin?
Sure. So one of the most common use cases is to manage risk, right? And when you think about how to begin that research as an advisor, we kind of think about it in 2 broad buckets. If you truly can take a position and do a collar, self-implement some trade, and stick it in a drawer and not touch it for a year, and be okay with that, truly, by all means, like you should do that. It'd be very efficient, right? But the reality is most of our clients, and I think most advisors, are accountable to their clients, and they're accountable on a much kind of more frequent basis, and they need an active risk management. And this is where managers like us and some of these ETF products start to come in. So that's when you need to start looking at, should I be allocating to a fund? Should I be talking to an SMA manager like Convexitas?
And we also, you mentioned derivative income strategies. Tell me a little more about that part of it.
Yeah, so, I mean, it's definitely exploded as a category. And I would say one of the main things when reviewing derivative income style strategies is making sure that the actual income you're receiving is new capital, not distributing your current capital back to you. So ultimately underlying that is you need the strategy from a total return perspective to actually make enough money to support those distributions. And a lot of the fanfare of late has been created by the fact that the distributions are very, very elevated
but ultimately the total return of the strategy is less than those distributions. So the ETF, or most ETFs, are actually just giving you your own money back. So it's confusing to the end client where, hey, there's these really big numbers. Why are we not looking at this ETF to replace traditional fixed income exposure? You're like, well, let's look under the hood. Let's make sure it's actually creating new value to create those distributions.
I think about the days where they talk about options volume and it was a record day, and we have those from time to time. And not that long ago, it was a Friday a few weeks ago, that we had such heavy options volume trading. What does that tell you, either pro or con? Because it gives you a glimpse into how people are positioning too, right?
So it tells you that more people are using options.
That's true.
That's the only thing I can tell you definitively. I'll tell you, as a professional and someone that used to have a very active role running a structuring desk, an active role in a strategy group at a bank, it's very hard to take that volume apart and say what it means, right? You have to segment it up, you have to make a lot of assumptions. I mean, I think there are definitely some trends that we can say for sure. The short dated, what Zed's talking about, the short dated derivative income trend, particularly, it's now kind of coming into the 0 day and very short expiry world. Undoubtedly, that's grown the most. Retail use of very short dated options, 1-2 day expiry options for directional trading has yes, that's actually accounting for most of that growth, right? So I'm, forgive me the number, but I want to say something like 60% of the volume growth is in like 0 and 1 day options, right? So that's not coming from institutional players, right? It's coming a little bit from funds, but it's mostly coming from true retail participation. So that's a dynamic that didn't exist when Zed and I started our careers in this business 20-ish years ago. Our firm is now 4 years old.
Right, and you co-founded this together. And I'll give you the final word here, because we also, people like to have a strategy for investing. They think it's a good economy, a bad economy, when the markets are going higher or lower. A final thought.
Yeah, I mean, again, ultimately, you got to figure out the goals you're trying to achieve, and you got to make sure that the tools you're using to achieve those goals are providing the intended benefits that you're hoping for. So when it's risk-reducing hedging, make sure those tools are incredibly tax efficient and give you actionable liquidity when the nasty things happen. That's the point of the diversification agent. If you're using it for leverage, make sure it's a very cost-efficient leverage within the portfolio. And when it's, distributions, income type of category, make sure it's actual income and not just giving you your own money back.
That's a lot to take in, but it's such an important growing part of the market, as you both just explained to us. It's great to see you both. Zed Francis, Convexitas co-founder, CIO, and Devin Anderson, Convexitas co-founder, CEO. Thank you both for being with us and giving us more looks into options trading. Thank you. Great to see you both. Coming up, we'll discuss Fed policy, because what will the Fed do next? Of course, they cut in the last meeting, but what about the December meeting? And if you're investing, how about looking at fixed income too? What do you need to know? All of that next here on the watch list.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back, friends. This is the Watch List. I'm Nicole Petalides. We are live here in Denver at the Schwab Impact Conference, and it's at the Colorado Convention Center. 5,000 people, and a lot of exciting guests we've had on. And I want to bring in Lauren Pearson, co-CIO, portfolio manager, Baird Funds. Thank you, Lauren, for being with us.
Thanks for having me.
So I know you're having a lot of conversations with folks, and the market is near highs, not at highs, but near highs. But there's been a cautionary tone lately. What are some of the conversations you're hearing, and what's your guidance these days?
We're a bond manager, so it is interesting because we think there's good value in the bond market for investors, but it's primarily the level of interest rates. You know, as a professional manager, it's not the most exciting time to be managing bonds. I mean, yield spreads are pretty tight. I mean, it's not a smorgasbord of opportunities.
Right.
You know, fairly, not terribly attractive opportunities. So, but still opportunities for investors.
Well, there's always opportunity, right? I've heard a lot of folks moving away from short-term bonds. I mean, when you're looking for quality, you're looking for duration, what do you tell them?
Yeah, we think what we've said is, given that yield spreads are pretty tight, you don't want to be over your skis in terms of your risk exposure. So I think intermediate maturities are good. You know, some people have been short. The yield curve, there's some positive slope to the yield curve now, so moving out the yield curve makes some sense. But I think we caution people not to go too far out the curve. So that intermediate space we think represents really good value for investors overall.
Let's talk more about the yield curve. I mean, of course, we've had the Fed cut rates, so they may cut now. You're looking at the short term versus the long term. What is the yield curve telling you lately?
Well, it's positively sloped after being inverted for a couple of years. It was a long inversion. We think it will continue to steepen a bit. The Fed will lower short-term rates. You know, a lot of question as to how fast. We think they'll ultimately probably target a neutral rate of around 3%. So we still get about 100 basis points. We'll let others decide how quickly they'll get there. So we think short-term rates will probably come down a bit more. But I think with the deficits and the heavy treasury supply, there's probably some upward pressure on the long end of the yield curve.
And, you know, we have inversion. That's what everybody starts to get worried about. Recession. And how are you feeling about the economy now? Because the Fed has its next meeting. Do you have any thoughts on the next meeting?
In our opinion, the economy has been amazingly resilient. You know, the inversion, people thought it was going to be a done deal that there'd be a recession, and we really didn't get that much of a slowdown. You're starting, you know, today the headlines, the challenger job cuts were a little bit bigger than expected, so the labor market is definitely cooling down. And it's, you know, it's just kind of this bifurcated recovery for the K recovery that people talk about. For most Americans, that you have an investment portfolio and you have a house, things are pretty good. But, you know, those that don't, it's much rougher. So overall, the economy is still chugging along. We think it's, you know, reasonably, probably will continue at a reasonable pace.
And the challenger number was a bit dramatic. I mean, it's certainly, you look at it and you say, whoa, so many layoffs. And, you know, those are layoff announcements. They're not necessarily layoffs, or they may be cutting of jobs that were posted and now will no longer be posted. But we're not getting data. You know, we're on day 37 of the government. Yeah, so, you know, it's always nice to have the challenger numbers, the ADP numbers, the ISM services numbers. We've been getting a lot of numbers, but, you know, everybody, tell me more about that kind of situation for you in your business, the Fed trying to make decisions.
Yeah, all those kind of monthly numbers, the employment report and others that you rely upon, you know, there's a lack of data, so you kind of have to go with, you know, what you're feeling, what you're reading from context. And our sense is that, you know, the economy continues to grow, but longer term, we think it's got fairly limited growth potential. You know, lower, you know, 2-ish%. And a lot of it has to do with demographics. Our labor force is not growing, and it's hard to grow the economy when your labor force isn't growing. So I think there's going to be an increase in productivity, but you put those two together and
we've already seen some of that, right?
I think AI, you know, is increasing productivity. Whether that will increase nominal growth remains to be seen. I think it helps companies, you know, retain their profitability and find additional ways to produce profits. But in terms of overall economic growth, we think it's long-term fairly limited potential for the economy.
And I wanted to ask you about corporate bonds, munis, but first up, the financial sector overall. The health of the financial sector, what stands out to you?
We like the financial sector. As bondholders, there's good value there. Financial yield spreads typically trade tighter than industrials. They've been wider really since the global financial crisis. That's coming back in line, but we still think there's probably some value for investors in the financial sector and in good shape overall. Banks are in good position. Their balance sheets are strong. So we feel that's one sector we've been overweight. We continue to have an overweight there.
And we look at corporate bonds, munis. Sometimes these areas are hot or not. Munis in particular I'm thinking of. Tell me a little bit. Let's break it down. Let's start with the corporate bond story.
We like corporates. We have a modest overweight. We're comfortable with the fundamentals, but the yield spreads are at near historic tights. So you're not being paid to take a lot of risk. So we're overweight nominally, but taking more of that overweight on the shorter end of the yield curve.
And munis are making a comeback, aren't they?
Munis had a very good third quarter. Munis looked pretty cheap the first half of the year. We still think they're attractive, but they made up for a lot of lost ground in the third quarter.
And when you're talking to folks here and giving them your outlook, sort of more long-term, how do you feel?
We feel pretty good about the opportunities in the bond market. We're not looking for a dramatic change in interest rates. We say there's value not because we think rates are going to plummet, but just because bonds are producing income. Investors are owning bonds for the reasons they have historically, that they produce attractive levels of income. But we don't see that changing. And even if interest rates were to come up a little bit, I think investors would invite that.
What about international bonds? Do you look at that much or not so much?
We focus most of our attention, in the U.S. And I know international has had a lot of headlines. The dollar has fallen, so those returns have been sort of catapulted by the decline in the dollar. But we really feel there's pretty good opportunities right here in the U.S.
And I just wanted to talk more about your U.S. strategy. If you were talking to somebody who was coming in and maybe newer to this, what would you advise them to definitely maybe have in a portfolio for the longer term?
Well, want a diversified portfolio. And especially now at this environment, the things we do right now are not going to add value right now. We're thinking forward, and I think we're a bit cautious. A lot of the value we will add over the next couple of years is probably some of the things that we choose not to own and choose to underweight as opposed to what we just overweight. So I think to have a balanced approach, not take too much risk. You're not being paid to take a lot of risks, so don't try to squeeze blood out of the turnip and get overly aggressive. That usually doesn't work out in the long run too well. So I think to be in kind of an intermediate, higher quality bias makes a lot of sense right now.
And then last question on the Fed. We don't know whether or not they're cutting at the next meeting. It's gone back and forth because when Stephen Myron said 50 basis points to cut, everybody sort of expected that. But when Schmidt sort of held back and said, I'd like to keep it flat, that opened the conversation as to what the Fed may or may not do next. And you also had Goolsbee today saying, I'm a little nervous to, I'm paraphrasing, to cut during the government shutdown. We don't have that much information. Do you think the Fed should be cutting now, next year, or no?
I think they're going to take a cautious approach, and they're doing what they said they would do from the beginning, that they're going to be data dependent. Watch the data. So it's a little bit of a foggy outlook. I think that probably lends them to be a little bit more cautious. The Challenger cuts today. Clearly, if employment is softening, that will give them a little bit more impetus and maybe more likelihood that they'll cut in December. But again, we try to step back and not try to make the play-by-play in the short run. But I think over the next year and a half, I think you're going to see the Fed lower rates a bit more.
Oh, so more to come. All right, Warren, great to speak with you today. Thank you so much for being with us. Warren Pearson, co-CIO, Portfolio Manager, Baird Funds. Thank you for joining us on the show. All right, still ahead, we're going to take a look at ETFs, some of the strategy there. We'll talk to the team from Schwab Asset Management following the ETF and Beyond study that they have for us. The watch list from Schwab Impact Live. We'll be right back.
sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. We are here live at the Schwab Impact Conference in Denver. It's been packed. People are talking, and we're seeing different trends and exciting conversations. RIAs, wealth managers, asset managers, 5,000 people. Such intelligent conversations, and how the trends are changing. And one trend in particular, increasingly popular, you well know this, and that's ETFs. So let's welcome in a pro. We have David Boxett with us, Head of Strategy, Innovation, and Stewardship at Schwab Asset Management. David, this is the time. 5-10 years ago, ETFs were not as hot. Now we have record inflows this year, right?
Record inflows. We've already gotten over $1 trillion in inflows through the month of October. It's amazing to see those flows really coming in and investors really scooping up ETFs.
It's amazing, is right. I don't want to talk about some of the volatility just yet because, I do want to know, are people getting nervous or pulling out of it? But the trend has been people want to be in ETFs. Why?
Well, we just finished our 14th annual ETF investor study. And what we've seen is two things. Momentum continues to grow in investors wanting ETFs, and they want low cost. And ETFs provide that efficiency and low cost.
And so many of them are actively managed. It used to be you went to a mutual fund for actively managed. Now, tell me how ETFs are evolving.
Yes, actively managed ETFs are really evolving in the industry. They represent about 10% of the overall AUM, but they've captured nearly 30% of flows this year. In that study, we ask investors, what is your preference? They really look for those less efficient asset classes to find active management in the ETFs.
So the ETFs and beyond study, you told us one of the takeaways. Tell me more about that, because it's the 14th annual study. What are some of the questions in that? Give us more from that.
Yeah, so we asked them, how do you choose your ETFs? What are the key factors you look at? Number one, every year is cost, right? But what we're seeing is increasingly the other factors like performance, the brand and reputation of the asset manager are increasingly competing with where cost is at.
It's interesting because people want to be diversified, and ETF gives them that. They're not in one particular stock, and it's not just equities. I mean, it's a lot of things. It's gold, right? Have you seen interest in gold ETFs?
We have. It's interesting because we asked that question about niches or themes and what they're looking at. So things like commodities, cryptocurrencies, thematic plays. When you look, you ask them, well, then how are you using in your portfolio? We see a combination of core and satellite. So they're not stepping completely into those categories, but still looking at ETFs at the core as well.
And fixed income.
Fixed income.
Bonds, right?
Absolutely.
I mean, what's the variety there? What's some of the demand that you're seeing?
Yeah, we've seen a lot in the U.S. fixed income. What we're increasingly see is international fixed income is becoming a bigger part of their portfolios and getting that access through ETFs.
When we talk about active versus passive, you were talking more about the active side. Passive still is a good way to invest too, no?
It is, and it really helps.
It's active. Passive is still very lucrative at times, right? Well, why?
It is, and we have to remember that you can use an index-based product but still be active in how you're allocating. Whether you may be tactically tilting based upon a view in the marketplace, but doing that using index-based products.
What about AI-based or tech ETFs? Tell me about some of those.
Yeah, so we are seeing really good interest in those tech and AI-based. We'll actually ask a question. Do you use what's happening in generative AI as an opportunity to invest? Many times we're saying, yes, I'm using that time to increase my allocations to these thematic ETFs.
And what about crypto?
Crypto's really taking off.
And we're seeing a lot of flows, a lot of interest, especially from the younger investors. Not surprising. We do the demographic breakdown. You see the millennial investor has a higher propensity to think about using crypto in their portfolio than the older investors.
I had a great conversation with Rick Worcester here at Schwab, and he talked about more products coming in the new year because it's prevalent. The demand is hot, right?
It really is.
Always have something in their portfolio with crypto.
They are really looking for that. And things like exchange-traded products that provide the crypto access today, it really is an accessible way where you're not dealing with the hot wallet, the cold wallets, but it's a wrapper that they're already familiar with and comfortable with.
Are people willing to take risk, whether it's the leveraged ETFs, the 2 times, hey, if I go up, I get 2 times, if it goes down, it's 2 times, and then they have margin calls and things. People know what they're doing. You don't want to be gambling, you want to be investing and be smart about your trades. But that's still very much a thing, isn't it?
It very much is, but we also ask in the survey, how are you using ETFs? Over 50% of the respondents indicated they're using ETFs to the core of their portfolio or core and satellite. So from the data we see in the survey, it appears that they may be using those type of products, but it's not the entirety of their portfolio. Smaller allocations to get that type of exposure.
Do people stay in the ETF that they choose for a long time? I mean, they're not going in and out of ETFs. I mean, it's not like canceling your streaming. I saw my show and canceling it. I mean, people stay in their ETFs, right?
Generally speaking, that's what the data shows. They tend to buy and hold, and then they'll be doing rebalances over time.
And then they talk to Schwab folks and get some strategy, I guess. For a younger person, are there ETFs that you recommend? Or, what kind of strategy do you go for?
We have things on portfolio construction. We like to bring both A and what we call A and B together, and that's a combination of market cap weighted portfolios and fundamentally weighted portfolios to really blend together to build a diversified portfolio.
I mean, the other thing is that you can have an ETF with a variety of things in it. I mean, there's always large cap growth and small, but there could be international or, Asia, ex-China, or just China, or whatever, right? I mean, are you seeing the demand for abroad or emerging markets? Or
this year's been really strong internationally. If we go back 5 years, international markets has underperformed the U.S. markets. So we saw much less utilization in the international space. This year, with international markets really roaring back, we've seen an increase in the allocations to those international products, both developed markets and emerging markets, looking in some cases to the small cap internationally as well.
Are you seeing outflows at all by the this sort of back half now?
We haven't really in a big way seen outflows.
And then do you think next year could be record inflows again?
Well, it's really hard to predict the future, but where we are, I would say there's a chance of that for sure.
And how are you feeling big picture about the economy, the market? What's the strategy there?
Well, I think things are going really, really well. I think there's a lot of conversation here at Impact, like, are we in a bubble? Are we at a peak? It's really hard to ascertain if it's really a next leg up from here, or are we at a level that should be a little bit concerning.
David Botzett, Head of Strategy, Innovation, and Stewardship at Schwab Asset Management. Thank you so much for being with us. A good look there at ETFs and big picture. All right, still ahead, our panel is ready, standing by to talk about your portfolio. Get ready, how to position for 2026. We'll have all the details. We bring in pros next here on the watch list.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Schwab Network delivers real-time NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Welcome back to the Watch List. We're live at the Schwab Impact Conference. I'm excited for this panel. We're sort of wrapping up a couple of big days, and we want to talk about positioning your portfolio for 2026, the strategy. And we bring in Dylan Ross, Portfolio Manager, Head of Asset-Backed Finance at the TCW Group, and Brian Bendig, Chief Investment Officer of MJP Wealth Advisors. Thank you both for being with us. So, Dylan, I'll start with you. Are you feeling like there's always opportunity? Is there always something that you could put in a portfolio? Even though we're near the highs, people have been feeling a little nervous lately.
For sure. So asset-backed finance offers a pretty consistent complexity premium and does it in vehicles and investments that are also pretty short duration. So what that means with an environment of pretty high valuations and lowest spreads, it means that you can generate some excess return per unit of risk while you wait for broader dislocation. And asset-backed finance really can provide pretty stable sources of low vol yield, which we like a lot.
What are people requesting most, or what are they most interested in lately?
Yeah, so there really is this idea that our clients are focused on in the fixed income replacement world. So, you know, if you've got your 60-40 portfolio, you've got your retirement account, and your credit allocation is at all-time low spreads, right? Investment grade spreads are, you know, well inside of 100 basis points. If they can exchange that daily liquid product and go out the liquidity spectrum 1-2 years at most, and they can pick up 200-300 extra basis points, that's what our clients are focused on now. It's like, how can I build some extra yield into my portfolio in a thoughtful profile that has a lot of downside protection?
And Brian, tech has been so exciting. We've been seeing that boom, but there's always, is there an AI bubble? Market breadth has not been particularly great in the last few weeks. So what are people asking you, and what do you tell them for 2026?
Yeah, no, that's a great question. There's so many things right now that I think are on investors' minds, just with uncertainty around policy decisions. Where are valuations going? Is it time to be a little bit more protective, or really think about next year from an opportunity point of view? We look at things from the standpoint is we're not necessarily looking to fade tech at this point. You know, if you're invested there, I would say it's more of complement that growth piece of the portfolio with the cyclicals, with the value. Look at mid cap, look at small cap, because the economy, and again, there's nervousness this morning, of course, on the jobs, you know, private jobs data that came out, but I don't think that's necessarily an indication that the economy's going to a recession. So I look at earnings. Let's look at the path of earnings next year. We're still expecting 13% year-over-year EPS profit growth for companies, and we're looking for more contributions in the economy coming from areas outside of tech. So I think the classic stay diversified and make sure you're not overpaying for growth, that's the forward looking for next year. Don't always chase the big winners.
And we've been seeing more diversification into alternative investing, private investing, and that's something you've been talking about as well.
Yeah. So, look, private credit and private assets have really shown themselves to be an efficient financing form for borrowers and companies, right? It's bilateral, it's flexible, it gives companies a degree of certainty to finance their businesses in a way that's optimal, but then offers investors and companies like us and funds like ours that lend the money can provide us meaningful excess return. And the lines between public and private, certainly in the world of asset-backed finance, are becoming much more blurry, where we can simultaneously be trading in an issuer's public bonds in the mortgage-backed space, for example, but then also provide that same borrower a bilateral custom loan that feels like a single A bond, but offers 300 excess basis points.
And today we actually, Charles Schwab buying Forge Global, $660 million deal. That'll give folks, it sort of gives people who didn't normally have access to private companies. A lot of companies are staying private longer, not necessarily going for an IPO. Gives them that way to get in there and celebrate the wealth and the growth that sometimes we see. Something you were focusing on, Brian, very interesting, is the CapEx spending. You talked about industrials, mid-cap, small caps. Tell me a little bit more about some ideas for 2026.
Yeah, for sure. I mean, the July 4th tax bill, I think, really provided an incentive for companies and CEOs to relook at their CapEx budgets for next year, because you get this extra bonus depreciation write-off. And what we've seen over the last several months since the tax bill was announced is an uptick in CapEx spending, focusing on infrastructure, focusing on, obviously, data centers, things around the technology space, but also just that electrification, trying to move to a more efficient grid, and also the onshoring of supply chains. So when we looked at CEO surveys for next year, the surveys are quite robust to say that CapEx spending is looking to go up. And it's not just a tech-driven AI boom, it's actually more of a reinvestment into businesses and people and processes. So I think that's something unique. And one thing I'll pick up on what you said about private companies, there are 3 times more private companies to invest in than public. So I think from an education perspective, when we work with our clients, we talk about alternative investment and a way to diversify, because you get a different return sequence in those private companies than you might see on a day-to-day basis in the public markets.
Great to see you both. Brian, Dylan, thank you very much. Dylan Ross, TCW Group, Brian Vending, MJP Wealth Advisors, thank you for being with us. And thank you, friends, for being with me here live at the Schwab Impact Conference. Continue to take a look on SheldronFrost.com. So many of the interviews will be replaying there. You keep it here on Schwab Network all day for more live programming. I'm Nicole Petalides. Thanks for being with us.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SheldronFrost.com.
It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange today. We've got a very busy day for you, so let's take a look at what is coming up on today's show. We'll have you covered for all things earnings after the close. We'll give live reaction and insight on reports coming up from Trade Desk, Airbnb, Affirm, and DraftKings. We'll bring those to you. We'll also be joined by the President and CEO of Charles Schwab, Rick Wurster, to discuss the company's acquisition of Forge Global at the Schwab Impact Conference over in Denver. And we'll dive into international equity performance and how investors can get access to and diversify their portfolio with international equities. But for now, Marley, take us through what you're watching today.
I'm keeping an eye on the biggest winners and losers today, Sam. Datadog, the top performer on the S&P 500, after posting beats on its top and bottom lines. The company also posted a better than expected fourth quarter forecast on demand for its cloud security products. We'll break down that full report for you shortly. But DoorDash is the worst performer on the S&P today after reporting a miss on earnings and saying it is increasing its 2026 spend by, quote, several $1 million. And then last story I'm watching, Eli Lilly and Novo Nordisk striking a deal with the Trump administration to significantly lower the prices of some of their GLP-1 offerings. The agreement will lower prices to Medicare and Medicaid beneficiaries, as well as consumers using the upcoming Trump RX website starting in 2026. Jenny Horn will join us shortly to break down some of these top stories. But before we get to that, let's take a look at where the markets stand as we near the end of the trading day. On the S&P, still trading down about 0.7% at 6750.52. For the Nasdaq 100, trading down 1% and a third right now, 25,290.75. The Dow down about 0.5%, 47,048.18, and the Russell 2000 down 1% and a third at 2432.22. The dollar under the $100 mark, about 0.5% down, 99.57. Gold at 39.95 troy ounce right now. That's mostly unchanged. Crude oil trading at 59.47 a barrel, and Bitcoin retreating further, down 2.33% right now at 101,810 for the cryptocurrency. I do want to check in with Sam though and see what top stories caught your eye today in New York, Sam.
Well, we've seen the airlines under some pressure today, Molly, after the FAA said it would cut flight capacity by 10% across 40 major airports in the U.S. And this comes amid delays and cancellations due to the longest government shutdown in history. The reduction in flights is in response to air traffic control safety and staffing concerns, as air traffic controllers have been working without pay. Reports suggest the disruptions will be felt at mid-sized airports. The airlines have been vocal on the government shutdown and are said to be working right now to really evaluate how this latest move will impact them and also updating customers. In another sign that the labor market is continuing to cool, Challenger grade Christmas data showing the highest October job losses since 2003. It reported 150,000 job cuts for the month. That is 183% higher on the month, 175% higher on an annual basis, making it the worst year for layoffs since 2009. While we don't typically pay a huge amount of attention to this report, normally the absence of the official government data and that headline makes people take notice. Now, Nvidia was lower today and has been that for most of the session, and that comes off the back of CEO Jensen Huang telling the Financial Times that China will win the AI race. Then he softened his comments in an official statement, saying China some of today's top moves. So I'll send things back over to you.
Yes, and thank you, Sam. Like you said, Jenny Horn joining us here in our Chicago headquarters, co-host of Next Gen Investing, to talk about some of these big stories we're covering today. First, let's start with this Eli Lilly Novo Nordisk deal with the administration. You know, they just announced this mid-afternoon today. We actually saw the CEO of Novo Nordisk faint in the middle of the announcement of the release for this new deal to lower drug prices. But walk us through some of the details and how it can impact consumers.
Yeah, this is really fascinating. So President Trump announcing agreements, of course, with Eli Lilly, Novo Nordisk, to reduce their prices for these GLP-1 based obesity treatments, which have seen, again, demand that has been unprecedented. So the deals will also expand to Medicare and Medicaid coverage for these treatments beginning in now mid-2026. In September, though, Trump announced the first agreement with a major pharma company, being Pfizer, to bring those prices in line with the lowest paid by other nations, known as the Most Favored Nation, or MFN. So in October, we did also see AstraZeneca ink a new agreement to also help reduce its prescription drug costs. But companies now will provide their GLP-1 medications, which does include Wegovy, Zepbound, to Medicare and Medicaid for $200.45 a month. Medicare patients will pay a $50 copay for the approved injectables and the oral GLP-1 drugs, but the starting doses of existing injectables like Wegovy and Zepbound will initially cost $350 a month on Trump RX, declining to then $245 within 2 years. And then those oral versions, which have been, so sought after by investors because we've really traded around so much of the hype regarding those also are expected to come in cheaper. Novo Nordisk's oral Wegovy and Eli Lilly's Orforglipron are expected to be priced at roughly $145 a month, but through Medicare, Medicaid, or Trump RX. So Trump RX specifically does intend to sell drugs to patients at cheaper prices, hopefully without involving insurance, and that's the end goal. But right now we know that about 10% of Medicare employees, or roughly 6.6 million people, will qualify for GLP-1 coverage. So definitely making those drugs more affordable, but right now, even though, again, 6.6 million is not a small number, that's the right now expected, perhaps, like mass market share. This is still targeting a relatively small population. Hey, but at least a step in the right direction.
Yes, certainly. You know, the average cost of any of these GLP-1s roughly $1,000 to $1,600 a month. So any improvement for any amount of people who need this medication is a positive. Novo trading down on the day about 3 3/4%. Eli Lilly higher on the day, but another down day, DoorDash, our worst performer on the day.
DoorDash, a pretty brutal move to the downside here, and pacing for now a record percentage drop dating back to 2020. Now down about four of the last 5 sessions, 4 straight sessions. We've lost over 20% in that specific time frame, but expecting to ramp up its spending next year as we've seen sales growth accelerate in the third quarter to the highest rate actually we've seen in more than 2 years. Profits did come in higher than a year ago, but that figure actually missed estimates. While revenue climbed about 27%, that actually did beat. But marketplace gross order value, that's the dollar value of orders placed on the platform, leaped about 25%. And they did say, again, they expect to really invest pretty heavily on new initiatives on their platform in 2026 relative to this past year. And so in the midst of right now, overall just redoing a lot of the platforms that we use and of course that we know and love, they're trying to right now pace their global product development and boost developer productivity through these AI native toolings. What that looks like for their platform, I'm sure will just get more high-tech, more catered to us as consumers. But this did not resonate well. And right now we do see heavily adjusted EBITDA for now. The current quarter came in far beneath expectations, and that's also driving some of the pessimism today. When you give a range of 700 and 810 million, that's huge, and I think signals that you do expect some wiggle room to the downside here if your results do come up short.
Yeah, certainly. We saw this massive move to the downside. You know, they're down 16%. They were down, I think, as much as 20 at one point when I was looking. But interestingly, William Blair reiterated their outperform and isn't upset at all about their announcement for this spend. So, you know, the street today doesn't like it, but some of the analyst community is backing this spend. And we've seen a bit of a mixed story in response to spending numbers, depending company to company and analyst to analyst. But let's move to the flip side, to our top performer, Datadog, our unexpected winner.
I know, so tracking for its highest close since November of 2021, its best day since November of 2023, snapping now its 3-day losing streak. And I think it's amazing that even with a monstrous move, we're seeing 25% to the upside, that this name is actually still off of the all-time highs that were made back back in 21 by about just under 3% now. So third quarter revenue climbed 28%, that beat consensus. Adjusted earnings also topped forecasts. And they also did highlight that as of at least through quarter end, they have just over 4,000 customers with an annual recurring revenue of 100,000 or more. That rose 16%. Adjusted gross margin did remain flat at around 81%, while adjusted operating margins actually dropped by about 200 basis points to 23%. And they did really also highlight their accelerated AI push, launching AI observability and security products, as well as various security teams and new types of models that could help serve their customers better, raising now their fiscal 2025 earnings and revenue outlook, and also, for the fourth quarter, giving pretty stellar outlook, all things considered. This was a beat and raise quarter to its full extent. There was some concern from several notes I saw, but Guggenheim sticks out, saying that OpenAI being their biggest customer is at risk because OpenAI is going to shift to now its own in-house solutions. Obviously, this has not been paid much attention to today, though, as we're up 25%. Now Datadog was relatively up about 12% into this print. Now it's an outperformer, especially in a very challenging tech environment for earnings.
I saw that flag on concerns about the customers, but it has some big name customers too. Shell, PayPal, Comcast. Some big customers here for Datadog too. But will be interesting to see how this OpenAI story plays out for them. The last one though, they're up about 24%. This next company's down close to 24%.
CarMax taking it on the chin a bit here today, and they're trading in their CEO. So they did announce a surprise change at the top amid this weaker than expected now guidance going forward. So Bill Nash will be stepping down, leaving the board. That will take effect December 1st, according to the press release. They did name board member Dave McCreight as interim president and CEO, and they added that a search for a more permanent CEO is still underway. Now, alongside that, I think what's actually even more important to the fundamental story here is the fact that they announced a preliminary outlook for the third quarter, and it was not great. They did say they're expecting to earn roughly 36 cents a share. The street was projecting basically double that at roughly 70 cents a share on comps that are expected to drop 8 to 12% year over year. Brutal. And so there is, they said that right now they're trying to be preemptive. They're trying to overall really just sort of hedge some of the major turbulence facing the auto market, but also interesting to me that I've seen overall lots of analyst notes highlighting that actually Carvana is stealing away this coveted market share, whereas CarMax is still bigger, but right now they're losing to Carvana, which I never would have thought those words would come out of my mouth. We used to talk about that company's ability to grow, ability to have proper cash for its operations, but really becoming a strong player in, of course, the used auto space.
Yes, certainly. They mentioned sharp depreciation in their wholesale business too, and they increased their marketing spend. So just a lot of overhang for CarMax and Carvana coming for some of that share. Jenny Horn breaking down some of our top movers today, co-host of Next Gen Investing. Thank you so much, Jenny, for being with us today. I do want to check back in with Sam, though, and see what we have coming up for the rest of the show. Well, Marley, we'll head over to the Schwab Impact Conference in Denver.
Oh, my goodness.
Ladies is standing by with Rick Wurster, the president and CEO of Charles Schwab.
What a day.
The company's acquisition of Forge Global and more. Mark Velcos will be right back.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your
not
way.
too much longer.
Sounds nice, right?
I was just going to ask you what you'd like to do.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor?
Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on
we got
demand.
45 minutes to
Go
go.
to schwab.com/coaching and start learning today.
Everything is still in the red. They didn't recover.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live. Subscribe free at SchwabNetwork.com.
That's a good bounce.
Welcome
Really
to
insane
Schwab
spot.
Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Market on Close. I'm Sam Vardas on the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. Let's just check in where the markets are standing right now as we, of course, approach the closing bell for this session about 45 minutes away. And we, of course, have seen risk off across the major indexes today. The S&P 500 tracking low by 0.7%. Suffice to say, off the session's lows, but still seeing red arrows across the board. It is very much a down day for technology. That is where we are seeing some of the most pronounced losses. And so the Nasdaq is trailing by 1.4%. The Dow getting hit by about 0.5%, and then the Russell 2000, as I said, those small caps are down as well by 1.4%. As we look across some of the other movers and the futures markets right now, we've got the US dollar that's been taking a bit of a breather today. We're at 99 on the DXY. We've seen some euro and some strength coming through for the sterling as well. Pound, crude oil lower, down below that $60 a barrel mark. Bitcoin also tracking lower right now at 101,000. So we're down around 2.5% as we stand. The 10-year yield has backed off that 416 level that we were looking at this time yesterday, and we're an hour at 410. So as I mentioned, plenty of moving parts for these markets. We did manage to see a bit of a recovery yesterday, particularly led by some of the technology names, but we are tracking lower today. So we're seeing a bit of a reversal of what we saw yesterday. So what had been working, not so much in the session, down 1.4% on technology, and also consumer discretionary is down almost 2%. So a few names behind that. Nvidia, of course, one that is lower today. Tesla, a big day for that company with the annual shareholder meeting, and of course Amazon, which is lower, down over 2% today. Communication services down 0.5%. Consumer staples also having a bad day. We've got utilities, which is lower. Real estate just on the line there. Industrials are lower as well. Materials and energy, though, are higher. Materials only just holding out in there, as you can see on the line to the upside. So we are seeing a bit of rotation, perhaps into a little bit more sort of a defensive, a bit more of a cyclical play today. Apple is higher. We're seeing Alphabet higher as well. But as I mentioned, we do have some of the big other names down in the vicinity of about 1.5 to 2.5% right now. Microsoft, Meta, Nvidia, and Amazon, as I just mentioned. So we are seeing a little bit of a tech wreck, you could say, for some of these names. A few headlines perhaps are weighing. Of course, we had Jensen Huang talking about the fact that China could be winning this AI competition before walking back some of those comments. But I'm going to send things over to Schwab Impact Conference now in Denver, where Nicole Petalides sat down earlier with Rick Wurster, the president and CEO of Charles Schwab. Take a listen.
Joining me now, Rick Wurster, President, CEO, Charles Schwab. Thank you for being with us here at Schwab Impact. It's huge. It's the biggest ever.
It is our biggest ever. It's so great to see the enthusiasm here, the spirit of helping clients. This industry's grown so much, and the fact that we've got a record audience here is testament to that.
It's been incredible. We've had so many great guests and conversations, but I want to start with the big news of Charles Schwab, and that is the acquisition of Forge Global. $660 million. Of course, Forge's stock surges on this news. What brings together the two companies?
It's about a few things. Number one, it's about providing access for our clients to private investments. And this has been an asset class that for a long time was only for the higher net worth. And with our acquisition of Ford, I think we'll be able to democratize access to privates. And so we're really excited about that. It is a growing market. There's $9 trillion of venture-backed companies. Many of those companies are looking for options for their employees to be able to sell some stock and create liquidity. And we're going to bring 46 million clients to the marketplace that may be buyers of that.
Filling
so
up
it's
the
a
gas,
great
y'all.
opportunity for our clients to build wealth, diversify their portfolios, and for us to make a difference in a marketplace that could be more democratized.
And that's the whole thing. And that is your client strategy. You're always putting the client first. And this gives them the opportunity to get into something that folks didn't used to be able to get into, right? I mean, I know there's so many companies under the umbrella. I heard you mentioning some big names, SpaceX and Stripe and others, Anthropic. People have the ability to now have access to some of these names.
Yeah, well, one of the great things now about what we've created is for the everyday investor, they can come to Schwab and participate in alternatives in three ways. One, we've created a alternatives platform that has some of the leading alternatives managers on it. Number two is in the
they
first
take
quarter
it
of
all
next year,
day.
we will roll out a 40-Act fund that will be an index of the 60 biggest private companies in the United States. And any investor can come and buy that 40-Act fund and get access to privates in a very straightforward way. And then third, for those that want to own individual private companies like a SpaceX or an Anthropic because they would like the company for some particular reason, they'll be able to do that. And so we will now have, I think, the most robust private lineup in the industry.
I think it's so exciting also because you said companies stay private for longer. And so this gives them, the clients, the access to the wealth and the growth, and they get to see that. So congratulations on that acquisition announced here today, this morning. So that's a big deal. Let's get to also the quarterly report. Profit record, revenues record, trading record, number of new accounts record. I mean, you are now seeing, and you came on in January. We had such an exciting time with your launch. Tell me about the most recent quarter and the outlook.
Well, we came into the year in such a strong position. And I think we've really focused this year, as we have in prior years, on making sure we nail it for the clients. And we've seen that in terms of growth. Our growth is up 40% year over year. Our revenue's up 20%, 27% year over year, and our earnings are at an all-time high. But it all comes back to what you said earlier, seeing through clients' eyes, doing right by clients. If we do that, we're going to have a successful business.
It's pretty unbelievable to see now multi-year growth. And you made your first acquisition now in your CEO role. I mean, I know you've been with Schwab a long time, but as you start to look and have the outlook for the company, I mean, is this the platform going forward? What drives the company going forward? I'm going to get to some of the crypto products in a moment as well, but what's your vision at this time?
Well, for us, it all comes back to seeing through clients' eyes. If whether it's an RIA, a retail client, or one of our employer clients, if we do the right thing for them and help them in their financial life, we're going to be a growing
for a retest right here.
Well, the reason Forge fits in is because one of the great opportunities in front of us is to do more for our 46 million clients. And what Forge is about is taking a capability that our clients didn't have access to before and putting it on our platform. And with 46 million clients, that's going to create a lot of value in doing so. So we want to do more for our clients to make sure we deliver on the mission of making them better off in their financial life.
I was excited to see how many young folks were on board. I mean, I heard you say how
much was it?
Schwab is everywhere on TikTok. And are you surprised to see how, you know, people, younger folks want to invest? I had a young person say to me recently, I have $15,000. Do you think the market's going to pull back? Should I put it in? I'm like, oh my gosh, you're so young. And first of all, I don't give financial advice. But the fact that they're interested in investing, you're seeing more and more young people doing this, right?
Yeah, 1/3 of our new to firm households this year are Gen Zers, so between the ages of 13 and 28. And that's fantastic to see the future of our country coming to Schwab to be investors. And they come to Schwab because we can do more for the young investor than anyone else. We provide them the most robust platform. We provide them, I think, an incredible TV network where they can engage in what our experts are saying and what's happening in markets. We have incredible research. We've got people they can talk to locally or on the phone. So the young investors can't get what they can get anywhere else. And I'll say one last thing, and you and I have kids about the same age. I said to my marketing department recently, why aren't we doing more to market to young people? And they said, we are. It's just you're not where we're marketing to young people. So we're on TikTok, we're on YouTube. We actually are the most followed financial services company on YouTube. So we are winning the young investor at Schwab.
And, you know, there's so much education and
Yeah, you
tools.
are.
As you said, you could pick up the phone.
We're messing with Solomon over here.
At the same time, you talked about, at one point, gambling versus investing. And that was something that you wanted to address. A quick thought on that.
To me, there's a big difference between gambling and investing. Gambling can be a form of entertainment. If you treat it as something you do in lieu of going to a movie or out on a date of some kind, you should think about gambling that way, not in lieu of investing. And what we've seen from some financial services companies is that they really are trying to conflate the two. Or on the same app, you can bet on the Monday Night Football game and invest in a stock that you've won. And
right.
We have no problem with gambling. If people want to gamble, fine. What we want them to know is that there's a strong difference between gambling and investing. On gambling apps, only 5% of people that start on a gambling app pull more money out at the end than they put in.
I keep telling y'all that. I told them I said that yesterday.
And people want to see how they're investing.
Over here want to do the sports betting and stuff.
Your clients are seeing. And
that money gone once you lose
24
it.
24 hours, 5 days a week.
Keep playing around.
Right? Tell me about that.
But just another way we're innovating on behalf of traders. We are the #1 trading company in America. We do 7.5 million trades a day. There's not a close second. And the package of what we can offer, whether it's our Thinkorswim platform, our different places to trade, again, the Schwab Network, which is a real differentiator. Our experts, I know you're having many of them on today, Mike Townsend and Liz Ann. These are the kinds of insights that traders want to hear. They also want 24/5 trading and a breadth of things to invest in. And that's why, again, why we're excited about this acquisition. I think our traders will love the opportunity to participate in some of these private companies, of which they know many.
And more folks now have access to these markets to have a piece of the wealth and the growth that all the different companies are seeing. And Charles Schwab does such a great job explaining it to them. Another area of growth, crypto, and that's not already discussed. And
I love how much sauce.
Delving more into this.
Hey, hold up, I'm the Coldest.
Or 2026, right?
Well, we always want to meet our clients where they are and what they're interested in. And our clients do
Keep
have
telling y'all
interest
that.
in crypto. We've seen a 90% growth in visits to our crypto research site. Our investors and traders consuming our point of view on crypto. Our clients own 20% of all the crypto exchange traded products in the country. So our clients are getting invested, and for the vast majority of our clients, their interest in crypto is about participating in the asset, the fluctuations of the asset, not about transacting on the blockchain. And so as a result, the exchange traded products have filled that need. Now finally, in addition to that, we know some of our clients do want access to spot crypto, and we're planning on launching it in the first half of next year. So more to follow on that one.
So you've been in this role. The stock has soared over 25% since you took over this year. You made your first acquisition. You've had a record quarter with the growth. I mean, it's just unbelievable. I just would love to hear how you're enjoying your role. And I know you did a keynote here too, talking to the RIAs. Maybe just some final big picture thoughts.
Yeah, well, I believe so strongly in our mission. Our company for 50 years has stood to do the right thing for clients, to see through their eyes, to help them grow their financial wealth. And every innovation over 50 years is about putting more money in their pockets and helping them navigate financial markets. And I'm so proud to lead a company that is for good in markets. And incredibly grateful to Walt and Chuck, my two mentors, for being in this position.
Yeah, I loved when we had an interview together and when you were making the transition, and more branches, right? More accessibility to everybody, right? What's the plan for that?
Well, the plan for that is that we know that when we have a dedicated relationship with a client, the client satisfaction scores go up 10 points. and they bring us 2.6 times the net new assets. So they do a lot more business with us. So we want to be in local communities, serving people and doing everything we can to help them in their financial life, and that's why we're expanding our branch footprint.
Well, I'm so glad to speak with you here at the Schwab Impact Conference. It's been very exciting, a lot of smart conversations going on. Rick Lister, congratulations on
See if they can
incredible
hold on.
quarter, a great year so far. Always putting the client first in this acquisition today. Thank you so much for being on with us all today and always. Rick
These
Lister,
birds are strong.
Thanks for having me on.
President and CEO at Charles Schwab. Thank you.
And thanks so much to Nicole and Rick for that great conversation. Coming up next, we're going to head back out to Schwab Impact in Denver for a conversation about international equities and diversifying your portfolio. Market on Close. We'll be right back.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are
Well, this is
live
like
with
a quick
analysis
one more
that
you
matters.
say.
Watch now, only on SchwabNetwork.com.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Caden in Chicago alongside Sam Vadas in New York. We'll be watching DraftKings in just a bit when they report earnings after the close. But earlier today, the company announced that it is taking over ESPN's sports betting partnership from Penn Entertainment. DraftKings will now be the exclusive official sportsbook and odds provider for ESPN. Disney's ESPN and Penn Entertainment ended their partnership just 2 years into a 10-year deal. Now, DraftKings not the only company reporting today. We've got a lot of others. They are, however, the only company reporting that is in the green that we'll be covering after the close. We've got The Trade Desk and Airbnb, both coming out at 4 Eastern, 3 Central. Both of them under pressure today. The Trade Desk under more, down close to 2%. And Affirm under quite a bit of pressure, trading down 6.5% right now. Their earnings will be out a little later at 4:05, but we'll have all of that for you after the market closes today. I do want to send it back out to Denver, though. Check in at the Schwab Impact Conference with Nicole Petalides. Hey, Nicole.
Thank you, Marley. It's a great time to talk the international investors who are interested in investing right here in the United States. We bring in our leader here, Lisa Hunt, Managing Director, Head of International Services, Charles Schwab & Company. Thank you so much for being here, Lisa. You are speaking with folks that have interest in the U.S. How's demand been? Tell us a little bit about some of the latest.
Yeah,
My business here at Schwab is really about our non-U.S. investors coming to us to invest, and they come to us to invest in the United States, right? They have a keen interest in engaging in the most liquid, the most transparent, the broadest based market that there is, to invest in brands that they use every day, that they see and hear, and we have seen incredible demand this year.
And we have such a big global footprint, right? I mean, so when people hear Charles Schwab, what are they looking to you for? I mean, what are some of the trends that they've been asking for lately?
By and large, when someone comes to Schwab, they're coming to the trusted brand in financial services. Clearly, we are the leader in investing in the U.S., here in the U.S., and so if your desire is to now engage in the U.S. markets, of course you're going to come to the best of the best. They come to us looking for individual stocks, for ETFs, for bonds. They are really no different than our domestic investors. They just live in a different country.
And also, they want to diversify away from their own markets. How have foreign markets been, and why does the U.S. provide that balance that they need?
It's interesting. The majority of investors outside the U.S. often aren't investors at all. They're really savers. They have a lot of their money in banks, retirement, healthcare, education. So much of that today is taken care of by their governments. And so it's very different than a U.S. investor where so much of our wealth creation is our responsibility. So they're coming to us to do just that, to create wealth instead of saving, looking for ways to long-term invest in big and small companies, to be diversified broadly, and to do it in one place that they can trust.
And when you're speaking with the clients, they still are mostly bullish, right?
Absolutely. They're no different than our clients here in the U.S. We might say they're cautiously bullish, but they are still extremely bullish. And we saw a big pivot this year, really because of some of the volatility in the dollar early on this year. If you're living outside the U.S. and our dollar weakens, that's really a double buying opportunity because it's actually costing you less than it did a month ago to invest in the securities that you're most interested in.
And how is the trading, the 5 days a week trading, helped?
Yeah. So, what's interesting, obviously Schwab launched 24/5 trading. Our clients, in particular in Asia, are leveraging that 5 times more than our domestic clients. Not surprising, right? The markets are now open when they're awake. And typically, before it was when they were sleeping.
It's exciting they have that opportunity. There was concern that people were not interested in the U.S. for a while. I'm sure you heard that from some folks. Did that prove to be fast passing, unmerited? Because they were worried about if they're selling treasuries or the U.S. dollar. What were your thoughts on that after speaking to a lot of folks?
I think we saw a little bit of a slowdown post-Liberation Day activity. Some of that wasn't driven necessarily by market sentiment as much as it was maybe more geopolitical sentiment. But the death of American exceptionalism has not panned out at all, and our international clients see it just as much as our domestic clients.
And do they ask about the rules? I mean, because each country has its rules. We have our rules here. I'm sure there's no blanket answer to that.
So, if they're a client of Charles Schwab, they really have to adhere to our U.S. trading rules and come under the same landscape that our domestic clients do. The company Schwab needs to worry about the different rules and regulations in each of the jurisdictions where we engage clients. But once the client is here, it's a very similar opportunity. There are certain products in certain countries that are not permitted, but we very easily can carve those out of the available securities for those particular clients.
So do you get a slew of questions about Mag 7 and crypto? And look, now with the deal today with Forge Global, we'll have access to private companies. What are some of the themes that people are asking? Gold was hot. What are some of the people looking for now in the next 6 to 12 months?
Yeah, I think across the board they have the same concerns that our domestic clients do. Is there a valuation issue with the Mag 7? What does the economic outlook look like? With sort of the choppy data that we're getting, they have the same concern. What's going to happen? Are we going to be surprised to the upside, to the downside once this data comes out? very similar questions. They look for the same type of help and guidance that our domestic clients do.
And tech has been something that people love, but we're seeing more and more folks going to different sectors. I mean, market breadth hasn't been particularly great, but looking for ones when we look at interest rates coming down, or real estate, for example, right, or utilities. Do you find people are diversifying?
Absolutely, and one of the great things, as you know, at Schwab, we have so many products that help with that. So we launched earlier this year internationally Schwab investing themes. We've seen incredible pickup in the usage of that. Really an easy way for them to get quick help and guidance around a particular sector or a particular theme or idea. So we are very capable of helping them diversify.
I like this.
And it's an easy market to come into. We have so many ETFs. We have so many
all
different
around
ways
here.
that a client can very easily at a very low cost diversify quickly.
And I mean, we were talking earlier with Rick Worcester, and we were saying how it was record profits and record trading levels and record new, accounts. And so, I mean, it continues to grow, and this international footprint that Charles Schwab has still growing.
Absolutely. In fact, we have seen our contribution of new accounts to our overall retail business increase every single month really for the last 5 years. We're not stopping.
Great to see you, Lisa. Thank you so much. Lisa Hunt, Charles Schwab, thank you so much for being with us. It's been great to chat with you. It's back to you, Marley and Sam.
Thanks so much for that, Nicole. Wonderful conversation. So important to get an international perspective. Coming up next, we'll keep the conversation going at the Schwab Impact event and discuss the RIA industry and advisors, how they're navigating market conditions, AI, and more. That's coming up next on Market on Close. Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide. No overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Hey, Dad. you?
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Market on Close. I'm Sam Bardas on the floor of the New York Stock Exchange alongside Marley Caden in our Chicago headquarters. Let's head back out to Schwab Impact in Denver and welcome in our next guest, and that is John Beatty, who's head of advisor services at Charles Schwab. Thank you so much for joining us, John. Look, we've had so many fascinating conversations with people on the ground there at the conference. As somebody whose job it is to advise the advisory firms, what is the biggest question that you've been asked over the last couple of days there?
Yeah, I think the question is about growth and how do we achieve more of it. The advisor base here, independent advisors, are thriving and driving their businesses. We can see that the winning combination of the fiduciary mission with the entrepreneurial spirit is extending the reach of the advisor model to more American investors quarter over quarter. We can feel their growth in our numbers as well as in the conversations we're having here in the hallways and in our meeting rooms.
And John, you mentioned growth. You know, Schwab's certainly seeing that now, serving more than 16,000 independent advisory firms, overseeing more than $5 trillion in assets. What's driving that growth, and how reflective is it of what's happening more broadly in the RIA industry?
Yeah, it's because this independent business model allows advisors to meet their investor clients in the moment. They provide a holistic planning and investment relationship model to their clients. Certainly experts in the portfolio, but also at the same time thoughtful in relationship with their clients around financial planning, estate planning. Now more are bringing tax into the equation, family governance. So the fact that they can put their arms around the entire client relationship differentiates them from the rest of financial services.
And John, what has been the nature of your conversations around artificial intelligence?
Yeah, the group here is leaning into it. We did a survey over the summer and found that 50% of RIA firms that were part of the survey have implemented some form of artificial intelligence into their back office, whether that's note-taking or contract reading, other contact management opportunities related to artificial intelligence. There's certainly a lot of runway there. I think they're trying to really find ways that the artificial intelligence could augment the human interactions that are so important as it relates to serving investors and keeping them attuned to the markets and the risks and the upsides. It's, you know, I've often been saying you probably build the caddy in AI before you build the golfer.
And John, there's always some fear that AI in a financial advice situation could make it feel less personal. So you say if it's meant to augment it, how do we ensure that the technology actually enhances the experience as opposed to replacing some of the human side of that client-advisor relationship?
Yeah, I think that the AI will take the transactional work and make it frictionless and more seamless for both the advisor and the investor. But at the same time, I don't see AI, you know, helping a couple through a divorce or a spouse through the loss of another spouse, a cancer diagnosis in the family. This is where advisors make a difference in their clients' lives. There are financial implications to all of those scenarios. It's less IQ and maybe more EQ in the future.
And John, you talk about how liquidity is a big theme right now. I'm just wondering if you could sort of unpack that and tell us what you're seeing as far as some of those trends.
Yeah, I think that, you know, with the performance of the markets recently, we are hearing some talk here on the floor that advisors are being very thoughtful in coaching their investors to realize that markets don't just go straight up, and that volatility is a part of investing, and that if we should see a down market, There is some uncertainty around rates, economy,
The market is a good
some
place, y'all.
aspects of
Some of
the
y'all.
outlook.
It's beautiful here.
And so they're, doing their job, which is to make sure investors are understanding and somewhat anticipating volatility, whether it's to the upside or the downside.
And with liquidity as that theme, piggybacking off of what Sam said, how are you seeing advisors use tools to help clients manage their cash needs, whether that be for their home or tuition or a business opportunity, without disrupting their investment strategies?
Yeah, we see advisors extending beyond the asset side of the balance sheet to the liability side. And certainly Schwab Bank, with our pledged asset line capability and our mortgage capabilities, is helping advisors find liquidity where it's necessary, whether that's for home building or other types of life events. And so we see that that is actually fortifying the relationship between the advisor and the investor. Many advisors don't want some of the other financial services companies in the lives of their clients and potentially being disruptive, trying to take the assets away through the liability side of the balance sheet. So we feel very good about our ability to support advisors through the bank, Schwab Bank, in that manner, both from a deposit side as well as a lending side.
John, you mentioned some of the trends, obviously some of the questions that you're fielding right now. You also touched on interest rates and the fact that these stock markets aren't linear. There's been a lot of conversations about a repeat of history, dot-com bubbles, irrational exuberance. I'm just wondering, I see that you've been actually at Charles Schwab for nearly 30 years in advisory services. What is the biggest change that you've seen over that time?
Well, I think what we're seeing in the portfolio is that advisors are extending beyond the traditional liquid security types, individual equities, ETFs, mutual funds, fixed income, and now we're adding, longer-term investments, alternative investments. Crypto is a bit of a topic here. We see them leaning into options trading as a way to augment the portfolio. We believe the acquisition of Forge and the access to private securities is another way that advisors can add value in the portfolio and diversify risk and find return.
And John, last question, what is your long-term vision for Schwab Advisor Services? Where do you hope to take the business in the next few years?
Well, we often talk about the fact that we serve this community of advisors with humility. We listen to their needs, we listen to the trends, and we deliver the services that they're looking for. But at the same time, we have to lead with strength, and an acquisition like Forge allows us to bring a solution to the market that they might not have been anticipating. So I think the combination of that approach should drive this industry, and we expect sometime in the early 2030s that this will be a $20 trillion industry, and if we retain our 45% market share, which I'm confident we will, it will be a $10 trillion, $11 trillion business within Charles Schwab. And the mission here is to help advisors extend their model, the fiduciary model, to more Americans that want the independent fiduciary services that they provide. There's $30 trillion of managed wealth in this country. We're just getting started here. It's early innings. There's a lot more potential for advisors in the next decade.
Well, John, we appreciate you taking the time out of the conference to be with us today and to share some of what's happening in the advisory community.
Well, somewhere in here, they're going to fill up the gas.
And we're nearing the end of our market session, so we'll bring in Kevin Green to break down the levels he's watching on the S&P 500. We've also got earnings coming from Trade Desk, Airbnb, Affirm, and DraftKings. That's next on Market on Close.
But when you invest, you got to think about the future. You know what I'm saying?
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more.
I got a couple of videos for you guys.
You can ask
There's a few things I'm looking at.
Directly with an education coach.
Like this data dog right here, like this is wild.
At its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Data dog was getting to it, boy. They was out here getting busy, boy. Y'all was sleeping. Data dog was out here doing his thing. Hey, I appreciate that. I'm telling y'all, boy.
We go beyond the headlines.
We're gonna be out here every day.
Trends, sector moves,
getting
and
to it.
fundamentals shaping the markets in real time.
We're gonna see what's moving.
Schwab Network.
We're gonna see where that money's at.
SheldronFrost.com.
sometimes, you know...
Next. Try it again.
You could have done better.
Please?
Oh, we gotta start getting this stuff, thinking about some shares.
Level up and
Holding
invest
on
smart
for the
with
future,
Schwab.
boy.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the
That's what it's all about.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah.
Get you a nice dividend portfolio.
They can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes.
Keep reinvesting them dividends, buying them shirts.
We're experiencing technical difficulties.
We're gonna weather any storm, I'm telling you, yo. This best is starting now. I'm coming here trying to trade first.
Stay connected to the markets, the Schwab Network.
Tune in
Maybe
24
with
hours
shirts.
a day, 7 days a week on
Oh,
SchwabNetwork.com.
Mark's gonna take your shirt off.
Schwab Network. Available anytime, anywhere, on any device for free.
Come here and buy some shares, boy. You try to trade. Mark's gonna take your shirt off,
Schwab
boy.
offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charts.
That's why my cousin don't call me no more. Because he was over here trading and playing with that crypto and stuff.
Best of all,
And now he don't got liquidated.
directly to
You gotta pay attention.
It's interactive learning at its finest.
Can't be just putting your money in there and walking the weights.
Head over to schwab.com/coaching.
We got a bull trend and a bear trend. Pay attention. The market is your greatest teacher.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me.
I'm show you, boy. The power of investing is crazy, boy. It was probably all year we were screaming QS. We were screaming PL. We gotta start investing more.
Kevin, I see we're off the session's lows for now, but what levels are you looking at on the S&P 500 with just a few minutes to go?
You get me?
Yeah, we continue to see the
all y'all gotta do is subscribe. Well, we were screaming PL early.
Off the lows, as you kind of talked about, but this time yesterday we did see some aggressive selling action taking place, and is that
early,
the same
big
thing
bull
today,
runs.
especially when you're looking at Nvidia? We have broken some key.
Let everything pull back.
And we kind of highlighted earlier.
We're gonna load the boat up.
That 67.40-ish area is an area of support, but we are trading below that at this point in time. So just once again,
let them pull it back. We're gonna load the boat up for the next bull run.
We're still seeing a couple of sectors in the green.
This is what they do to us.
Energy in the green as well as healthcare.
Market give it and they take it.
It's fifth day in the green, so that's actually a pretty decent rotation trade that is taking place here.
It's all about entries and exits. We're gonna be all right.
Without technology as well as communication services, it makes it really hard for the market to move higher here.
We're gonna be all right.
Unfortunately, we are now below that 20-day moving average for the S&P 500, and now you are also seeing technology below that 20-day. You're seeing the semiconductor index close to being under that 20-day moving average, as well as Nvidia. So, unfortunately, seeing a lot of selling pressure. Hopefully, tomorrow we're able to kind of recapture some of these losses.
Even though we bullish overall, they're trying to pull it back in the short term because this government shutdown stuff.
And
people losing a lot of money.
We're seeing on this down day. What's
in the workforce, and then they're coming back to this,
it depends
trying to take their money out of
that
this.
You would like to look at. So if we look
So
at
they can
the
pay
S&P
for
500
that.
total composite volume, it's actually a very light day. We'll see what happens going into the close with the market on close orders, but it was actually fairly light. But if you're looking at the E-mini S&P 500 futures,
eventually all the money gonna come back here and
actually
things
did see
are
some
gonna go back
pretty
up.
decent selling volume today, as well as if you're looking at the options, the 0DTE options that are expiring for the SPX. So overall, once again, it kind of just depends on the metric that you're looking at.
They want to go lower right here at the end.
In focus. If you're actually looking at
those
the
0DTE puts is
Spider dividend ETF, it's actually in the green so far today as well. So you are seeing maybe higher dividend stocks, lower beta stocks catching a bid, and getting out of some of the higher risky trades, higher beta trades. The utility companies like the Oklos of the world seeing some aggressive selling pressure here. Obviously Nvidia, but you might be seeing some pockets of strength when it comes to high dividend stocks, and maybe that's an area to hide out in while this actually does try to.
Think about it. I'm just saying.
Yeah, I suppose it's not a full sell-off if you've got some of these
We still have
in the
earnings
green
this week,
today, as you mentioned.
so maybe they can save
Perhaps
us.
a bit of a healthy rotation into healthcare, no doubt helped by some of the headlines that we're seeing today with regards to pricing around some of those weight loss drugs as well. But what do you make of what we're seeing? I mean, I do see that, as you pointed out as well, it seems to be a sort of rotation into sort of more cyclical parts of the market as well. What are you seeing as far as energy? I saw that materials had popped its head into the sunshine for a brief moment there too.
I can go for some Wendy's right now.
Yeah, so for materials, it's just very difficult. I mean, you're seeing the more traditional material names actually catching a bid, while some of the more speculative ones that we've seen rise pretty aggressively over the last 2 months still sell off pretty aggressively over the last couple of trading sessions here. So I think that's a little bit more of a rotation, getting back to the traditional names within materials. The energy space, it's really the servicers that are actually outperforming the Halliburtons of the world, things of that nature here. Now, it was a very low bar for this earnings season for the energy sector as a whole. Actually, we were actually expecting the most drawdown when it comes to earnings per share growth on a year-over-year basis from energy, and they have been able to beat and exceed those expectations. A very small weighting in the S&P 500, though. If you're looking at around 3% to 5% weighting for the S&P when you're looking at energy, not a really big headline mover, but once again, a rotation trade, especially when you have energy prices like crude trading at around $58, $60 or so, very compressed prices, a lot of supply hitting the market, but the servicers are definitely catching some a bid here, and they actually might see some continued demand over the next couple of years with the AI trade, especially when you're looking at new energy production and facilitation in order to power a lot of these data centers.
They need to do something different.
Away now from
When these got copy off McDonald's.
As KG has pointed out there, a bit of selling pressure heading into the close today. We've got most of the sectors in the red, all but healthcare and energy.
Yeah, I said it, boy.
A lot of moving parts for these markets, as we did see a little bit of a recovery yesterday.
When these got the copy off McDonald's.
Shaky ground today, so things looking a little bit wobbly as, of course, we are in the
whatever McDonald's doing, Wendy's not to do that shit.
Here's your back.
And here's how we closed out the day. The S&P 500 down 1.67,
All right, y'all. Yeah. I need a minute. I need to make me some lunch.
The NASDAQ trading down almost 2%, 25,130.04 to close out the day. Taking a look at the Dow next, trading down almost 0.9%, 46,913.65. And the Russell down 24,18.90.
Everybody get liquidated.
1.8% on the day. Taking a look at some of those sectors that we mentioned, a lot of red on your screens here. Technology down 2%. Communication services down 0.75%. Consumer discretionary more than 2%. Consumer staples and financials both down about 0.5%. Taking a look at the rest of our sectors here, we're going to see a bit more red here as well. Utilities down more than 0.1%. Real estate down 0.25%. Industrials trading lower as well, 0.4% lower. Materials about the same, down about 0.4%. And energy trading down 1%. The trade desk's earnings just coming across the wire, though, so we'll get right into earnings here. This stock tends to be very volatile. EPS coming in for the third quarter at 45 cents. That is a beat from the 44 cents that was expected. A small beat, but a beat nonetheless. Revenue also a beat here for the third quarter, $739 million. Estimates calling for 719.7. Those numbers just coming across the wire. And as we mentioned, a volatile stock sometimes already trading up 13% higher just on this initial cross the wire momentum. I want to bring Sam and Kevin back into the conversation. You know, KG, we've known trade desks to have these huge gaps to the upside or the downside following their earnings. These initial numbers coming across the board, we're seeing one of these massive upside moves for now. You know, what are some of your thoughts as we're just getting these?
Yeah, it looks like maybe the trade desk is seeing a bottom when it comes to the fundamentals for this company. If you look at a longer-term chart, obviously we have seen a lot of movement to the downside here over the last year. A lot of disappointment when it comes to this name, and we are seeing a little bit of a spike. Low bar going into this report, beating on both the top bottom line, and when you're actually looking at the net income margin, coming in at around 16%, this time last year was 15%, so margin expansion, once again, very low base when you're looking at it. I'm not sure what their guidance is going to be, so maybe once that crosses the wire, let's see if it really kind of shakes up the stock. This is a company that has seen market share being taken away from some of the bigger names within the advertising advertising space just as a whole, and as well as the transition away from linear, which is where they actually do see a significant amount of money when it comes to trying to place ads and things of that nature here. But initially seeing a spike, it looks like it's trying to reverse here. Let's go through maybe some more of the numbers to see maybe if they did provide some weak guidance moving forward.
I'll give you some of this guidance numbers, those just coming across as well. Fourth quarter revenue expected to be at least $840 million. Estimates calling for $831, so that's better than expected. Fourth quarter adjusted EBITDA expected to come in about $375 million, besting expectations for $365.4. So a beat in the revenue we're seeing so far. They're also announcing they've added a $500 million buyback authorization. So far, good results coming across the board. We are seeing a bit of a reversal, still in positive territory, up 2.3% right now, although about 2% right now for the trade desk. Sam, in the conversations you were having about the trade desk, because I know you're very familiar with them and how volatile they've been in the past, what are investors looking for here from them?
Well, obviously, this is very exposed to some of those cyclical trends, as KG pointed out. I mean, this is placing ads in some of the linear TV, and so this is very heavily tied to some of the trends and, what we see around the consumer, but also with regards to the tariff situation as well. We have certainly seen in the previous quarter, even though this looks better as far as what they had even been guiding for this quarter, that advertisers had been sort of feeling a little bit less confident than they were, say, a year ago. So I would say this gives us a little bit more confidence here, particularly because as far as the revenue forecast, they were looking for 717. So this comes above what they've seen here as well, and even what they were penciling in. But yes, as consumer discretionary sort of remains in a tough spot, it's been very interesting also, to KG's point, to see what they've been able to do this quarter, even though that they've been losing some of that market share to the likes of Amazon, because they've got this deal with Netflix, and also Walmart, who seems to not be breaking up with this company. They just don't want to be exclusive, so they want to sort of date other people, is how some investors were putting it to me. So, I think this is seemingly a good report in light of some of those challenges there.
Yeah, certainly, and they, as you mentioned, tariffs, they did flag tariffs as a potential issue for them in their last earnings. So I think seeing this guidance come in ahead of expectations certainly will be a question asked on the call. But all in all, good performance. They are pulling back some, though, as KG said. We know them to be volatile. They are proving it to be true, spiking as much as 13%, now down about 0.1% right now. But I want to move over to Airbnb. They're also just putting their numbers out across the board, and they're moving higher, up 2.6%. Revenue coming in at $4.1 billion. That's up almost 10% year over year, and slightly better than expectations, calling for 4.08. Their gross booking value, very important number for them, $22.9 billion. That's up 14% year over year, and beating estimates, calling for 22.13. A slight beat there as well. Adjusted EBITDA margins coming in at 50%. Estimates calling for 49.9, so in line there. EPS 221 versus 213 last year. Estimates were calling for 236 here, so this is a slight miss on EPS. But nights and seats booked, that beat expectations and is up 8.8% year over year. And their gross booking value per nights and experience book, that's also coming in 5% higher year over year. Free cash flow also up to $1.35 billion. That's up 26% year over year. For the fourth quarter, they're seeing revenues between 2.66 and 2.72 billion. Estimates calling for 2.67, so that estimate at the lower end of the range they provided. Likely some of the reason we're seeing this move to the upside. But KG, as we're just getting a first look at this report for Airbnb, what are your thoughts?
Yeah, I would say this is a little bit of a mixed result here. Obviously, looking at that guidance moving forward for gross bookings value, expectations, the outlook for revenue, a little bit of a, I would say kind of a slight miss, and to say kind of a slight miss in some respects here. It seems like they are trying to put this picture out that maybe some of the headwinds that they've seen over the last couple of quarters here might be put past them, at least for now, especially when you're looking at their guidance for gross bookings and things of that nature here. The only thing that I'm a little bit concerned about, or maybe a little bit cautious about, once again, they have this commentary around this tax rate, or the effective tax rate after the big beautiful bill. Do they take actually a pretty decent charge over the next quarter or so, like we saw yesterday in some earnings announcements, and then do they kind of reset moving forward here? That could be a little bit of a concern, but I think this is actually a really decent report. They do have a lot of headwinds. I think the concern around Canada and the U.S. trade relations and how that could actually impact travel itself doesn't seem like it's being reflected too much in these numbers. Maybe analysts have already priced that in, and the guidance, for the most part, is okay. The top line guide for me, when I'm looking at some of the estimates, looks like it came in a little bit light, but it seems like the market's okay with that.
Yeah, and this is a really interesting one, Sam. As we've watched so many of these and covered so many of these now, to see where things are coming in sort of in line. We've got a mixed report here. There's some potential yellow flags, but the market doesn't seem upset about it. Up 3.4%. Likely on that gross booking volume number, was strong, and their revenue beat that gross booking value. That's an important one for them at 14% year over year. As far as conversations you had about Airbnb or anything about the international concerns here, what were you hearing coming into this report?
Well, certainly the nights and the bookings certainly seem to be encouraging here as far as the metrics and the numbers that you just mentioned, and also on the experiences too, because there had been some sort of questions around how it was sort of making this sort of foray post-COVID into things like cooking classes and, training with a personal trainer, etc., just beyond staying at somebody's home for the night, whether that would certainly pay off. So I think those numbers seem to be quite positive as well. No doubt some of the new features, as far as what the company has been saying. I was listening to the CEO actually the other day talking about more AI support as far as customer services. They say they're knee-deep in AI at the moment. Will be something that will be addressed on the call as well. But one of the investors that I spoke to, actually from Seven Investing, mentioned to me that quite encouraged also by recently repurchasing shares. So it does look like the operating margins look fairly good for now. And there seems to be very much this, a feeling that people are encouraged by the fact that, they've got more market value than some of the hotels. But I would also say that with these numbers, I mean, if we just take a step back and listen to what we've heard from the airlines, listen to what we've heard from even the Avis car companies, how people are continuing to spend. I mean, I suppose this goes hand in hand with the overall travel narrative and story that we're seeing from all of these companies, that things are holding up.
Yeah, and certainly, and KG, Sam brings up a really interesting point there about, some of these travel issues, and also the announcement we got from the FAA in the midst of the government shutdown here. That could issue some travel disruptions here for customers of Airbnb with these bookings, and some potential disruptions or fear of even booking the flight at all or doing a last-minute, weekend away. If the shutdown continues, do you think that that's something that will come up on the call? Questions about how they plan to deal with that, because we are seeing the ripple effects now.
Yeah, that could actually have an impact. They could also move prices higher to offset some of that, the demand concerns as well as the supply constraint concerns as well. That could also create a little bit of gyration for this stock. The bright spot here, when you're actually looking at the breakdown, it's not the core markets, it's not the U.S., it's not France, it's not Canada, it's Latin America. They actually just talked about the gross bookings, if you will, has actually doubled in Latin America. And that is where they actually saw a lot of the positivity for this earnings announcement here. Now, that's something that's not really talked about that much, but they have rolled out some new services, and it seems like there's a really massive uptake that's taking place there. And that could actually be an untapped market for them that they can expand over in the future, right? And maybe not rely so much on the U.S. and Canada, and maybe just focusing on just certain other segments of the market, like once again, Latin America. This is actually a really good report when we're talking about the international exposure and how much that actually drove top-line revenue here.
Yeah, and Sam, for the international numbers, I had read through some of the analyst notes coming into the report today, saying that was going to be an important thing for them to see where their focus was in terms of international growth. But I imagine we'll get some more commentary on that on the call here. But as I'm saying that, Affirm now coming out, Affirm Holdings releasing their results. I'm going to pivot over to Affirm so that we can cover these. KG, I'm going to say goodbye to you and welcome in George Tillis to help us with these earnings. Kevin, thanks for being with us from Schwab Impact in Denver. And we'll welcome in George Tillis now. We've got two more earnings for you. Hey, George, welcome to the show again. We're going to got Affirm coming out here, so I'll give you some numbers. We've got their fiscal second quarter revenue coming in. This is their forecast here, $1.03 billion to 1.06. Estimates calling for 1.06, so that's going to be a miss for them. They're seeing their gross merchandising volume. This is their guidance coming in $13 billion to 13.30 billion. They are seeing their fiscal year gross merchandise volume, a very important metric for them, above $47.5 billion. They had previously already raised this to be above $46 billion. This is a very important metric for this company, making sure that they're doing that merchandise volume for a firm where they kind of sit at the cross-section of consumer credit and fintech innovation and payments. So that number, performing well. Shares up about 1.5 move to the upside. But, as we're just coming across here with some of this guidance they're offering us, George, what are your initial thoughts?
Yo.
Well, I think first off, the transaction volume is critical for a firm because they essentially really don't take the financial risk being, a lender of other banks' money, and their partnership network and volume is extremely important because of the fact that they make their profits, which are small on bigger volumes. So these numbers are extremely meaningful. I would look at the EPS numbers. It looks like they just posted the EPS numbers just came in at 23 cents versus the 11-cent estimate. And then, of course, the sales came in quite a bit higher, beating the estimates by 5%. About 34% increase when it comes down to sales. And right now, based on these numbers, quite a meaningful increase in EPS.
Yeah, certainly in that revenue number for that first quarter coming in at $933 million, that well exceeded the expectations for $844.3. Now, Sam, coming into this report, so much of the focus was on this gross merchandise volume number and where they were going to stand in a challenged environment here. As far as conversations you had or analyst notes that you saw, we are seeing a move to the upside now a little bit more strongly, about almost 5% here. What do you think the focus on the call will be here for a firm?
Well, I think it's really interesting. I mean, just looking at these numbers, it sort of takes me back to a conversation that Diane was having actually with one of her guests earlier today about this company. And they were sort of talking about how this is going to be a really good barometer and sort of a health check on the consumer, because we've been talking so much about that lately with everything from the retailers to the fast food and the casual dining. So this is just giving us another sense of that off the back of obviously the credit card companies that we heard from as well. They had actually been pointing out, which strikes me, that customers here do skew younger and also low income. That has been such a focal point this week with some of these earnings that we've been hearing from about some of the concerns of that demographic actually having pulled back. Now, obviously, this is a company in the business of buy now, pay later. So interesting trends there as far as the consumer is concerned. But, this sort of part of the demographics is also much more exposed to inflation, student loan debt, etc. And, they were also talking about some of that payback fatigue. So I would say those numbers are fairly encouraging in that particular context, Marley.
All right, I'm going to pivot us now over to DraftKings. Shares moving sharply to the downside, down about 8% right now as their earnings come across the wire. Their revenue for the third quarter coming in at $1.14 billion. Estimates calling for $1.22, so that is a miss there. Their average revenue per MUP here, I'm just pulling these numbers up for us, coming up at 106, estimates calling for 105.40, so in line there. They posted a loss per share of 52 cents. Estimates were calling for a loss per share of 44 cents, so a more considerable loss. For their adjusted loss, they posted an adjusted loss per share of 26 cents, which also missed estimates for the adjusted loss of 21 cents. Adjusted EBITDA loss of $126.5 million. That loss was only expected to be $77.8 million. So very disappointing numbers coming out of DraftKings as they sort of miss loosely across the board here. Shares down 8%. George, thoughts as this is coming across? We talked earlier about this big headline that they put out about being now the official exclusive provider sportsbook for ESPN.
We did. That's a very positive news, article for DraftKings, but it really comes down to substantive customer growth, the profitability progress, as well as some guidance revisions. So at the very least, right now, we essentially see, misses in terms of adjusted EPS and sales. Again, the fractional misses on the sales, but that's essentially sufficient to create a situation where we see continual decline in this name, which has already been down about 23% in the last year.
Man, it's been a good day.
The profitability profile was already very finite in terms of 25 cents EPS guidance adjusted for this year. With this ratcheted down number for this quarter, it's probably
give me a second.
going to change based on reality. change the outlook for this year's earnings multiple, because right now it's already trading at 110 times prior to today's release, this year's earnings. And so there's a lot riding on the growth next year, which is expected to improve to essentially $1.09 on an adjusted basis for the next fiscal year. So if they move back one quarter, which again, I surmise is the case right here, it's going to ratchet across the board the estimates for the next 4 to 6 quarters.
And George, they are revising those estimates down. They're coming across the wire right now. Fiscal year revenue expected 5.9 billion to 6.1. They had previously said they saw 6.2 to 6.4. They're also seeing their EBITDA, adjusted EBITDA for the fiscal year, 450 million to 550 million. Previously saw 800 to 900 million. So some massive downward revisions there in terms of those numbers. Also authorizing an increase in their share buyback plan to $2 billion, and their monthly user number coming across right now as well. Their monthly unique payers, that actually missed as well, 3.6 million. Estimates calling for 3.92. You know, we're down 11% right now. Sam, we've not seen too many scenarios in this earnings season where we've seen these downward revisions sort of across the board in terms of their forecasting for the fiscal year and their guidance. How much punishment is there going to be here? Because we've seen punishment for far less.
Yeah, we've seen punishment for companies actually clearing the bar, Marley, but interesting move to the downside, as you mentioned, because I think previously at the top of the show we had said that this was actually the bright spot amongst the 4 companies that we've actually got you across here. So now we're seeing this reversal as far as the market reaction off the back of this. Yes, look, wouldn't you like to be a fly on the wall in this earnings call, certainly later today, because, you know, I think there's going to be a lot of conversations, particularly around the SPN deal that you mentioned at the top of the show as well, being definitely the sportsbook and the odds are provider now. Also with respect to the prediction market, which has been a big focal point here as well, the likes of Kalshi and Poly market, that's been a big conversation down here at the New York Stock Exchange. Particularly off the back of the recent developments we've seen here. I was also talking to an investor, again, over at 7 Investing earlier today, who really said that, you know, these companies do have an advantage in the predictions market because of the fact that they're federally regulated rather than the gambling rules, which are state by state. So we have certainly seen this company making their debut into that sort of predictions market as well, and launching an app, Railbird Tech as well. So I think, you know, all of that's going to be addressed on the call later today as well.
And George, final thoughts on DraftKings and what we're seeing from them now down more than 10.5%.
Well, clearly I'm not surprised to see them go down, but I think the rate of change may be decelerating in the declines because, again, you just continue to move, you know, the goalposts a little bit further out in terms of, you know, pushing things out, and in terms of profitability. So I think, again, Sam brings up a great point. Is the integration now of DraftKings through either acquisition or partnerships to compete with the prediction markets, which right now are really out-competing them just based on popularity and trends. Just, you know, from what I hear and see, DraftKings, which became very favorable and was doing well, getting closer to profitability, they're just moving backwards for a while. And again, this is another quarter that demonstrates that.
All right, well, George, we appreciate you being with us to break down these earnings for us. I'll walk us back through all 4 that we've seen in the action. The trade desk trading down about 8.4% after we saw a pop, almost 10% to the upside. After an earnings beat and raise quarter on Airbnb, up about 5% on a mixed quarter. Affirm now up 8% after they posted better than expected earnings. DraftKings down more than 10% after a disappointing quarter for that company. And up next, we're going to close out the show with our final takeaways and what we're watching for tomorrow. Stay with us. Market on Close. We'll be right back.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
That could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marlene Caden here in Chicago alongside Sam Bottis at the New York Stock Exchange. We'll close out our show with some final thoughts on today's session, stories that stuck out to us. We've had so many guests on talking about how if the government shutdown continued, we would start to feel its impact, and air travelers are about to. The FAA announcing today it will be implementing a reduction in flights across the country due to a slowdown from the ongoing shutdown. The FAA has not yet said which high-traffic airports would be affected, but a preliminary list includes some of the country's largest international hubs: Atlanta, Chicago, Dallas, Los Angeles, and New York City. Several major airlines also saying they plan to waive cancellation fees even for their most basic tickets in response. And pivoting here, the Trump administration's push to lower American drug costs entered the GLP-1 space today. They announced new deals with Eli Lilly and Novo Nordisk as a part of the president's most favored nation policy. He's already announced deals with Pfizer, AstraZeneca, and EMD Serono to sell certain drugs directly to patients at a discount in exchange for exemptions from planned pharmaceutical tariffs. Health and Human Services Secretary Robert F. Kennedy Jr. said that this is the most important of all the announcements the administration has made because it will, quote, have dramatic effects on human health in the U.S., adding that he believes the American public will lose 125 million pounds collectively by this time next year. Sam, what stuck out to you today? Well, we had some Fed speakers today, Marley, and Austin Goolsbee started off the day giving an interview to the media this morning where he expressed hesitation about further rate cuts. This is not new coming from Goolsbee, but that is because of the lack of data due to the government shutdown. Now, that data fog, as we've been calling it, really appears to be a concern for Goolsbee, particularly on the inflation side, which he has been talking a lot about. Now, the BLS, of course, we know, did release the delayed CPI report, which came in above the Fed's target, but more or less in line with the market expectations. Meantime, the Chicago Fed also was out with its labor market indicators today, which showed the U.S. jobless rate, edging up to 4.36%. So the inflation level, back to that, also appears to be concerning for the Cleveland Federal Reserve President, that's Beth Hammack. And in a prepared remarks for an Economic Club of New York event today, she did suggest that prices are too high and is a bigger concern than the labor market, and that policy should be leaning against it. So the markets, of course, have been wondering what might happen in December after that meeting last week where Fed Chair Jerome Powell said a cut was not guaranteed, not a foregone conclusion. So, of course, we'll be getting a lot more of this sort of information from some of these Fed speakers to get a little bit more of an idea of where they sit on things. But heading into tomorrow, what will you be looking out for, Marley? Well, we've got more earnings coming tomorrow morning. Wendy's, Constellation Energy, Duke Energy, and Six Flags, just to name a few. Wendy's expected to report earnings of 20 cents, which would mark a decline of 20% year over year on revenue of $451 million for the quarter. Now, McDonald's did just report an increase in same-store sales growth, but they also offered commentary on the spending habits of some of its lower-income customers. So those 2 points will likely be in focus here. As for Six Flags, I love their ticker and their parks ticker fun, expecting EPS of $2.18 on $1.33 billion in revenue. In 2024, the company announced a $1 billion investment into its portfolio across the brand's 42 amusement and water parks. Investors will definitely be looking for any developments on how that's helping drive growth. How about you, Sam? Well, as I mentioned, we've got a few more Fed speakers up tomorrow as well. So it seems to be a lot of a sort of concentration in the back end of this week, and coming off the back of course, last week's decision, where we did see 2 dissents in either direction. And so, you know, Myron's going to be a really interesting one because of sort of where he stands on things. And, you know, we'll get an indication of, you know, how a lot of these Fed speakers are actually thinking about the lack of data at the moment, as we now see this very much dragging on as far as the government shutdown is concerned. And we near towards that December meeting, we're going to be hearing from Williams and Jefferson as well. So no doubt we'll be listening to some of the commentary. And then I've just been checking out Tesla. So we're just seeing in the aftermarket, post-market up 1% right now as this shareholder event has got underway. It was trading lower by about 3.5% in the session today. So we're going to be all ears and watching the reaction in the stock off the back of what is going to be a very critical time for the company, no doubt, this afternoon.
Absolutely, that $1 trillion pay package. But that's going to do it for us today on Market on Close. For Sam Bottis, I'm Marley Caden. Be sure to download the Schwab Network app, available in the Apple App Store. And you can tune in 24/7 on schwabnetwork.com. Market Overtime is coming up next. Have a great rest of your Thursday.
Hello and welcome to Market Overtime. I'm Sam Bardis. Our next guest is an MIT graduate, an Air Force Reserve member, and an inventor with close to 50 patents under his name. All impressive titles, but you probably know him as the pioneer in Bitcoin. I'm very pleased to introduce now Michael Saylor, Executive Chairman of Strategy. Welcome to Market Overtime here on the Schwab Network.
Thank you for hosting me.
First and foremost, congratulations on becoming the first Bitcoin treasury company to be rated by S&P. How does it feel and what does it mean?
Well, I think it's a very legitimizing step. It's auspicious for the industry. This year, we launched 4 digital credit instruments, Strike, Strife, Stride, and Stretch. They were all IPOs. They all publicly trade. Those are backed by Bitcoin. And they've been very successful, but they've been unrated. And so many fixed income investors and you know, insurance companies and large pools of capital, they would like to buy them because they have superior yields. They're really cool instruments, but they can't without a rating. And so part of the maturation of the entire asset class is getting the traditional credit rating agencies to begin to acknowledge digital credit. And this was the first credit rating of a Bitcoin treasury company ever in the industry. And we've been at it for 5 years, so I think it's a big milestone.
It certainly is a significant step, and I just want to sort of talk about what you do, because you mentioned some of your product offerings, and we will dig into that in just a little while. But what is the best way to understand what you do and how?
Well, it all starts with Bitcoin, a digital commodity. Bitcoin is digital gold. It turns out that it's also a global asset. It trades 24/7, 365. You can sell it short with 20x leverage on a Sunday morning, and then you can reverse and go long 40x a few hours later from Singapore, cross-trading with someone in Europe, and that makes it very volatile but very desirable, and for a conventional investor, it makes it a little bit scary. The history of Bitcoin for the past 5 years is it's been appreciating about 50 to 55% a year, and it's been about 50 vol, so 3 times as volatile as the S&P index. If what you wanted was 50% ARR and 50 vol, then you would just buy the raw commodity. But it turns out that if you walk down the street and you ask people, would you like to generate 50% returns a year, but you might wake up and lose 25% of your capital in 1 week? Most people don't want that. So they don't like the volatility. What our company does is we buy Bitcoin and then we issue credit instruments against Bitcoin. So for example, some people would like to have 75% of the upside, 5% of the downside, and an 8% dividend while they wait. That's a convertible preferred, and that's what Strike, STRK, is. It's most of the upside of Bitcoin, very little downside. It's like 6-7 times over collateralized, and it's a dividend. Other people, they don't want that. They just want, for example, 10% dividends forever. care about anything more than that, but if you pay me 10% dividends forever, that's interesting. So we just take an asset that's very volatile that we expect Bitcoin to go up 30% a year for the next 20 years. We expect it to go up more than 20% forever. So it's not a problem for us to give 10% dividends because that's our business model. But for the investor would like to see that we're 5x or 10x over collateralized, right? So for every $10 billion of Bitcoin we own, we might sell $1 billion of that credit with that $100 million a year dividend stream. And so you're the credit investor, you're just getting that pure yield. And from our point of view, we're paying 10 and we're getting back 20 or 30, right? So it makes sense for us. And then, there are other flavors, like we created this product, Stretch, STRC, which is a treasury credit instrument. The idea of that is it's just a high yield bank account. Like, we'll give you a bank account or we'll give you a money market type instrument that pays 10% yield, and the idea is for it to be a 1 month duration, so we strip all the volatility away. We target a $100 par value. You take cash that you don't need for 6 months, but you want to earn 10% instead of earning 4%, and you buy that instrument. Now, you don't want the upside of Bitcoin. You don't want to buy, a lot of people don't want a 20-year bond. What they want is they want a money market, right? And so you don't want infinite interest rate duration, you don't want delta, you don't want volatility, just give me pure yield. That's probably the most refined digital credit instrument. So what our company's doing is we have a lot of capital. We have about $70 to $75 billion worth of Bitcoin on any given day. We sell those credit instruments, and we have about $6 billion of those credit instruments outstanding. They're so way over collateralized. Then we generate various types of dividend streams or upside with them. As it turns out, we expect Bitcoin to appreciate 30% a year, but we don't pay more than 10% to 12% dividend streams. So our common stock shareholders get the excess. So what happens is we take that volatility and performance of Bitcoin and we strip the volatility, the risk, and the performance off, and we sell you 10%, 12%, 8% as a credit investor. And then the extra performance and volatility goes to the equity. So MSTR, which is our common stock, is more volatile, higher performance than Bitcoin. And what you have is some people want more Bitcoin performance and they want to be on a roller coaster and they buy the common stock. And some people want less and they just want the pure dividend stream. And of course, the people that just love Bitcoin and they don't want any counterparty risk, they don't want owner security, they just buy the commodity Bitcoin. And so that's how we sit in this ecosystem.
Right, so it's almost like a levered bet. I mean, it's a way to be exposed to Bitcoin without having to actually buy the actual commodity itself. There is so much to unpack there, Michael. I mean, you just talked about, how much Bitcoin you have, $75 billion. Just talk to us about how much that actually represents and what's your end game here.
Well, we own about 640,000 Bitcoin, and that's about 3.1% of the network. 3.1% of all the Bitcoin that will ever exist, we have acquired. Most of that we've acquired with equity capital. About $50 billion plus of common equity, about $6 billion worth of preferred equity, and so the company is substantially equity, and our primary business line is to issue this credit instrument, and every year we sell a bit more equity and we sell a bit more preferred equity, and we buy more Bitcoin. So like this week, we bought like 390 Bitcoin. Every week, we'll acquire a bit more, and we just continue to grind up. And as we do that, Bitcoin becomes more scarce. And because we're buying so much of it, that means the price over time has to appreciate because all the natural sellers get taken out of the market, and no one wants to sell unless you raise the price for it.
Right, so you are really a pioneer in what you do with regards to Bitcoin treasuries. I mean, how many companies are out there now doing what you do, and do you welcome that?
Yeah, and in August of 2020, we were the first public company to make any meaningful commitment to crypto assets or to Bitcoin specifically. And we bought $250 million worth of Bitcoin in August, and then we followed up with another $175 million a few weeks later. we were the first, then came Block, then came Tesla, then came half a dozen or a dozen other Bitcoin miners, and by about a year ago, there were maybe 60 companies that owned Bitcoin, and then it doubled, and now I think there's probably 180 companies that own some amount of Bitcoin on their balance sheet that are publicly traded. We're 10x larger than the next largest one in terms of holding, so we're the 800-pound gorilla in the space. I think probably 1.1 million Bitcoin are held by public companies, and we own about 2/3 of it. So we're the largest player. We're the first ones to actually issue digital credit instruments like these preferreds that are trading in the public market, but I expect that others will follow. There'll probably be about half a dozen companies over the next 12 months to 24 months that will follow and issue those kind of credit instruments. We welcome those companies. I mean, the truth is every single company that capitalizes on Bitcoin takes more supply. There's only 21 million Bitcoin ever. So, if Microsoft turned around tomorrow and bought $100 billion of Bitcoin, that would be great for us. Right? So the more companies that buy Bitcoin, the better. Most are just capitalizing on it. They're just buying it in lieu of holding treasuries or holding cash. Right? It's like a company can own real estate, a company can own any other asset, a company can own Bitcoin. So most do that. There'll be a few pure play treasury companies that will also issue digital credit against their underlying Bitcoin, but you need to have, more like $10 billion of capital before you can get to critical mass where you could do 500 million and billion-dollar IPOs of credit instruments that will be liquid in the market.
Okay. Let's just take a step back. I mean, obviously you founded Strategy in 1989. I just want to get a sense of what Bitcoin is to you. I mean, you've called it digital gold, but you've also talked about how, the fact that it's evolving faster than people can digest, but also the fact that there's a lot of criticism out there and it will continue to be misunderstood. How do you speak to that? I mean, how do you reassure the markets about what you're doing out there?
The best way to think about Bitcoin is it's the world's first example of a technology that allows individuals or corporations to tightly bind economic energy to their person. If you have 100 families and they all have some money, but they don't trust each other, they don't trust their bank, they don't trust their government, they don't trust any company, but they want to keep their money. So they come up with the idea of a digital bank. You write it in software, and the digital bank has 21 million coins, and anybody can buy any amount of the coins in the bank, and that becomes their bank in cyberspace. Now the question is, who runs the software? Well, I might trust you, but I won't trust your great-great-granddaughter. So we all run the software. Everybody runs the software, and then the software continually cross-checks everybody else. It's a very elegant, decentralized way to create a property network or a decentralized banking network. It's a protocol for economic prosperity, right? Just like you speak English, I speak English, we can communicate. You use Arabic numerals, I use Arabic numerals. We could do math together, and you offer me nine bananas. I know what 9 is, right? Because we both use the same numbers in the same language. Well, what if we want to trade together and we don't want to rely upon any government or any bank, and we want to do it for 1,000 years? So Bitcoin represents that breakthrough. It's the first time in human history that an individual can own anything without asking the permission of someone more powerful than them. If you have 1,000 Bitcoin and you have the private key, nobody can take it away from you. You can carry it with you. You can send it anywhere on earth. You can take it with you to the grave. You solved the problem that the pharaohs in Egypt couldn't solve. How do you take your money with you? So that's a big idea. Let's just call it a bank in cyberspace where you put your money and no one can steal it. And it's currency in the sense that there's never going to be more than 21 million. So when you buy a Bitcoin, you're buying 1/21 millionth of all the money in the world forever. That's the idea. What do we call that? I call it the world's reserve capital network. Right? It is capital. What is capital? Long-term store of value. You're a rich person. Where do you save your money for the next 100 years? Not in a currency, You don't buy pesos, you don't buy euros, you don't buy the US dollar, you don't buy the yen. If you're a rich person, you want to save your money for 100 years, you're buying equity, private equity, public equity. Maybe you're buying scarce desirable art. Maybe you're buying real estate, commercial real estate. So the capital assets of the 20th century were like the S&P 500 index, or New York or London real estate, or maybe sports teams if you're lucky enough to be able to buy one. But what Bitcoin represents is digital capital, right? If I have a bank and it's a network, a bank, I can move the money. I can move $1 billion from here to Tokyo in a few minutes. So then that way it's a network. But it's also capital itself. If I gave you $10 million and I dropped you in the middle of Africa, and I said, buy anything you want, buy any equity, buy any land, buy anything, buy any bond, buy anything, but you got to keep it for 30 years in Africa. Or I said, or you could buy $10 million of Bitcoin, and by the way, you can send it to Singapore or London or Paris or New York in 2 minutes from your phone. I would submit to you, there's not a single thing you would buy in Africa. There isn't a capital asset that you want to give to your family or your great-grandchildren. The same is true if you actually talk to people in China. They don't want to keep their money in China. There's a law against removing it from China. In Russia, in Ukraine. If you talk to Europeans, they don't want to have their money locked down in any country in Europe, right? They want to have their money. Where do people want their money? They want it in the U.S., right? How about Brazilians, Argentinians, Venezuelans? Most of the world doesn't want to take all of their family's wealth and store it locally in real estate, local stocks, local currency, local banks. That's why there are laws against them removing the money. And the problem with gold is if you have all your money in gold in Africa, you can't take it through the airport. You can't take your, if you have all your money in gold in Argentina, you can't bring it out of the country. So the value of Bitcoin is it's digital gold. So if you have your family's assets in Bitcoin, you can take it anywhere you want. No one can stop you from removing it from the jurisdiction. And the more insecure you are about the country you live in, the bank you do business with, the nation state you rely on, or your economic future, the more desirable it becomes. So, in a nutshell, Bitcoin represents property rights for the human race. It represents economic prosperity, and we'll call it colloquial digital gold, but it's 100 times better than gold. You cannot teleport gold from here to Tokyo with the blink of an eye, right? And if you have gold, I can shoot you and take your gold. If you have Bitcoin, I can kill you, but I don't get the Bitcoin. And so it is a state change difference in the economic vitality of an individual, a company, a family, a nation state, the human race. And so that's why all of us in the crypto community, we really we revere Satoshi, and we think about the world before Satoshi and after Satoshi, because before Satoshi, everything you owned was subject to the permission of someone more powerful than you. And after Satoshi, after January 3rd, 2009, you could own something for yourself that no one can take away from you, and that is what's caused the entire 750 million person crypto movement.
And it certainly has been gaining traction. I mean, crypto has got so many tailwinds this year. I mean, more regulatory clarity and support, more corporate adoption, institutional appetite, and also legislative wins. I mean, which one has been the biggest tailwind for the space, and what continues to drive it higher?
There's been about half a dozen massive milestones in the past 24 months. The first one was the approval of spot Bitcoin ETFs in January of 24. And that sparked the explosion and the explosive success of IBIT, which went from $0 to $100 billion in less than 2 years, and it's the most successful ETF in the history of Wall Street. So that was a big deal, the endorsement of the SEC. The second big deal was the red sweep in November when you had a pro-crypto, pro-Bitcoin administration. We went from one supporter in the cabinet, Gary Gensler was a Bitcoin believer, 1 out of 12, to all 12 cabinet members, the president, the vice president, the head of the SEC, the head of the CFTC, the head of the Treasury, the head of Commerce, the head of, RFK, the head of, the head of, the Housing Authority, Bill Pulte, Kelly Loeffler, and Howard Lutnick. So you all of a sudden have 12 positive cabinet members from one, and that was a big deal. The third big milestone was FASB's adoption of fair value accounting for crypto assets. Before that point, and that took place at the beginning of this year, beginning of 2025. Before that point, if you're a public company, you could mark down your losses on Bitcoin, but you could never realize the gains. Right? It's literally an asset where you could only lose, you could never win. Right? So the entire accounting rule was a deck stacked against you. And so fair value accounting meant that our equity, for example, went from 3 billion to 50 plus billion in 12 months. Right? But if it wasn't for fair value accounting, we would still have $3 billion instead of 50 billion. So that was very prejudicial and hostile accounting, and that flipped in January. I think the fourth big milestone is all of the pro-crypto and pro-Bitcoin guidance that came out of Treasury, the OCC, the FDIC, and the Federal Reserve. And the key point there is most banks in the United States and the rest of the world were afraid to custody Bitcoin. They were afraid to lend against it. They were afraid to do business with it under the previous administration. And I think the guidance that came out of the current administration delivered a message, which is not only is it safe for you to custody and extend credit against these assets, it's really imperative because the United States wants to be the crypto capital of the world, and we want to lead in digital assets, and that means our banks need to lead in digital assets. So that you can attribute to the President and to the Secretary of the Treasury, Bessent. I think the next thing was the passage of the Genius Act, championed by Senator Hagerty, and that created a stablecoin environment in the United States. And the idea there is, why can't we tokenize the U.S. dollar and ship $1 trillion of it to the rest of the world, or maybe $10 trillion of it to the rest of the world? Because money wants to move at the speed of light, and this is the critical part of the crypto ecosystem. So the last two banks that moved crypto dollars around were Silvergate and Signature Bank, and they were assassinated by the previous administration. They were shut down on a weekend for no good reason. They were perfectly well capitalized, and they were literally murdered by regulators. So you can imagine that the banks were afraid to get involved with crypto under the previous administration. Getting a supportive White House, a supportive cabinet, a supportive head of the Treasury, and then a law that says that it is legal for you to do this, I think was pretty important. Then that has resulted in an avalanche of institutional adoption, and now you have companies like JP Morgan, right, and Bank of America, and Wells Fargo, and BNY Mellon, and PNC Bank, and Citi, that are all announcing their support for this asset class. And if the trillion-dollar banks are willing to custody, and they're willing to extend credit, and they're willing to handle the asset class, and they're willing to bank the crypto industry, that's really the necessary condition to 10x from here. Like, Bitcoin got to 100,000 without their help, but getting to 1 million requires the banks to bank the asset. And so the next 4-year period is really about banking Bitcoin and the support for digital assets in general by the major establishment of bankers in the United States and everybody else in the world, right? You can imagine the bankers in Australia, Canada, Singapore, the Middle East, and Europe, Mexico, they all follow the U.S. banking standard. And so what you have is an avalanche or a sea change here, and the headwinds have become tailwinds.
Okay, so that's what got us here. Let's just talk about the short term, 2025 year end. Where does it end up? Because I've heard everything from 100 to 200,000.
Yeah, well, the consensus of all the equity analysts, there's like a dozen of them that cover our stock, is north of 150,000. Our corporate guidance is targeted at $150,000 by the end of the year.
Right. Okay, and sort of looking further out, have you got a sort of a 2030 target?
I don't have a specific target, but in the 4 to 8 year time frame, I think Bitcoin goes to $1 million a coin. My 21 year expectation is Bitcoin appreciates about 29% a year for 21 years, and that leaves it at $21 million So I think that Bitcoin will appreciate in the range of 29 to 30% a year for 20 years from this point.
Okay, you seem to like that number, 21. Just as far as what we have to work with through the end of the year now, I mean, you know, is there a favorable macro environment to support that as well?
I think the drivers right now will be Fed decisions with regarding monetary policy. Clearly, that drives every asset class, and we've had a fairly tight monetary policy right now, and if that policy loosens, that'll be a driver. I think other than that, the industry is volatile, and the primary actors in this case are the banks, and every time a bank makes a major announcement about Bitcoin acceptance or crypto adoption, those are all very positive for the asset class, and those should come progressively.
You know, it's interesting, just as far as the more recent price action that we've seen off the back of October the 10th, I mean, we did certainly see risk on for equities, but it feels like Bitcoin's kind of been stuck and sort of lost the momentum. Why is that?
I think it's a $2.5 trillion asset class that's been unbanked. So imagine that you started a company, NVIDIA, and you gave 90% of the stock to the employees, and they went from $1 to being worth $3 trillion, but no bank would give them a loan against it. So you're an employee, you've got trillions of dollars of capital gains, but no one will give you a nickel loan against it. You cannot get a loan. You could post, you know, you have $10 billion of Bitcoin, you can't get a $1,000 loan from a major bank right now. So what happens is the OG crypto holders, the ones that actually had the capital gain, the only path they have to liquidity is to either rehypothecate the Bitcoin and it gets shorted in the market, or to sell the Bitcoin. So I think we're working through a period where 10% of the supply, or you know, it wouldn't. What percentage of the equity in your big tech company would be sold by employees? You know, when they all got insanely rich, probably 10-20%, right? They would sell at least. So we're waiting for that to boil off, and we're at the point where everybody knows that Bitcoin is digital gold and it's got institutional acceptance. But banks are very careful, bureaucratic, and process-driven creatures, and they should be, right? I mean, you know, if banks get out of control, right, there's hell to pay. So I think it'll take 4 years for the conventional, traditional banking establishment to get spun up, where they're custodying the asset and they're extending credit against the asset, and it's worked its way into the systems, right? I mean, Bill Pulte has directed Fannie Mae and Freddie Mac to start to recognize this as good collateral, but how long will it be before you can post your Bitcoin as part of your conforming loan collateral? And it's a government, quasi-government type agency, and the credit rating agencies, they're starting to cover us, like we just got covered by S&P. But how long before they acknowledge Bitcoin as collateral or capital that's just as good as holding a share of NVIDIA stock or Apple stock? And I think, reasonably speaking, that's a 2 to 4 year adoption curve. So between 25 and 28, the traditional finance infrastructure to bank and collateralize and issue credit against this will come online. When that happens, if you think about every asset class, if you can't get a loan to buy a car, and if you can't get a loan to buy a house, what happens to car prices and house prices? Right? At the point that the credit market forms over the asset class, the prices move up. So what you see right now are the bank credit markets, the corporate credit markets, right, and the public credit markets are forming on top of Bitcoin. And as they form, that's going to be very positive for the asset itself.
It's about those believers, isn't it, as you say? And you actually have previously said that each quarter you gain more believers. Can you give us a sort of sense of what you've seen in the most recent quarter?
Well, I think that we started with the early shareholders of Strategy. They were Bitcoin and crypto believers who were prohibited from buying Bitcoin due to regulations in the various markets. So you're a Bitcoin believer and you're a retiree and you live in the UK and you have all your money tied up in your UK retirement plan. It's illegal, impossible to buy Bitcoin with that money, but you could buy a stock, so you'd buy MSTR. Same in Australia. Actually, everywhere in the world, there are large pools of capital that are tied up in these tax-advantaged accounts, IRAs, 401ks, etc., where you might be able to buy security, but you can't necessarily buy, you can't just say, I want to buy a bunch of my favorite artist paintings that are, Art Basel. So the early believers were the crypto enthusiasts that had capital tied up. And mainstream investors, big investors that actively manage funds at Capital Group or Morgan Stanley, that they believed in the Bitcoin thesis, but they had pools of billions of dollars that were mandated to make equity capital investments. 99% of the professionally managed money is mandated to equity or credit. They can't invest in a commodity. So we offered the first equity to the equity capital investors. And what we followed on next was a set of convertible bonds. We became the biggest convertible bond issuer in the world. And they were the most successful convertible bonds, and there was a lot of money earmarked to convertible bonds. So after we became a substantial part of that market, we outgrew it. And then we went on to preferreds, and in the preferred market, we started creating these publicly traded digital credit instruments. They were targeted at a different user base. I mean, the person that wants to collect a 10% dividend forever, but they don't want the Bitcoin upside. It's like, okay, I hear you when you say you expect 30% a year for the next 20 years, but just guarantee me the first 10 and you can have the next 20, but take the volatility away and then take the risk. Like, right? There's a lot of people that would rather have 10% after tax with 1/100th the risk, right? And so that's a different class of investors. So we have rotated from the true believers to the hedge funds that, like, the Millenniums and Soros and Citadels that wanted to trade and hedge the convertible bonds, to the credit investors that want long duration, sophisticated credit. And then with Stretch, it's just money market investors. I have some money, I just want more than zero, but I don't really want to risk the principal so much. And so that last set of investors are, retirees, mainstream, retail. I think we had $600 million of retail demand for our Stretch IPO in 2 days. So in 48 hours, we had $600 million of demand, and that was an order of magnitude larger than the retail demand for our other, instruments. So right now, this is migrating to family offices, retail investors, high net worth individuals, and of course fixed income investors like, PFF, which is like BlackRock's preferred fund. I think like 3.5% to 4% of that fund is invested in our credit instruments, which didn't exist 12 months ago. So we're now starting to move into credit indexes. Of course, you're a credit investor, you have to buy credit. You're an equity investor, you have to buy equity. We're also in equity indexes. For example, our biggest shareholders are Vanguard and BlackRock through their passive equity index funds. So there's a lot of pools of capital in the world. Some of them, if you lived in Africa and you needed to flee the country and you didn't trust your bank, I would say buy Bitcoin, put it on your own hardware wallet, because you can't trust the bank. Right. But that's one class of Bitcoin investors. But if you're an investor in the United States and you have pools of capital earmarked to equity or credit, then you probably want something created by a company like ours.
There had been a view out there that crypto was uninvestable without the regulatory framework and guardrails in place, but we have seen these sort of legislative wins, as you mentioned, and we still got to 100,000, to your point, without that. I'm just wondering, talk us through Strategy's involvement in the latest legislative efforts now to really regulate and create those guardrails and construct the infrastructure for everyday people to understand and access and have that exposure to crypto.
If you look at the digital assets industry today, you could divide it broadly into two segments. One segment is digital capital, and that is Bitcoin. It's dominated by proof-of-work networks. Bitcoin is 99% of all the energy and all the capital on that side of the industry. And digital capital means digital gold, and that means, I want to buy something without counterparty risk and hold it for 100 years. And what do you do on top of gold? you issue credit. For 300 years, the Western world ran on gold-backed credit. All of our currencies, all sovereign debt, all corporate debt was in essence a form of gold-backed credit. So the part of the industry which is most traditional and conventional is digital capital, digital credit, all basically centered on Bitcoin and Bitcoin treasury companies, and that's what our company strategy does. The other half of the industry is digital finance, and that is all about tokenizing currencies, tokenizing securities, stocks and bonds, tokenizing real-world assets, tokenizing brands, right? It's Joe Rogan token, right? It's a meme coin, but it's also the dollar, right? It's also a stable coin. So that opportunity is, why don't we create $10 trillion worth of stable coin and export our currency to the world and move the money at the speed of light and let the computers trade with themselves 1 million times a second? Why not? And that's also about capital formation. Like, there's 40 million companies in the United States. Why can't they all just issue their own token to raise capital, right? Tokenize your country club membership, tokenize your restaurant, tokenize your hotel chain, whatever, Katy Perry token, Joe Rogan token, everybody token. Right now, you want to go public, it's $40 million in 4 years and an army of lawyers. Well, what if I just wanted to spend the weekend or 4 hours or 4 days and I wanted to raise money for my $2 million company or $20 million company? So capital formation is another killer application of digital finance. The third killer application is I tokenize a share of Apple stock. Okay, why can't I just send Apple stock between India and Pakistan on Saturday afternoon on an Android phone? Okay, what are you doing? You're basically moving the securities market at the speed of light. Everybody wants 24/7, 365 trading, and if I can self-custody my Bitcoin, why can't I self-custody $1 million worth of Apple stock? And if I can self-custody, maybe I can actually, get bids from the highest bidder, and I can send $1 million of Apple stock to Singapore and get paid for it. So, this entire area of digital finance, this is very entrepreneurial. It's all about innovation. It's much more sophisticated, and that is the other half of the crypto market. Now, the first half of the market, digital capital, digital credit, that's got regulatory clarity now. Right? Bitcoin is digital capital. The President of the United States has said it. It's been the Secretary of Treasury. They've all clarified that. So that's pretty much just about issuing traditional, conventional credit instruments, taking them public on capital markets. And if there's any hoops to jump through, it's like, how do I sell Stretch in euros in Switzerland and get the sign-off from the European Union, the Swiss regulator, the exchange, right? But it's not new law. It's traditional finance law. The other part of the equation requires clarity. I mean, literally the act clarity. And so the next big crypto bill is the bill that defines and creates the bright lines and empowers. What can you do with digital currency? What can you do with a digital token? How do I tokenize my share of stock? How do I tokenize, STRC and let it trade at the speed of light in Singapore on the weekend on a crypto exchange? Right? It's not clear how to do that yet. Is there demand? Yeah, there's $100 trillion of demand, but I think that there's bipartisan consensus that we need that bill. That bill will get passed. We don't know what the final bright lines in the bill will be, and once the bill is passed, then it'll be clear, what you can do and what you can't do. And so I think that if you're an institutional investor or conservative investor, right, you can buy Bitcoin, hold it as a store of value. You can buy digital equity or digital credit instruments backed by Bitcoin. That's all fairly straightforward. I think in the other part of the industry, the digital finance part of the industry, it's very driven by technology, it's very regulatory intensive, and then it's unclear, how will every jurisdiction, view every regulation. So it'll be a bit more complicated, but, we're talking about extraordinarily exciting new ideas, an artist, a celebrity that could own their own brand, and a membership that could be tokenized, a ticket that could be transferred. So there are a lot of things that will happen, and they'll be transformational and innovative, but, they'll require more legislation before before you're going to find your favorite celebrity do it, they're going to want to make sure they're not getting sued by the SEC.
Okay. And speaking of these new ideas, I mean, why should the U.S. government have a Bitcoin reserve?
I think that the key to understand Bitcoin is it is like owning a piece of cyberspace. It is the world reserve capital network. So if you're looking at a world that's going to have hundreds of trillions of dollars of capital on this network, and if we're looking at a world where you're going to see trillions and maybe tens or hundreds of trillions of dollars of credit on top of the capital in the network, right? You might want to own a piece of it, right? What I say is the United States purchased 79% of the landmass of the country. 79% of the United States of America was purchased for $40 million. That's all of Louisiana Territory. That's all of Texas. That's all of California. That's all of Alaska. We purchased it before we knew there was going to be Hollywood, before we knew there was going to be a Silicon Valley, before we knew that anybody would want oil, right? We purchased Alaska 1867 with Seward's Folly. He was a fool for doing it. It's got trillions of dollars of oil underneath it right now. So if you can actually purchase the future, if you can own cyberspace, you ought to, right? What you know, the Dutch, I think they purchased Manhattan for like a few guilders and glass beads or something, right? So it's very valuable real estate, you know, in the same way that you want to control the world's reserve currency network. I mean, the corollary is why should the U.S. actually sell $10 trillion of stablecoins? Because money wants to move at the speed of light, and if we sell the 10 trillion of stablecoins, and if our companies run that network, we will control currency for the next 100 years. And so I think the United States ought to dominate the world reserve currency, and it ought to dominate the world reserve capital network. We're the biggest holder of gold, you know, and if I said to you, would you like to own the majority of the oil in the world? John D. Rockefeller thought yes, and we were the biggest generator of energy, you know, due to Standard Oil, you know, at the turn of the century, and that's why we won World War I and World War II, because we were the energy dominant leader. Well, Bitcoin is digital energy, right? Either you own it and control it, or somebody else does. And so I would just make one more point. If the U.S. doesn't, they should encourage U.S. banks, U.S. investors, U.S. corporations, and taxpayers to own it, right? It's not necessary for the U.S. to own it outright, but it's very, very critical that U.S. banks, U.S. investors, U.S. corporations own it and control it, in the same way that it wasn't necessary for the U.S. to own all the oil, but it's pretty necessary for a U.S. corporation to own the oil.
What about the energy side of it? I mean, so many Bitcoin mining companies now pivoting to focus on AI data centers. I've been talking to a number of them. I mean, you've got Iran, you've got CleanSpark, you've got Hive. What are your thoughts on this?
I think that it's been an extraordinary 180-degree turn for the better by the nation. I think maybe the most profound development of technology in the 20th century was nuclear power, nuclear energy. Unlimited, clean, scalable energy. And we shut down the programs for 50 years. And in 2020, if you talk to energy companies, they were going to decommission all those nuclear reactors. And we were asking the question, how do we get this nation to embrace the importance of electricity? And if you want to generate infinite clean electricity, you know, the most efficient way to do it is with nuclear technology. So I think there are two things you want to do with energy. One thing is you want to create digital intelligence, right? And that's what AI is. And we discovered the way you create digital intelligence is you feed an extreme amount of energy, you feed gigawatts of energy through very customized silicon chips, NVIDIA chips, you know, GPUs, and then out comes digital intelligence. Well, you know what the Bitcoin industry discovered is the way you create digital money, digital capital, is you take gigawatts of electricity and you feed it through custom silicon, ASICs, and you generate a wall of encrypted energy to defend the network, and that's what Bitcoin is. So what happened in the last 4 years was the Bitcoin miners were under pressure for using too much electricity by the environmentalists, And we were defending that. We were saying, but we're actually going to create a new banking world order, and it's going to be worth hundreds of trillions of dollars, and so it's a good use of electricity. But we had a hard time winning that battle. Then all of a sudden we have the Chat GPT moment, and people discover that they also need power in order to create digital intelligence, and that turned Apple, Amazon, Facebook, Google, right, Microsoft, and hundreds of millions of Americans into true believers. And that entire debate about whether electricity good or electricity bad just went away, and the entire debate over nuclear power went away. And all of those AI data centers, they desperately needed high power data centers. And you know who owned them? The Bitcoin miners. And so as the Bitcoin miners were struggling with the economics of the industry, because the way the Bitcoin works is it gets exponentially more efficient to mine Bitcoin, and so the margins of Bitcoin mining are decreasing. At the point they were struggling, along came a new buyer for those power rights, and they were able to pivot and monetize those power rights. So AI and digital intelligence saved, the Bitcoin miners. And what are they? They're digital power providers, right? And ultimately, the entire industry is, the market is starting to realize the future is digital capital, digital money, digital intelligence, right? That's the future, and the way you create it is with silicon and electricity. And so if you want your nation to dominate in the 21st century, you better have digital power, you better have digital money, you better have digital intelligence, right? Just like you want air power or sea power or land power 100 years ago. And of course, I think what everybody's realizing is now it's a mad scramble to harness hydro and natural gas, but ultimately the solution is nuclear.
I mean, we could keep talking about energy forever. I find this part of the story just super fascinating, but I just want to know, what is your message out there to the skeptics?
To the Bitcoin skeptics or to the what skeptics?
To the skeptics of Bitcoin and also just broadly crypto.
My message is if you live in Argentina and you've watched the currency collapse completely every 20 years for the past 100 years, and if your family was impoverished 5 times in the century, and an engineer named Satoshi came along with a way for you not to be poor and destitute, and he said, well, it's no more difficult than just put this wallet on your iPhone and now you don't have to be poor, then you would be utterly captivated by that vision. And that is the plight of everyone. If we go on my hand and say, how many people have lived in societies where they had their property rights and their wealth stripped away from it? It's everybody in Africa, everybody in South America. Brazil's currency collapsed, Argentina's currency collapsed, Cuba's got no currency, Venezuela collapsed. Everybody in the Middle East, people in Turkey right now. Russia collapsed 30 years ago, Russia's collapsing now. Everybody in Ukraine, everybody in China doesn't trust their currency, right? Everybody in Europe doesn't trust their currency. So if you're a skeptic, you must be an Upper East Side trust fund baby, and you're lucky enough to be born rich in the only country in the world where the currency didn't collapse in the last 100 years. And your currency's lost 99.9% of its value over 100 years. The US dollar has debased 7% a year on average for 100 years. So you're probably smart enough, if you're wealthy and a skeptic, to know that you shouldn't store your family's assets in cash dollar bills. You're probably smart enough. You're privileged enough to be able to invest in U.S. real estate and U.S. equities, because that wouldn't work in any African real estate or any African equity, right? Or any North Korean equity, or et cetera, any Chinese equity. Wouldn't work in Japanese equities either, right? In fact, I could go on and on and on. So you're a privileged person that happens to be rich or happens to have money that's invested in the world's most secure assets in the U.S. But Bitcoin is digital capital, and it's for everybody else in the world that wasn't as privileged as you. For them, it's the difference between 7 billion people living in destitution and 7 billion people having hope. And so Bitcoin is an idea whose time has come, if you're one of those people, right, you're going to cling to it like a diabetic would cling to insulin, right? Before Bitcoin, every company in the world, everybody in the world is a type 1 diabetic. They cannot store economic energy, right? So if you're in that situation, that is life affirming for you. It's not a laughing matter. That's why people are so passionate about it. But let's say it's not. You're not one of those people. You happen to be one of the 500 million or a billion elite that lives in a very comfortable environment. It just happens to be the best idea for you. It's the ultimate alternative investment. It's an asset uncorrelated to a currency, uncorrelated to any nation state. It's not an equity. It doesn't have counterparty risk. So the reason you ought to look at it, it's the most valuable real estate property. It's basically buying a piece of cyberspace. And if you had a chance to buy an acre of Manhattan in the year 1700, you would have been paying top dollar for it. And then every decade for the next 300 years, someone would pay more. And at what point did buying land in Manhattan ever become a bad idea? It's still a good idea. And Bitcoin is cyber Manhattan. It's one day 8 billion people want to put their money there, and there's only 21 million blocks. That's 276 by 276 by 276. You can't make any more of it. So our view is it's just a good idea. It's the best idea for a conventional investor, but it's a life-saving idea for the rest of the world.
I like that. Cyber Manhattan. It's almost like a monopoly board, but for crypto. Just on a lighter note, Michael, who are your role models in the financial world?
Yeah, I think that the people that are inspirational are the industrialists that took a technology and they commercialized a product and gave it to the world. So, you know, you got John D. Rockefeller came along, looked at crude oil and extracted kerosene and eventually extracted gasoline and diesel, right? And we heated our homes and lit our houses, but eventually we ran our cars and our jets and our rockets. Kerosene is rocket fuel and jet fuel. And then, you know, take Henry Ford, right? He took a fire and an explosion, explosives in a fire, put it into an engine, wrapped it onto a carriage and gave everybody an automobile, and he basically gave everybody the ability to travel 100 times as fast and safely. And, you know, history books are full of people that died because they had to walk 100 miles in order to get from here to there, and they caught pneumonia. So Ford gave mobility to the world. You know, I think I could go on with Boeing, and you could look at the iPhone and the radio and the telegraph, and you can look at the, you know, development of penicillin, antibiotics, and the like. But I think that, you know, and if you look at Bitcoin right now, right, so Bitcoin is this scary, explosive crypto thing. People are afraid it's going to blow them up or it's going to hurt them, right? What we're doing right now, the thing I'm most excited about, our iPhone moment, is Stretch, STRC. Because Stretch it's a high yield bank account, you know? I want my money to generate 10% tax deferred income forever. Where are all the moving parts? There's no moving parts. What's the product? Comfortable retirement. Well, what's the alternative? Well, 2 or 3%. So you're just going to give me 5 times more money. What do I got to do? Well, what do you got to do to drive a car? Well, believe in the engine. What do you got to do to fly in an airplane? Believe in the plane and the pilot. What do you got to do to get 5 times more than your bank's offering? Believe in Bitcoin and then this issuer strategy. So our job is to get people to trust us and then give them a comfortable retirement, or just give them money, right? We're in essence selling money by using digital technology to double or triple someone's yields.
We've covered a lot of ground. Do you want to leave us with a final thought?
2025 is the first year of institutional adoption of digital assets. So if everything that I'm saying sounds new or scary or novel or you never heard it before, that's because 12 months ago, Donald Trump hadn't won the election. And 12 months ago, your bank would have been shut down had they even tried to suggest this to you. So we are living in a very special period where it's just like in 1902, every learned person would have given you 100 reasons why human beings will never fly. And in 1904, it was obvious that we were going to fly because we flew in 1903, right? And so we're like 1904 for a digital asset. It's pretty obvious, right? The president's told you it's a commodity, the cabinet's told you, the head of the treasury's told you, all the banks are moving. But the way it works is the traditional finance world's going to take 10 years. You know, like Vanguard's going to tell you, well, we're afraid of crypto assets, don't buy it. But you know, Vanguard's my biggest investor, like passively. But actively, right, even though they're the biggest investor in my company, actively they haven't quite got around to processing the fact that, I guess, the digital form of everything is 100 times better than the analog form. Digital photos, you know, you'd Kodak and you'd Apple, right? Digital books, digital gold, digital video, digital whatever. We're living through the digital transformation of the capital markets, and people weren't sure that was going to happen a year ago, but now they're happening, and you've got a 10-year digital gold rush. And so the beauty is, you can make a lot of money if you are willing to do the work. If you're willing to do the research and spend 10 hours thinking about this, or 100 hours, well, you can buy Bitcoin for a 99% discount. If you wait until the year 2035, your bank's going to tell you, yeah, it's easy, we all support it, it's good, well, LeVar gets it. Then you're going to pay 10x more. And if you wait until the conventional wisdom is this is the world's greatest asset class, well, it's going to be $10 million coin, and you're going to pay 100 times more. And so you're living through a technology transformation where you get a massive discount and you get paid a lot if you think for yourself, and if you do the research and you come to a conviction over this issue. And I couldn't have said that 2 years ago. 2 years ago, or 6 years ago, you know, we need the President of the United States to endorse it, but if we don't get that, then you've got a different future. So this is a special year, and there are special opportunities, and I would encourage everybody to focus on it and come to their own conclusions, because it's the most auspicious development in the capital markets in my lifetime.
And there's some irony in there. I like it. Exciting times. Michael Saylor, it's been an absolute pleasure. Thank you so much for joining me.
Yeah, thank you.
That is the Executive Chairman of Strategy joining me there. For all your market news, Bitcoin news, and more, be sure to subscribe to Schwab Network's YouTube page and follow us on social media. I'm Sam Bartis. Thanks for tuning in.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcast